ball rolling then, I'd like to invite on stage none other than the co-founder and managing partner at Blue Ventures and the chairperson of IVCA. Ladies and gentlemen, a round of applause for Karthik, ready to deliver the welcome address. Karthik.
Rajat and team have given me a lot of talking points today. So again, on behalf of IVCA, a very warm, especially those who've come in from overseas and enriched the event today. I'm going to keep it very short. I have 10 minutes. Basically, for those who do not know IVCA and who are attending for the first time, this is India's premier sort of association of alternative asset managers. And what started about 20 years ago as a very humble, small group has today crossed 350 funds, combined AUM of 260 billion. Almost 45% of those funds are Mumbai-based. The rest are predominantly Delhi, NCR, and Bangalore. And a lot of the younger cities are now bringing membership forth as we see new fund formation. Also, I was fortunate enough to be the chair. Bloom played an active role along with all our executive committee members to sort of further advocacy for the industry with government and the regulators. And for people who are members already, just an amazing sort of enthusiasm, wave of enthusiasm around the new committee that's coming up. I finished my 2-year term next month, but basically there will be a new executive committee heralding IVCA for the next 2 years. We had a record 59 nominations from member funds for the executive committee. Only 9 of them get voted in, and the rest are nominated. We nominate another 6 members. So this 15-member executive committee is basically what helps Rajat, the president of IVCA, who's invited most of you today, and his team to execute and put together everything that goes through the year. And this is kind of a finale celebration of everything that we put together all through the year. So the quick journey in the last 2 years, policy and advocacy highlights, right? So we've made phenomenal, moves in getting in front of SEBI. The Damodaran-led expert committee took a little bit of a backseat, but we hope after the elections it'll come back to the forefront. The, dialoguing with RBI, talking to the government of India through initiatives like the Amrit Kal dialogues, basically forcing the government to actually have conversations with all the stakeholders of the industry. Industry development. So Rajat and team put together with Amit and with all of his colleagues a program called VC 101. So India has had over 100 micro VCs join the venture capital fold, for example, in the last 5 years. So rather than actually making them make the same mistakes that we went through 13 years ago as a young $20 million VC, we are trying to re-educate educate the venture ecosystem much faster. So 95 unique funds have attended this, program over the last year or so, and has a NPS over 62, and we're trying to put this on edtech platforms. We actually were the entire industry body and its members were very active participants in the G20 startup sort of track, which India started last year when we had the membership presidency of the G20, and also put together the corporate governance and ethics framework for the very first time globally, as if it can be continued as a global standard across G20. We're also then roping in ecosystems. So we believe that India can be built differently. It's a young ecosystem, 20 years of venture and private equity, where 95% of the people are not older than that in the ecosystem. How do we bring in, academic institutions like ISB and Ashoka University, Ministry of Corporate Affairs, and educate in all directions? So we are actually disseminating this through these colleges, also having ministries involved and getting educated on what we do. Events like Green Future Series, Global Investor Roundtables, have all been very well received by all stakeholders. Actually, next month, about 3 weeks from now, there is the Minister for Commerce and Industry, Mr. Piyush Goyal, won a standout event for startups called Startup Mahakumbh, which is happening in Delhi. And almost everybody in the industry is charged up, firing up for both not only participation, but it brought in massive sponsorships to make this happen. I think this is what's helping build trust and also be seen as the folks driving the early economic engines of growth in the country, which is what the IVCA comprises. And then we've seen trends in the market, and we want to be ahead of them as IVCA. So we've had an IVCA Private Credit Summit all in the last 2 years, an IPO conference, a secondaries conference. So essentially we realized that the market is getting mature, moving to sort of new subdivisions of this asset class, and we are trying to facilitate that through this body. Diversity is, finally up to standards we should be proud of. Of the delegates today, we have 200 women PE and VC professionals registered for this conclave. We have worked very closely with Nupur's organization called WinPE, which is Women in PE Foundation, and this is changed or started pushing at least mentorship to far more younger women, not seeing this as a daunting industry, but coming in droves to the industry. So big round of applause for diversity and seeing the women participation. Internationally, we've become a little bit more clever in terms of not just waiting for international investors to come for one IVCA conclave in the year, but also sort of export our industry to international events like Super Returns, where we did a Maximum India conclave alongside Super Returns. Idea is to try and do this in around 2 or 3 geographies every year, so that the Indian ecosystem can be visible around global events like Super Returns or whatever next happens in Abu Dhabi or New York or London. So 60 LPs, global LPs, and about 100 GPs were present when we did Maximum India Conclave at Singapore. And then advocacy milestones, right? So keep nudging and pushing the government, like private equity being able to sponsor AMCs in this country. That happened in the last year or so. A clarification of excuse clauses so that insurance industry can participate. Progress towards international listing, right? Pushing the government to try to get to direct listing in GIFT City. Ease of banking in GIFT City, which has basically made it a far more viable sort of jurisdiction for all of our industry. Easing overseas investment norms, laters, and I think, when policymakers think about where India can be in 2030, where India can be in 2047, how do we get to the 5 trillion mark, how do we get to the 10 trillion mark, they see this industry as the one shaping that acceleration. And we should all be proud and thankful that we've managed to congregate all our strength under the IVCA umbrella, which is the dominant sort of industry body today. Once again, thanks and welcome to a staggering 850 registered delegates for this edition. It's a record, and we have 730 delegates, 120 speakers, and a special shout out to all our government public stakeholders and our knowledge partners. They are the ones who make it a little easy as we go about our full-time jobs, helping the IVCA team to execute on a day-to-day basis. And over the next 2 days, next 36 hours, please participate as stakeholders coming to the event. And a lot of government folks right from the top, from SEBI, GIFT City, SIDBI, are all going to be here to address you. Thank you once again and welcome.
Thank you for that, Karthik. In fact, it's going to be lots of engaging sessions, lots of collaborative sessions as well that we can look forward to for the rest of the 2 days. All right, let's begin then. We've got our first fireside chat that's lined up, and this is going to be to talk a little bit more about the success stories of raising funds overseas versus doing it domestically. And for that, ladies and gentlemen, we have 2 very distinguished speakers who will be joining in on stage. It's going to be a very interactive and chatty discussion, I know. Put your hands together for Manish Kejriwal, founder and managing partner at Kidara Capital. And we also have Karan Bhagat, founder and MD at 361 Asset. Ladies and gentlemen, a big round of applause.
Okay. Truthfully, the 2 of us this morning didn't know 2 things. We didn't know there was not going to be a moderator, and we found out the subject of the talk about 3 seconds ago. So with that context, pardon us, I think We told Rajat if he wants to get back on time, he can just cut this thing all together. But he was very polite and insisted we stay on. So what I would say to my friend Karan is, and given the context of the topic in mind, is listen, the last year, 2023, if you look at it from a global perspective, it's been a disaster for the broader private equity industry. The number of fundraisers dropped dramatically. The number of deals done dropped even more. And finally, the new MOIC indicator today is DPI. DPI wasn't existent, right? The only thing I would say with to Karan is I still continue to be a long-term believer in China. Strategically, even India needs a strong China economically in order to play. The value chains are so deeply entwined, whether you look to our automotive manufacturers, whether you talk to our fan manufacturers. So we would want a stronger China going forward. But I think in the context of private equity, some very interesting things have happened. The global flows of capital which were going to China have stopped because there's been no disbursements from China. The level of activity in deployments, barring a few funds such as PAG or Fountain West have taken a cross-border approach in China, there's very little money going into China. The Indian press believes that money is going to come into India. That's not the case. The money will go probably from a risk-adjusted perspective back to the US. The two countries who are seeing incremental flow would be Japan and India in that order. So first, we got to keep the context on the reality in place, right? And I think the money which is coming to India, it's probably going to benefit the Pan-Asian funds much more than us, much more than most of the domestic funds. So if you see the money going into a KKR, a Blackstone, that has remained constant. They've raised $6 or $10 billion funds. The big difference is their allocation, given they have to deploy the capital in 3 to 5 years, will pivot away from China, given the context that there is, and that more money will come to India. So two things will happen. Valuations will go up, like we're seeing it go up already. The public markets are already the biggest competitor for players like us. But on the private side, the larger Pan-Asian funds will be more dominant with lots of dry powder. The good thing for us in our industry is depending on which stage you play in, and for us, we've remained relatively small and inconsequential. So the money we deploy is between 50 and 100 million to $200 million in our latest fund. That will grow and we can sell to the Pan-Asian players. So that's actually helping us increase DPI and exits. But if we started competing and raising $3 billion or $5 billion funds, where each deal size would be 300 to 400, that's a space we don't want to get into because the valuations are so high. So I think the headline, which is China, good for India, is true, but it's actually a very complicated level of iterations for the money to actually get here. And frankly, if you look at the global allocators, they're facing their own challenges, whether it's a denominator issue, whether it's the Asia is represented by China historically. So instead of redeploying, they're saying, we'll shut down Asia altogether. So I think we need to be very careful, obviously have a positive bias, but don't assume that money will just flow in for any strategy. And I don't know if you're seeing the same thing.
No, absolutely fair. I think I'll just kind of top off by saying, what's really also been interesting for the last decade, and I can say this especially for the last 7 to 8 years, I think domestic capital has become a big force also. And I think that's kind of shown itself not only in the listed side. Listed side, obviously, all of us are aware. Now, the SIPs, the systematic investment plans itself, are close to $2 billion a month. And it's kind of averaged out at an average of around about $100 per person. So that's a huge amount of flows. I think we've kind of built a domestic market which in terms of flows can be a little bit of a small counteract to FIs. But even on the private side, I think the last 7, 8 years has been phenomenal. Obviously, I think we've seen a huge amount of interest from family offices, high net worth individuals, retail investors, not maybe sophisticated retail investors, to come into alternates. We've also seen the growth of multi-asset alternate firms. I think that's very important. I think both real assets, private credit, private equity, different stages of private equity, from early stage all the way to pre-IPO. You've seen a lot of strategies come in. And I think what's really helped well is some firms have grown kind of horizontally, some have grown vertically. And that's really allowed the opportunities both in the top 3-4 cities as well as the next 8-10 cities to really foster. So I think overall the industry will have a little bit of, like potentially China benefited, we'll have a little bit of local bias also. And hopefully, the local capital continues to stay strong, both for the broad listed side as well as the alternate side. And I think the alternate side, a little bit of a tax change on 1st of April last year is really going to go a long way in helping propel the alternates industry. Because earlier the fixed income portion obviously was taxed at 20% less indexation on the mutual fund side. So there was a big friction for people to invest on the fixed income or the real asset side on alternates. That's changed now. So the taxation has become practically equal. There's still a little bit of tax arbitrage between the listed and unlisted, but everything else is now equal. And that, I think, augurs very, very well for the alternates business itself. And you've really seen a huge, substantial growth on private credit and real assets in the last 12 months post the tax change, outside the private equity change also. I think from a high net worth and a family office perspective, similar challenges, like on the institutional side. I think a little bit of concern on DPI, a little bit of concern on the length of the funds. But I think funds are becoming mature. And pretty much all funds post 2017-18, I think, have had a very, very sharp focus on both DPI as well as return of capital to investors in the right space and time. So overall, I think a relatively good, mature industry. And I think firms which are able to kind of, or GPs which are able to kind of look across these strategies will also end up getting opportunities. And there'll be both pluses and minuses of going vertical and horizontal. So I think domestic capital will be very, very important as we go forward over the next 5-10 years. And I think I fully agree with you. I think as I meet investors globally, I think outside of China, I think China is never going to become zero, but outside of China, I think Japan and India are going to be two big beneficiaries, apart from the US. There's all the US endowments and pensions I met. I think their favorite market or the market to allocate more capital is US itself. But I think outside these two markets might benefit in a big way. So Manish, over to you, back again.
So
any trends you see on the investment?
No, so on the, I think let's just take on and stick with your domestic capital point. From the perspective of the GP, I've always wanted our funds to be a good balance of domestic and foreign capital, right? The biggest issues for us when we started off 12 years ago was, from a macro perspective, the budget deficit, the FX, the huge issue was currency depreciation. So if you look at our returns on our first fund, the number is a certain number in dollar terms. The INR numbers are much higher. So given our deployment is all in rupees, from a duration and a matching perspective, raising in our INR money is extremely beneficial for the longer term. I've always gone on record to say, eventually I'd love to see the Kedara family of funds being 30-70, 40-60, 50-50. But I do want to mention, so far, except for Fund 1, where we had some very friendly families who helped start us off, literally even Fund 1, 95% of the money was global. And the last two funds, it's 100% global money with no INR money. And the current Fund 4 that we're in the midst of raising, so far, is a complete 100% global money. So despite knowing, so let me tell you what worries me, Karan, is the sort of money I would chase in India as a GP would be long-term capital. It'll be, my first focus would be, if I categorize this, would be insurance money. Life insurance more than general, because there is duration matching. If you look at it globally, the Manulifes of the world, the New York, these are the ones who first funded guys like KKR and Blackstone when they started, right? It was a $50 million check from one of the insurance companies. And I think the duration matching is very critical. People don't realize recent investors have not gone through the 08, 09 cycle when there was a liquidity squeeze. It was a liquidity issue. It was not a solvency issue. But many rich, ultra high net worth people could not make the capital commitments because they didn't have the liquidity. And the lack of liquidity made them insolvent, rather than the solvency issue making them illiquid. So my only worry here, and I'd want you to address this, is sometimes this product is not well understood by the retail and even the HNI segment, and the family office are getting that. So the mis-selling of the product, where I know I received a pitch, or my wife received a pitch, which was guaranteeing a 30% IRR, and and also liquidity when you want it. So I said, hey, stop investing in Kedara, please. Just invest in this product, right? If I'm getting a 30% guarantee on my IRR, and I'm getting a promise that when I need the money, I can pull it out like a money market fund, it's manna from heaven. So, maybe help me understand as a potential GP. I know the right theoretical answer is to get domestic capital and to have more INR money. But one of the reasons we're hesitating is we want to be only institutional long term. And as you know, IRIDA and others have had historically a degree of restrictions, which I believe, and I know well, at least they are slowly becoming more and more liberal. So why don't you address that issue into different types of capital?
No, I think personally, honestly, I think we've been big beneficiaries of domestic capital, and I've had a very different experience. I think domestic family offices and ultra high net worth individuals have reached a certain level of sophistication. I think everybody builds out an investment policy statement, everybody has an asset allocation, everybody defines quantum of liquidity, illiquidity. This fits into the illiquidity bucket of not allocating more than 10% into illiquids. I think generally speaking, if I was seeing the last 8-9 years, and maybe we've done $6-7 billion now, there's hardly maybe $3-4 million of people who've not paid up their drawdowns. Everybody's kind of paid over the last 7 to 8 years. So my experience has been quite different. Having said that, there'll always be 1 or 2 instances where kind of things don't go through the way you plan. Obviously, we have to kind of, as an industry, as a company, as a set of mature individuals, train people to kind of sell in the best way possible. But I think it's a constant changing thing, and I personally feel it'll keep becoming bigger and bigger. There will always be small things here and there, but we'll have to ensure that we stick to the path and ensure that the number of such incidents are minimum, and our training and education standards are the highest. Having said that, I think I fully agree with you. I think matching of duration is absolutely critical, whether it's insurance companies, pension funds, family offices. But I think the ability to act quickly. There are a lot of sectors which in India still require domestic capital. So the ability to kind of move around quickly and arrange for that is important. And I think generally speaking, sometimes decision making is also faster and ends up giving certain set of opportunities which are not generally available otherwise. And overall, for me, I think institutional capital is going to be super important. And like you're saying, it's going to be the cornerstone. But we can't ignore domestic capital for the next 10-15 years, because I just feel it's going to be a very, very large pool. And unlike the rest of the world, India is not going to become capital account non-convertible. It will remain capital account non-convertible for a long period of time. So we are unlikely to allow more than, today it's $250,000. But even if I look at NRIs, they can only convert $1 million of capital today and current income. So we are going to remain capital account non-convertible to a large extent for the longest time period, maybe through all our generations, at least this generation. Therefore, it's going to be a pool of capital which is going to continuously grow. And there is a certain pool of this 10, 15, 20%, which is definitely patient capital. I think the challenge is in the execution. I wouldn't really say the challenge is with the client. I think the challenge is with us. So challenge is on the execution, challenge is on, like you said, matching the expectations and matching the selling process. And the challenge eventually will be to kind of ensure that the right time period and the right DPIs are matched. There are a lot of benefits: local capital, ability to move fast, no depreciation between dollar and rupee. So there are a lot of positives. I think the challenge will be in the execution, which I'm sure some firms will end up doing. And I personally feel across asset classes, okay, private credit, real assets, private equity, pre-IPOs, everything, there will be a lot of domestic capital which will find its way, and hopefully the right capital.
I see where you're going. I think if you even look at the amount of penetration of this asset class domestically, it's negligible, right? So there's only way to grow. Let me shift this a little bit, but just dealing with domestic capital, the main reason we're all in our businesses is eventually you're supporting a very, very strong entrepreneur class in India, right? I've said that since, for 20 years in my previous jobs. The reason we all got back to India was it's inspirational how it's not just the global tech CEOs who are Indian, but now you have a guy from Starbucks and Chanel, which are truly Mumbaikar, Punekars, leading global firms. So there's something in the water we drink or the DNA which is worth supporting, right? And it's true if you look at the companies we support, and the level of governance have gone up. But I'm going to throw this at you as a sort of we didn't talk about this, so I'm going to speak a little longer so you get prepared for this. Is when I now speak to 7 or 8 of my friends, they are saying we're in discussions with Karan Bhagat. So the question to you is the level of domestic capital so easy that Karan Bhagat is now becoming like a BAM or which is the multi-player, the hedge funds in the US are all becoming not multi-asset, but multi-manager. So I see you fall, maybe we haven't discussed this, I don't know if we're going that way or not, but in a sense I see you seeding, not end entrepreneurs, but even you and I are entrepreneurs in a certain way, right? We took a risk, we left relatively comfort jobs to start this.
I was quickly going to ask you for your water.
So I'm just saying, since we've taken the risk, you're now supporting an entire bunch. So it's a double-edged question. One, we're encouraging, and I think many in the room, we should be encouraging to start off their own asset management firms. And that's happening in India just like we saw many textile mills in the 90s, right? So what is it that you're seeing which is making you, what do you see in a potential manager to give him or her courage to step out on his own, to leave a larger firm or to move from banking or consulting? And how are you looking at the quality of talent? Because for us as Kedara, we say we also do deals. But the thing that we think we're good at is identifying, attracting, rewarding, and retaining that talent. And we're creating a unique culture. So talk a bit about the people side and how you're doing this.
No, I fully agree with you. I think India is a land of opportunities, and it's impossible to do all deals yourself or do all funds ourselves. So actually, we've taken that approach, and if I just look back at the last 7-8 years, I think we've seeded a lot of managers in the country, right? From Fofa Capital to White Oak to maybe even Abacus when we started it off, and very recently another manager called Neolive. So we are very open to kind of backing the right set of partners. Obviously, we are able to kind of play 3 roles there. One, we have the domain expertise of the industry. Second, obviously, we can add a little bit of value in terms of contributing capital for the initial startup of the business. And third, as a large wealth manager on the other side, we can help him kind of start off with an initial amount of collections. But obviously, talent there is very, very important. But I think it's a good strategy. I think the ability to kind of deepen the market and put in some money initially to kind of start off these firms is very good. We also have the ability to put in some small amounts of checks initially before we even take it to the clients and see it for the first 6 months, first 1 year, and see the behavior and then take it to our clients. So I think overall the industry is becoming very, very deep, Manish. I think you have so many CEOs across consumer, financial services, technology, industrials now, people kind of healthcare, people wanting to move out and start funds of their own. And obviously the domain understanding is very, very large. They may need some help in terms of the investing side of things. And that's where people like us can come in and kind of get the ecosystem matched for them to kind of grow. But having said that, I think all these things have a little bit of a problem. The more you become experimental, you can become a little, so you have to be a little careful. But I think overall, industry is growing. 8 out of 10 will work out well. And I think through process, discipline, research, rigor, we need to kind of ensure that's not 8 out of 10, it's 9 out of 10 or 9.5 out of 10. So I personally feel, I think you'll see the same amount of innovation and vigor on the asset management domestic GP side as much as you'll see on the LP side. Manish, just kind of moving to a different track. Any thoughts on the sectors in India you you think this room can kind of focus on both in terms of opportunities on the ground as well as LP interest investing in India?
Yeah, happy to take that. I think the way we look at life in a very humble manner, India is a very large economy. And so if it's a 100% economy, I think the first thing that we do, and I would encourage every new wannabe PE or VC guy to do, is understand what you don't know and which space you don't want to play in, right? So actually, if I look at the way we look at life, whether it's infrastructure, real estate, competing with our friends like the Rahejas, I had no value in real estate, right? Or infra, or where Mr. Adani has his value chain, where are you going to play? So the actual relevant area for us comes down to less than 30, 40% of the economy. There, I think quite humbly over the last 15 years, there are one or two sectors that we really think we know better than most. And for us, it's financial services and consumer tech. We also spend a lot of time and focus creating and developing healthcare services, and tech, as in SaaS more recently, product as well as tech services. But I would say we still need to, we play there, we made investments, we can be much. So I think it's critical to understand, one is the sector, but equally importantly, what are the themes? So a lot of our things have been, we invested in Perfios. I don't know if it's a FIG investment or a tech investment, but we literally had the best of the firm to look at that, and every portfolio company was using that product. So it started off as a tech team, but then we so the themes are important, and there's lots of new things around AI which are really challenging some of the old business flows. So I think when one looks at it, huge opportunities, quality of entrepreneurs, but don't look at it verticals only, but look at it as what the horizontals are, what the themes are. And the last thing I would say is figure out your angle, right? For us, the difference is, I was speaking to someone who runs a global venture fund, and I'm always amazed with Sequoia and others on the VC side, having 300 or 500 portfolios, and I respect that. But we have trouble. We do only 10 investments or 11 investments per fund. So we have totally done 29 investments in our entire history as a fund. The amount of time we deploy against every company is significantly higher, and our model is that it's a very hard model with a very specific numbers of operating partners who are, sort of ex-CEOs, people like a Pramod Bhasin who help us out on our tech services deals. We match that with operating directors. So the way we work, we would not be a winner in a normal auction. We would try to preempt the auction by knowing that sector better than anyone else and trying to get a deal along with our operating partners so the company wants to work with us. So that, I think, is the way I'd approach it.
No, makes sense. I think both the points down to 5 or 6 sectors maximum: consumer, financial services, industrials. But these 5 and consumer tech, these 6 kind of make up the entire spectrum. Now, just kind of crystal ball gazing so that we can have this room excited a bit. Let me kind of ask you. Let me ask you the size of the alternates industry 3-4 years from today. Obviously, we are close to 8.5-9 lakh crores, I think, in terms of commitment. Drawn down amounts are 4.5-5 lakh crores. Manish, as an outsider, double, triple, 5 times. Obviously, unlike the public markets, we have a bit of a problem because this money is not perpetual. It doesn't have the benefit of mark to market. So we have to kind of go out and do the net flows every year. So you see a 50 lakh.
This is a classic Karan Bhagat, Uday Kotak, where they understand global flows. I have no idea if it's 500 million crores or 1 billion crores. But all I will say, slightly tongue-in-cheek, and I mean this sincerely, that number could be 2x or 4x. The question is it 2x or 4x will depend on our ability to continue doing what we're doing. It's your ability to keep seeding new. It'll be very different if there wasn't a Karan Bhagat / 360 helping new guys. And I also think, instead of being, there will be a degree of consolidation also. Every sector goes through this, right? We saw that in the so-called winter. It actually created a discipline. So even as we launch a variety of different managers, one needs to keep in mind, you need to figure out what.
I'm going to take, I think it's definitely going to be 3x from here in 5 years. That's my feel. But with that, we'll open it up for a few questions. I think we have 2.5 minutes. So maybe a couple of questions and we'll wrap it up with that. Anybody with a question? Nobody?
Vivek Soni always has one. We can cold call him, given he's giving the next lecture. Vivek, so your numbers, are your numbers, since he made, is it a true projection that Karan made, or he's completely off?
You know, it's a good hope to have, and all I can say is maybe we can hit it. All right. But I have a question now with you.
It's called a cold call, Vivek. Make sure it's to Karan and not to me.
Okay, so this question is really for both of you. In the year gone by, we saw the volume of deals dip significantly. And a large part of it is not because of shortage of capital, but more a bid-ask spread between where valuations were at for investors to be comfortable and where sellers wanted to sell, and then the IPO markets, and sorry, the capital markets haven't helped. Valuations have gone through the roof, so anybody who's looking to raise capital or sell down looks at multiples in the listed space. Now, going ahead in 24, I mean, where do you see this converging? Do you see investors moving up a bit? Because the sellers, unless you really need capital, don't seem to indicate their inclination to move down on the multiples because of the public markets pressure. So that's the question.
Fair question. Let me give you a quick remark, and I'm sure Karan has even deeper views, given he knows the macro and the numbers better. My sense of this is actually not an industry as a whole which has slowed down. If you look at it by different verticals, so I think it's the biggest slowdown is actually in the early stage, the funding winter. There is actually a shortage of capital. What people are not seeing is and I remind by seeing Srini in the room, the number of investments, if you look at the real estate or infrastructure, it's probably been the best year in terms of deployment last year. I'm sure it's the same thing in fundraising. So the focus has always been in India and startup India, VC India, early stage India. That unfortunately shrunk. But the rest of the industry, especially real estate and infra, I don't think have had a better year. I'm sure the numbers somebody will have. On the private equity side also, it's been a mixed bag. I keep saying our biggest competitor is the public markets. So for us, but that has always been the case in India, right? The good thing is the private markets have a lay period of 6 to 12 months. So in markets like this, we would be a strong seller when things cool down, as they eventually will pick up the pace of deployment. You can never time this, but that would be my quick response. It really varies by the vertical. Karan?
No, we are out of time, so I won't say much, but I think it's a flow issue. I think obviously public markets have massive flows right now. So it's kind of translating into much better price discovery. And we typically go through a rolling cycle. I think 19 to 21, the unlisted markets were much more acceptable. Now it's the listed markets. I think there'll be a time soon, like Manish said, where there'll be a little bit of parity between both. Yeah.
All right, Manish, as well as Karan, thank you for that. I request you to stay on stage for just a moment. And I would request a moment to have Rajat please come on stage to present you both with a token of our appreciation. And I think everyone will agree for being given your topic at the nth minute. You played moderator, you played panelists, and you did a wonderful job. So thank you so very much for that. Looking at 3x in the next 5 years for the alternate asset industry. And outside of China, Japan and India stand to benefit. I think those were some of the key takeaways from this insightful discussion. Thank you so very much, gentlemen, for joining us on stage. All right, let's get a move on then. And surely the last few years have been dominated by an enhanced geopolitical activities. In fact, it is estimated that the impact of these headwinds will dissipate hopefully over the next few years. But what exactly do these macro trends imply when it comes to capital allocation, when it comes to emerging markets? In particular, what does it imply for India? Well, as we focus more on capex spending, as we're planning a full throttle economic super cycle, our next panel joins in to throw light on the India experience for LPs over the years and the key aspects that emerge from the macro story for India-focused allocations. So join me in welcoming on stage our esteemed panelists for the next discussion. We have with us Dominic Goh, he's the Managing Director at Harbour West Partners, Kenneth Chin, Principal Co-Head at Responsibility Investments AG, Kunal Sood, Managing Director, Neha Grover, South Asia Regional Head Private Equity Funds, IFC, Randy Wang, Partner Private Equity Stepstone Group, and moderating this discussion is Siddharth Shah, Senior Partner at Ketan and Company. Ladies and gentlemen, a big round of applause and a very warm welcome. And I'm going to request you all to please stick to the time limit that has been given.
Okay. I think we have one of our panelists missing. Randy, if someone can go out, and I think he may be in the speakers lounge, if at all. Yeah. Anyway, I think good morning, everyone, and welcome to the inaugural panel. I know you're going to have a couple of days full of a lot of panel discussions, a lot of deliberations. So I think welcome on behalf of IVCA and all our panelists over here. I think Manish and Karan have obviously set the stage for us in many ways. And I think it was great to kind of hear their thoughts on how they've seen the capital allocations and how the industry grow. So I think just flowing right into the discussions, which is all about India allocations. I think we have an excellent a set of panelists here representing a very good cross-section of LPs that you would want to hear from. I mean, we have fund of funds, we have a DFI, we have global allocators, impact investors, all of them. So I think over the next 40 minutes, we'll try and cover as much ground as we can. I think starting off from where I think the previous fireside chat left, and I think obviously there were slightly differing views around it, but clearly what one of the press report has recently indicated in terms of global allocations, Indian allocations have generally doubled in most cases. So the numbers talked about 5%, which was typically the case maybe a couple of years back, has gone up to 15%, which obviously is a significant jump if you really look at allocations. And obviously, before we delve into why and what, but maybe it would be a quick one to run through the panel as to whether you corroborate with the fact, I mean, from your institution perspective, and if there's any number that you think historically where India stands in your allocation. I think that would be a great way to kind of kickstart the discussion. So, Dominic, maybe you want to?
Just on allocations, yeah. Morning, everyone. So, maybe just a quick 2 seconds. So, I'm over at Harbour West, which is a global private markets investor. Started out as a fund of funds. We do primaries, secondaries, co-investments. In Asia, we've had an office since '96. In India, we've done more than 2 decades of investing, so just to set the scene on who we are. Just to the question on international, I guess, how international LPs are looking at India per se on allocations. Look, you're going to get different answers from all the different types of LPs. We represent so many different pools of capital that have different strategies, that have different appetites for India, etc. So there is no one answer, I think, or one number for us. But what I can say is that the percentages or the numbers have definitely increased, I would say, over the last 4 or 5 years. So Yes, I think in the current environment where I think a lot of people will point to geopolitical tensions, I think China has been a big receiver of dollars in the region, and that has obviously changed in the current environment. I would say that these changes, however, as it relates to India, go back a little bit more than that, right? And these have been positive changes. I think when we look at having done 2 decades of India, you'll remember 2013, 2014, 2015, and those were maybe darker days for India. The economy has come through a lot of change, positive changes. There is a lot more visibility on near-term stability in terms of macro decisions, the tax base is one, et cetera, et cetera. And you put all of that together, and it is no surprise that in the current climate, you know, this is why allocations to India have been on the up, and I would like to think that this is not a one-off change, and it really reflects the improvements to the investment climate over the last couple of years.
Thanks. Yep. I think. Right.
So, hello.
Yeah.
So on my end, I'm with Responsibility Investments, and we're a global emerging markets focused impact investor. The fund of funds team, which I'm a part of, recently took over the investment management contract for SIFM, the Swiss DFI. And so we're allocating on behalf of the Swiss government to ensure that their impact mandate is satisfied. With respect to India, it's kind of a tricky story for us, because I think from a returns perspective and from a diversity of managers and strategies perspective, you know, we should be doing a lot more in India because of the impact, because of the ability for commercial returns. But that being said, because we are a DFI, we have our own strategic priorities, strategic objectives, and a global mandate that we have to focus on. And so it almost becomes a matter of Hunger Games in a way, where we're constantly having to reprioritize between different regions, different strategies, different managers in order to get the right balance for our shareholder. But if you were looking at India on a whole, and whether or not I was, as one of the heads for Asia, if I was bullish on India over other countries in my region, I would definitely say yes. And if it was up to me, I would be allocating much more.
Kunal.
Hi. My name's, can you hear me? My name is Kunal Sood. I'm with Pantheon. Pantheon, similar to Harbour West in many ways, is also a global private markets manager. We manage roughly about 65 billion in discretionary assets under management across 4 different asset classes: private equity, infrastructure, real estate, and private debt. In the Asian context, we've been quite active on the private equity, which includes venture capital for us as well. We came to Asia very early on in our journey, so we've been in Asia 35 years out of the 40-year history of the firm. And so India has been a core part from the very early days. So we've been investing in India late 90s, early 2000s. I say in hindsight a little bit too early, but it's been a long sort of couple of decades of experience in the market. And again, the way we invest is also through funds, through secondaries, and direct co-invest. I look at Asia Pacific for the firm, sit on our Asia Investment Committee as well. And so we do get a relative view of the investment opportunities. And I have to say, in the markets, how the markets have stacked up in the last few years, the India opportunities has really started to shine. India's been a core market for us, but I think a couple of issues people have had with it, things like currency risk, unstable macro, political uncertainty, a lot of those key things that foreign investors tend to focus a lot on have been taken off the table. I'm not saying foreign exchange risk has gone away, but at least the currency more recently has been more stable. Oil prices have been a little bit more helpful, and India's managed to play that well as well. So all of those things set up a pretty good stage on for things to take off from here. But I think in many ways that's just the starting point, right? What foreign investors are looking at when they look at India is in 2 different viewpoints. You could look at it from a global relative viewpoint, but someone like us who's global, but we also manage Asia-dedicated pools of capital. And I think we started that off very early in our journey, just to not have these swings in portfolio construction, because one market very far away does very well, like the US has. And so how do you play the rest of Asia? We have Asia-dedicated pools of capital that focus on the best investment opportunities in Asia. I think, and in that, countries like India have started to really show their potential. So Rajat was talking about the deepening of the membership base and the assets under management for the IVCA. I think that's reflective of the opportunity set. That's also reflective of how enough people have started to do well across spectrums, from venture capital to growth equity, buyouts, and other stages as well. So, excited about the opportunity ahead and looking forward to more opportunities to do investments here.
Great.
Hi everyone. I'm Neha Grover with IFC. I lead the funds business for South Asia. Thanks to IVCA team for having me here, and really nice to see a lot of familiar faces in the audience. Thank you. I think from IFC, we invest in private markets across private investments across emerging markets. South Asia, primarily India, led by India, has been a large focus area for us. We've been investing in India as IFC for the last few decades, at least 5 decades. We've done a lot of direct investments. We were the first shareholders in companies like SDFC and in Bharti Airtel. So long history to go back to. Private equity, we've been investing in India for the last 2 decades at least, maybe 3. In the late 90s, that's when we started. I think we've seen the whole industry evolve over the last 3 decades significantly. And we typically deploy about $3 billion in India on average. This is including direct, indirect, everything, lending and equity. On the private equity side, we've invested and mobilized capital of about $600 million on average for the last couple of years. We've got a large portfolio. We've got about 50 funds, co-investments in South Asia, primarily in India. So a large sort of pool of managers. A lot of them are very active relationships for us. I think the way we've seen the market evolve is the private equity industry has deepened, for sure. We've also seen LP capital, both domestic and international, play a very important role in the last few years. IFC as a DFI has played a counter-cyclical role in the last 3 to 4 years, where a lot of interest has been from the domestic side, both on the VC and PE side in the industry. On the private equity side, there's been more interest in the domestic side. International capital for the last 3-4 years, just after COVID, was a little bit on the wane, but we are seeing that increase significantly, and we're seeing that with larger fund sizes, larger co-investment opportunities, direct opportunities. So definitely, India is a bright spot in today's emerging markets, and we're seeing that reflect in larger allocations.
Great. Good morning, everyone. Very delighted to be here this morning. So my name is Randy. I'm a partner on StepStone's private equity team. I help oversee all of StepStone's capital allocations across Asia Pacific, which includes India, obviously, and also across all 4 asset classes: private equity, real estate, infrastructure, and private debt. I guess just to round out this question, maybe a few observations from my side or from StepStone's side. I think historically I think our posture towards India has been one of cautious optimism, probably similar to many of you in the room. But we are becoming increasingly bullish on the market for 2 key reasons. I think first is, given the breadth of our advisory model, we have a lot of unique and interesting perspectives from the clients that we serve. And what we're seeing over the past couple of years, especially in light of all of the uncertainties surrounding China, is a very pronounced rotation of capital away from China into other emerging markets around the world. And there's no bigger emerging market than what is undoubtedly the 2nd largest emerging economy in India. So I think that capital rotation has definitely benefited the entire ecosystem, the private markets ecosystem. I would make is, historically, the points that Kunal highlighted is distributions and liquidity. So if into 2023, there's been about 130 billion of private equity and venture capital deployment in India. if you go to the prior 7-year period from 2014 to 2020, it was also 30 billion. So it's pretty clear that deployment pace has really increased significantly. That could be, I think that could be seen as alarming, but what gives us comfort is, in the prior 3-year period, I think the total number of distributions was around 70 billion across private equity and venture capital, which is the same as the prior 7-year period from 2014 to 2020. So I think this is definitely a trend that's here to stay as the business and capital markets environment continues to mature, which is one of the primary reasons that we hold an increasingly bullish view on India private equity.
Thank you everyone for sharing the initial perspective. I think just staying on with you, Randy, I think one of the questions which I'm sure a lot of us in the audience here would also have, what is really India solving for in your global portfolio? I mean, is it sheer diversification? Is it sheer more opportunistic with the China situation? Or is it really the returns and the performance of the market? I mean, which is it that you are trying to solve for when you make allocations to India?
Yeah, so Stepstone itself doesn't have a global allocation policy. You know, I would like to consider ourselves more bottoms-up investors. We find the opportunity in the geography and we go after those opportunities. But I would say overall, I think it's a little bit of both that we're solving for, both diversification and returns. Historically, it was more diversification, right? Just given the sheer size. And maybe taking a step back here, I think it's important to emphasize just the size of the Asia-Pacific corridor, right? It represents 40% of global GDP, 60% of the global population. It's expected to contribute 70% of the incremental middle class by 2030. And obviously, China and India are the biggest movers here. So, notwithstanding all of the China, uncertainties, I think India continues to play a major part in the rise of the global middle class, global GDP growth, et cetera. So that's kind of on the diversification side. I don't think, Asia Pacific cannot be overlooked when constructing a global private equity portfolio. I think we're in a new paradigm right now where buying low and selling high just doesn't work anymore. You really have to be able to generate alpha. Past couple of years, we've seen a number of good case studies of Indian managers being able to generate alpha through whether it's operational value add or M&A or roll-ups or platforms. And so we're really seeing the fruits of that labor come to fruition, especially over the past few years. And another trend that I believe is here to stay.
Well, thanks. I think maybe Dominic, coming to you, obviously, I mean, again, a similar question from your perspective as to, would it be fair to say that India as an asset class, as I think Randy mentioned, seems to have evolved from merely being a jurisdiction for diversification to something which is really making a case for itself in terms of promising returns for the LPs, and I think we've seen the performance of the market there. But obviously, having been invested in India and being investing for a while, what are the kind of, how have you seen the landscape kind of evolve, and with the GPs, how they have matured, how the strategies have been fine-tuned from your perspective as an LP when you look at India? Any thoughts on that?
It's a long one. It's a walk down memory lane. Okay, so a couple of things, right? I guess to answer the first part of your question, which is diversification, is it really at any cost, I think is what you're saying. I think the answer is no. We're not diversifying for the sake of, I guess nobody is doing that. And I think what has, I think, become very apparent or more apparent over the last, I would say, a couple of years, as we're now seeing, at least within Asia-Pacific portfolios, a rebalancing of exposures, relative exposures amongst the different markets, is where I think investors are questioning the cost or the cost of diversification. And this is not just within Asia, but globally as well. I think you see that US returns are so strong, read this. In addition to just what we call primary investing or, getting capital for commitments into brand new funds, what we've seen in India also then is the development of more of what we call active strategies, so the secondaries as well as co-investments or ad hoc, project type of fundraisers. And I think that just points for the PE ecosystem here.
Thanks, Dominic. And I think one of the points that you mentioned, and I really think Indian industry, private equity industry, or I would say alternative space, is probably at the cusp where a lot of the fund managers will have to talk about institutionalization. And I think from what we hear from a lot of our clients, probably a lot of them are moving to a stage where a need for institutionalization of the setup will also be further driven by how LPs would look at allocating capital from a long-term perspective. Coming to you, Neha, I think, again, as a DFI, obviously, your priorities to allocate capital to a jurisdiction or sectors, a lot of it is also driven by developmental agenda. And obviously, as an economy continues to grow, and I think India has obviously been growing at a pretty rapid pace from economic growth generally, and also the space within the alternative space. How do you think that's kind of really evolving or changing your strategy as a DFI from an allocation perspective? I mean, it would be great to kind of see whether more the development, more the need to look beyond. I think that would be something.
So I think, we all know India is a complex country. And recently we were talking to a couple of managers and we read some analysis about India being partly London, partly UK, partly Brazil and Africa, right? And 700 to 800 million people in India are still in the Africa zone. The top 50, 60 million in London, then you've got the UK and you've got the Brazil, and then you've got Africa. Essentially, even if the top 300, 350 million people have developed, you're like the London or the UK of the world, the vast majority of the country is still in the African zone where there's a lot of development needed. So let me start by saying that. So as a DFI, we don't look at India as one brush. Investing 25 years ago, we look at a developmental role in two ways. And I'll talk about private equity first and then overall. One is the market creation. Second is the project outcomes. Market creation for private industry, private equity, 25 years ago was very critical because there were very few managers, there was very little capital. Today, if you look at it, the ecosystem has developed. There's a lot of good, solid fund managers. Many of you are sitting here to sort of choose from across VC, across PE, the entire sort of alternative space. So I think our role in private equity today is less market creation in India, more project outcomes. And you'll see that our role sort of in terms of how we allocate capital, how we choose managers, what we're doing with them. We're doing much more co-investments. Every year we're doing about 2 to 3 co-investments, if not more. We're doubling down on existing managers. We're choosing newer managers in newer segments, newer strategies. And that's where our role is evolving. If I look at India overall, so therefore development impact is still there. It's still at the core. But there's a big commercial lens as well that we apply. And that's true for all sectors, all other sectors, real sectors, financial institutions, infra. Each of those spaces, the need is different. And therefore, we look at it for that particular segment, that particular sector, that particular subsector. What is the need? What is IFC's role? And how do we sort of integrate our allocations?
Okay, interesting. I think coming to you, Kunal, I think obviously from a Indian market perspective, obviously as you mentioned, you've obviously been involved with the market for a while as a group. I mean, as a global allocator, what are the challenges? I mean, we talked about opportunities and then what India presents, but what would be important to hear? I mean, what are the key challenges that you see which may have kind of kept you away from allocating more?
I mean, I think, look, in many ways, the challenge to private equity on capital flows into India today is not really China, it's actually the US, because those markets have continued to do so well. Even the markets like Europe have continued to do so well, even on a currency-adjusted basis. You all hear about how in demand some of the Japanese market private equity funds are today, and that's despite a 50% drop in currency. So I think, look, overall, when allocators look at capital, and also depends on what seat they're looking at from. For a US fund, the safest, their own currency return and a strong return, the experience that they've had is in their home market. So why bother? Why bother go and take all these risks in a market they need to understand first, spend the time, maybe go through cycles? So that's one. I think what that then leads to is, while we've all been, I guess, generally been quite optimistic about the potential for Indian PE, I think it's also important to realize that in general, it's a hard fundraising environment globally, where interest rates have gone and all the macro challenges and the rest of the world is facing. It's fair to say that generally the industry has had a weaker last year in terms of fundraising, and the outlook is also hard. And China, going through its own sort of cycle right now, has not helped the Asian private equity sort of flows as well, more broadly. And obviously, India's benefited, but on the margins, I have to say. And what that really then leads to is, it's really some of the well-known larger firms and funds that have managed to raise large amounts of capital, they have it much easier. And so they're the beneficiary of all the topics that we've been talking about, saying, well, India's in favor, India's doing well. There is a long list and much deeper ecosystem that's come up today that doesn't see that flow from foreign capital. And I think while there is a very important role domestic capital is and has and should be playing in that as well, and it's not surprising at all these days to have managers have a first close with domestic capital, then come out to raise for foreign capital, and I think that sets at least a minimum base for them as well, and that's hopefully a good strategy. I think it's important to recognize that, unless you're able to differentiate your strategy and saying, why do I have a right to win in this segment that I'm operating? There may be 10 funds in the same segment. Why?
Many a times we tend to gloat in our own economic success, whether it is policy making, whether it is about GPs really seeing how they can go out and raise capital. And I think you're right. One needs to see the perspective that we are really not competing only with the other emerging markets or capitalizing on where China's kind of losing out. We are competing with more developed markets which have probably lower risk with probably better returns as well, or consistent returns.
And I think a good proxy that I said is also, if you look at, and these can be famous last words, but I'll still say it, if you look at where public markets stand today, and you look at US dollar returns of the Nifty compared to all the major global indices, including the US, on a US dollar basis, the Indian indices have actually done very well, comparative and comparable to what the US markets have done. So there is a set of investors who actually made, over long periods of time, very good money in the Indian markets. And if anything, look, we'll have a debate about public market valuations and other things, but if you look at returns, that's a good benchmark to have in saying, look, if you've done that in the public markets, maybe you also need to sort of set a similar benchmark with the best globally for the private markets as well.
Yeah.
Just want to add one thing. See, the returns are also driven by growth, right? If you look at growth globally across emerging markets, how many markets are growing consistently, have the sort of macro structural drivers that we have in India when you compare it to either the emerging markets or some of the developed markets as well. And I think that is what is important, that, okay, hey, what's driving these returns? Are these returns sustainable, replicable? And I think the answer is yes. And that's where I think global LPs and everybody's looking at India and saying, hey guys, it's not just something that has happened in the last couple of years, a few years, but we can see that this will sustain. There may be blips, there may be sort of macro shocks, but we're going to see sustained returns from this market, at least in the medium term.
Sure. Just quickly moving on, I'm mindful of time. Kenneth, I think you did alluded to the fact that impact investing in India, and obviously, I mean, amongst all other capital which comes with less strings attached versus impact investing, which has an additional objective to kind of fulfill. It's always a challenge, and I think when a market is in a high growth phase, where a lot of capital, commercial capital is chasing deals, how do you see impact investing evolving, and then how do you see that landscape really evolve? Have you seen enough opportunities, or do you see more opportunities coming out from India for you?
So maybe it's a cynic in me that I don't believe that any asset class that you invest in has no strings attached. I mean, I think regardless of what you're looking at or how you're looking at it, what lens you're looking at over it, there's always a catch to it or something. From my view, I mean, I think when I think about impact investing, I always put a commercial lens over it. So it has to make sense at the ground floor level. There has to be a reason why you're doing it, not just to help rural farmers or help create jobs, but there has to be a commercial angle to it. And I think that that in itself is where the opportunity lies because I think if you go out to the tier 2, tier 3 cities, there's massive underserved market. So I would not look at impact from a philanthropic lens or philanthropic perspective, or if I did, I'd have to have a junior tranche or something involved in place for me to really go for something like that. But I think all in all, the opportunity set in India is so large that you can have different strategies focusing on, say, commercial returns or just purely impact strategies. But from my perspective, I would like the impact to come with a return on my investment.
Yeah, and any thoughts on like strategies that you see having played out well for you, or where you think opportunities lie?
Right. So, I mean, I think the biggest one is climate, right? Climate is a major objective that amongst DFIs as well as other institutional investors, it's something that they've allocated their portfolio. I would caution that and say so I've been covering India for the last 15 years. I lived up the street on off of Lincoln Road, and so I know how savvy Indian GPs are here, and what I don't want to see is, when I flip through a pitch deck, the inclusion of a hot sector all of a sudden because there is an influx of capital going to it. So, I mean, it has to make sense. There has to be the right management team in place. They have the right skill sets and the right track record in order to deliver.
Thanks for that. Maybe I think just moving on the topic of exits, and I think obviously over the years, it's always been a topic for discussion from an LP perspective, whether the market, India as an asset class, has given respectable exits and returns or liquidity to monetize some of these investments. I think maybe interesting to hear, and I think maybe the noise around that seems to have quietened a bit, because obviously the way the markets have really performed and the way the capital market has really sustained some of these exits. Any thoughts? Maybe we can go around quickly around each of you and maybe get a quick thought on that. Dominic, do you want to kind of kickstart with that?
Yeah, so I think on capital markets, well, on exits, let's say, in general, I think certainly over the last 4, 5, maybe even 6 years in India, we've seen definitely a marked increase. I think Randy has shared some statistics on just exits in the Indian private equity market. And I think that is obviously, I think, bode very well for the asset class. We've seen through secondaries a lot more exits coming through. I think if I were to summarize, I'd say there has definitely been more of an ability for exits to happen in the Indian private equity market. That is, and those exits are not just capital markets focused. So not just IPOs, we see M&A, we see secondaries, and it is also what we've been seeing is it's also been happening across the spectrum of not just, again, in fact, less so on the venture side, but more into growth and even on the sort of larger buyouts where there has been, I say, significant liquidity that has been produced. And this is great for the asset class. It's great for a strategy like secondaries, which actually benefits from better exit markets. It may sound a little strange, But the reality is that ourselves as buyers in the secondary markets ourselves, we need an exit route at the end of 4 to 6 years, right? And if these markets continue to stay open, you know, it used to be a phrase we talked about, exit windows opening and closing. I think nobody uses that phrase anymore these days, right? So, you know, again, it's that continued persistence of an ability to take exits, and then a willingness of the GPs to make those exits, I think, which is what's going to then propel the further growth of or faith in the PE market here in India.
Yeah, maybe I'm sorry, but given the time constraint, maybe I don't know if anyone else has any quick thought to share on exits, but yeah, well, no, maybe.
Maybe very quickly. I think one of the benefits of this environment that we are in is there's a lot of strategic and global corporate interest starts to look at India. They'll start to open offices here, start to set up a manufacturing base and other things here. And that opens the M&A route, that opens the strategic exit route as well. And I think you would do well to take advantage of that interest into India to use that route. And again, this can change. So it seems to be open. The thing is, I think, to people to think creatively. Globally, things like single asset secondaries and GP-leds have become a very dominant asset class. There's over $110 billion of secondary annual investment activity globally. Asia, very small part of that. India is even smaller part. You're starting to see some...
I think DPI is king. And so I would just encourage all the GPs, you know, today in your last fund, but the consistency of delivering, you know, high quality DPI across your funds.
Thank you. I think just before we wrap up, I think since we have the policymakers as well in the audience, and I think you, as LPs, you are one of the important stakeholders in the industry here. Any quick kind of thoughts around from a regulatory, tax, or other perspective that forms part of your wish list that India should do, or the policymakers can make a note of? Maybe, Randy, I may start from your end.
Yeah. I wouldn't pretend to be an expert on India regulation or tax. I think that's really the nature or the beauty of the Stepstone business is just given the network of our GP relationships, we rely very heavily on our partners, our GPs, to be able to navigate the regulatory and tax environment, whether it's India or China or other emerging economies. And so that's kind of one checkbox that we evaluate when we assess a GP is, you know, how local are they? Do they have boots on the ground? Have they invested and been successful in economic and regulatory cycles? So I would say there we really rely heavily on our GPs.
Yeah.
Very quickly, I think GIFT City has been a welcome move. We're seeing a lot more GPs, a lot more LPs moving towards GIFT City. Making it easier to do co-investments, to do secondaries, transfers, that's one. Making it easier for LPs to decide what they want to do with their funds, with the GP, rather than trying to regulate and over-regulate is the second piece that I would say. Keeping it generic because...
Yeah, no, I know, I think, but very important again.
Well, I appreciate the regulator's dilemma. They need to cater for the 1% bad apple, and hence 99% also get affected. So it's not an easy job. But I think, look, from a foreign investor's perspective, stable, predictable regimes that are broadly in line with what you'd expect to see in other key markets is what you generally want and expect.
Very, very important.
I think that the amount of transparency that the regulator has brought into the industry is actually a very positive thing. I mean, with the performance benchmarks, that makes my life a little bit easier, just making sure that, you know, the validation and the due diligence still has to be done. But apart from that, you know, I think I would just caution on making sure that you don't overburden the GPs with, you know, additional layers of expenses or reporting or requirements like that, because it might have the opposite effect. But for now, I think it's a positive move for bringing in domestic sources of capital.
Yep. Maybe, I think, Dominic, anything else? Okay. I think we are already out of time, and once again, I think I would say thank you, IVCA, for having such a fantastic panelist for me to moderate. Thank you, each and every one of you, I think, for contributing and I know we don't have time for any questions from the audience, I guess, so because we are running terribly behind schedule, but I think all of us may be around for a bit, so you can obviously catch us outside. Thank you very much, and have a great rest of the day. Thank you.
Thank you, Mr. Shah, for moderating that discussion ever so eloquently. Ladies and gentlemen, a round of applause, and can we please have on stage Mr. Karthik Reddy to present the certificates and the token of appreciation to all of our panelists. In fact, it's been very encouraging to hear from them talking about how there is now a new paradigm to be able to put alpha first, and that is an opportunity to generate alpha, which we're witnessing in India. Thank you, Karthik, and thank you to all of our panelists. Please request you all to take your seats. Next up, well, it's time for a report launch, and this time around, IVCA and EY, it's the India Trend Book 2024. And join me in welcoming on stage Vivek Soni, partner and private equity leader at EY India, to walk us through this report launch. Vivek.
Great, good morning everyone. I'm Vivek, and I'm here to sort of launch the EY IVCA Private Equity India Trend Book. We've been doing this report every year for the last 7 years, and it's become the default voice of the industry in terms of the data. The whole purpose of doing this report is that it's more a weakness in certain sectors, like the startup sector. From a deal size point of view, we had 12% lesser large deals than we had in the previous year, and that's made a difference. The biggest weakness has been in the startup space, where the investments dropped from almost $18.5 billion to about $8 billion. As a result of this, the entire pure play private equity space saw a $10 billion decline from $40 billion to 30. From a fundraising point of view, it was a pretty good year. It was the second best year ever. But in terms of values of funds raised. But when you look at the number of funds that saw closure, this was the highest ever, right? And if you compare it to 2021, it's a significant jump, more than a double of that. The real stars were the real assets class, where you had infrastructure sector and the real estate sector clocking in close to $12 billion and $8 billion respectively, marking their all-time highs. We expect that to continue in the foreseeable future as the government as well as the private sector cranks up capex spending, and a lot of the InvITs and the REITs really allow them to rotate capital. From the pure play asset class, private equity asset class point of view, healthcare was the standout, where the amount of dollars that went into healthcare almost doubled. And then, the traditional favorites wherein financial services and technology saw almost 39–40% decline year on year in terms of dollars raised. The real star actually is the exit story, and within that, the role that the public markets have placed in terms of delivering exits for private equity investors. At an overall level, it was the second best year with almost $25 billion of exits, almost a 36% growth from 2022. 2021 was the highest ever, but that was another era when the cost of capital was very different from where it is now, and also the business risk premium was very different from where it is now. The capital markets continue to sort of play a leading role in helping private equity funds rotate capital via the IPOs as well. This year we had in 23, the second highest number of IPOs. And I think in the foreseeable future, as the market continues to stay buoyant, we'll see a lot more of action happening on that side. From an exits class point of view, this was the first time that open markets exits really took the highest position, with almost 94% increase from the previous year. There's some data here. A lot of this data is in the report, which is going to be tabled. We have an EY kiosk outside. There's a QR code. For those who prefer the soft versions, you can download it as a PDF on your phone or your digital device. As you can see, from the highs of 21, we have progressively declined, but this decline is largely because of one asset class, which is the startup class. All other things have continued to remain the same or have grown significantly, as you can see in real estate and infrastructure. A bit more detail here, where you see the pure play PE falling down from 30 to 40. Now, all of this is because of startups. If you keep that aside, pure play PE in other segments has more or less flatlined from last year to this year, but the number of deals have fallen significantly. So adjusting for that, essentially the main insight is the deals, while the deals have reduced in count, the deal sizes have continued to go up across all segments, whether it is infrastructure, real estate, or pure play PE. I'm sorry I'm rushing this up. There's not too much time. I've been told to release whatever time I can get here. Okay, so from a deal segment point of view, there is a big drop both in number of deals which are under 100 million and greater than 100 million. From a sectoral point of view, all the action really is in the top 3 sectors. As I said, infrastructure, real estate, and financial services accounted for the maximum amount of value. But if you look at number of deals, then the segmentation is very different. This is again a small slide which talks about the growth of the pipe segment, which is the investments in private investments in public enterprises. And India that way is a gold mine for using the private equity approach to public markets, because there are so many listed players in India who are not covered, right? And the inherent strengths of the economy, the inherent strengths of the sectors that they are in provides a lot of opportunity for private equity funds to identify targets, put in the money, and then you obviously have the benefit of liquidity. From an exits point of view, again, we've covered this, so I'll quickly go through this. The main thing is that the number of exits have gone up in value as well as in volume, and the standout constituent has been the open market. Since 2021 and before, a lot of private equity investors have put in money in publicly listed enterprises. The buoyant capital markets gave a fantastic window of opportunity for them to exit. This year, you see, compared to 2022, open market exits have gone up almost double, right? From 6.6 billion to over $12.8 billion. In terms of sectoral segmentation, the volume of the exits has largely been in financial services and e-commerce. They were the top 2 sectors, and even from a value point of view. And this is really no surprise because of the quantum of money and the transactions that happen in these sectors. The last bit is obviously on fundraising. It's been a very good year for fundraising by India-focused funds. In terms of value, may not be as much as what it was in the previous year, but in terms of number of funds raised, it's been the highest ever. And as a number of speakers spoke about how India is becoming patient by many Asian funds and regional funds, we hope to see Indian GPs also continue to take advantage of the opportunity that is there. And the next year, 2024, looks to be very promising, as a number of our leading Indian GPs are on the road trying to close their next fund rounds. From an outlook point of view, there are a few things we wanted to say. Look, the startup sector is obviously in a trough. We think the sector is very resilient. They will come out of it. There is a kind of a funding winter in the early stage segments. In the later stage segments of startup, it's largely a bid-ask spread issue because of which deals are not getting done. And we think things will begin to converge sooner than later, right? And then from an exits point of view, we think the resurgence of private equity-backed IPOs is going to continue this year. We saw fintech account for a lot of investment in 2021 and 22. There has already been a scale back. We think that will continue in 2024 as well. And then there are these new sectors which are emerging because of the energy transition, talking about clean technology, it's talking about sustainable agriculture. This is all being driven by a huge pressure for environmental consciousness and also regulatory imperatives. And there's money to be made in these segments. We believe 2024, 2025, we'll see a lot of capital being deployed by private equity, venture capital ecosystem into these sectors. So from a yield generating assets point of view, we expect the momentum to continue. It allows for capital rotation, and then the developers can rotate that capital into greenfield deployment, which is really what the country needs. We are looking at the comeback of the private sector capex cycle. All this is going to contribute to all of that. So this is about what I had to say. I'm sorry I couldn't compress it sooner. Thank you so much. I hope you enjoy the report. Cheers.
Yes, thank you so very much. We request someone to come on stage to present the certificate. Aha, Rajat, right here. Ladies and gentlemen, a round of applause. That was none other than Mr. Vivek Soni talking about the IVCA EY PVVC agenda, the latest report. All right, let's get a move on then. And moving right along, we have our next panel discussion of the day. Now, as we're seeing the investment landscape maturing, it's critical to understand how to unlock growth, how to create value, and how to hunt for emerging sectors. While navigating these unique dynamics of PE investments and the evolving Indian market, our next panel is going to delve into the strategic approaches, the challenges, as well as the success stories for investors, serving as a compass for optimizing growth. Ladies and gentlemen, put your hands together for none other than Ashish Kotecha, partner at Bain Capital. We also have with us Mr. Gopal Jain, managing partner and co-founder at Gaja Capital. Prakul Koshava, who is the Managing Director, Private Equity Asia at CPP Investments. Rohan Suri, Managing Director, KKR. Shweta Jalan, Managing Partner at India Head at Advent International. Sudhir Variyar, who is the Managing Director and Deputy CEO at Multiples Asset Management. And moderating this discussion is Sneha Shah, Senior Assistant Editor at Mint. Yes, please join us on stage.
Good morning, everyone, and thank you so much, guys, for making time. And I couldn't have asked for a better panel than this. Such diverse speakers, from growth stage to late stage to LP turned investors. So, let's have a huge round of applause for all the speakers here, guys. In India, late stage PE investing, we can't slice it in one way. There are a lot of layers. I've been covering this for 17 years, and I've really seen the market grow. We have seen 2 cycles by now. So the 2010 cycle and now what we're seeing. So it's pretty interesting how, more than 75 billion of investments have gone into growth as well as late stage investing in the last 10 years. And there is more to be invested. So, let us first start, from the deal pipeline. Where are the deals? This is a question we often ask investors in our private conversations. Where is the deal flow coming from? Especially for growth and late stage private equity investors, because, the funnel gets narrower by the time deals reach them. So first up, Rohan, KKR has been investing across the spectrum. You have the ability to write a 50 million check to write up to $1 billion. So where is the deal flow coming for KKR? What are the kind of deals? What are the sectors that you're looking at?
So I think, I mean, just at the start, the market today, there's it's a very favorable market that we're all investing in. I think there is, there's very strong drivers, which people have already spoken about. From a KKR standpoint, there are a couple of themes that we focus on, and like you said, we have the ability to invest in these themes, across a range of check sizes. So I think the first theme that we really focus on, and we're focused on in India, is this consumption upgradation theme. So just given the favorable demographic that India is in the middle of and is likely to continue to be in that phase for quite a few years to come, you're seeing a range of consumption upgrades across sectors, from healthcare, financial services, consumer. So I think that's a big theme we all focused on. There's also this theme on, just globally competitive export industries. So in tech services, pharma, increasingly in manufacturing, Indian companies are already global champions, and they have the potential to further consolidate their position as global leaders. So I think that's another theme that we are focused on, and we are seeing a lot of opportunities across these sectors that I mentioned. And I think the third theme, which kind of cuts across sectors, is this whole phenomenon of generational transition that you're seeing in India. Private equity, I think, as an asset class in India has become a lot more mature. Entrepreneurs and founders now understand the type of capital private equity represents. And I think PE capital can be a great ally for families which are going through or thinking through succession, thinking through generational transition. If they want to bring in a partner who is also long-term oriented, who can help professionalize the business, bring in talent, be aligned in terms of outcomes, I think PE as an asset class is very well positioned to play that role. And we're seeing a lot of opportunities across sectors as founders are looking to think through succession issues and bring in a partner who can sit on the same side of the table and bring in global best practices to take the business to the next level.
Right, that is interesting. Gopal, if you can jump in here and talk about the kind of deal flow that you're seeing, because clearly for a fund like yours, which plays into this very sweet spot of growth investing, a lot of your funnel, I am sure, is tech investments, while a lot of late stage investors can afford to look at non-tech investments. For you, a large part is tech investments, and how is the deal flow from that sector?
Yeah, so we are investing at, let's say, from a revenue perspective, 10 million to 100 million. Look at companies that want to be 100 million and are at the $10 million stage. And this, the supply side of deals has completely changed over the last 10 years. And I was just saying this, that until 10 years ago, the typical entrepreneur we would meet would be bootstrapped. And today, the typical entrepreneur we meet has already spent time in the venture capital ecosystem. There are about 11 to 12,000 startups that we have identified. We have a coverage funnel of about 1,000 companies. And from these 1,000 companies, we are hoping to make our next 10 investments. 80 to 90% of the companies that we invest in have a prior investor in them. So there are a lot of companies to look at, and theoretically there's an opportunity to cherry pick, but it's easier said than done. Yeah.
Right. Also, the critic that these tech investments often invite is the kind of valuations, right? And Sudhir, your firm has been investing in traditional investments, and where you've been very mindful of the kind of companies that you pick. If you can talk about the deal flow at your end, where backstage you were telling me there are a lot of these non-tech deals that you're looking at currently.
Yeah, I think the fact that the market is quite deep and wide is what makes India really attractive for a country-focused fund like us. You can really think of investing not as a, India is not a thematic for a short period of time. It's really now you think about what is the right portfolio that you create for India investment. And there is, each of the sector offers that opportunity, whether it is consumer, healthcare, now even manufacturing coming back, tech and so on. And I would say that apart from these, the transition that is happening for someone like us who does both growth and control, the ownership transition that is happening, all of that now really allows you to think of creating a portfolio of investment rather than say that in this kind of vintage I'm seeing more tech deals and it will be largely tech, and we kind of, I think we can follow that discipline a lot more, and that's the attractiveness that we see in India across, I think what Rohan said, each of those themes are extremely relevant, as all of us know in this audience, whether it is consumer, the pharma side, whether it is financial services. I think each of them give us a significant investment opportunity to invest into the country, and really meaningful entrepreneurs. I think what's also matured in the country is that the entire ecosystem from the VC and the early stage also is throwing up deals. So many of our transactions, when you start looking even at the 100 million, I'm sure Shweta and some of them will be looking at even larger, but even at the $100 million deal, you see an ability to do a mix of secondary and primary, which takes you to that. And that's because the entire ecosystem has been supporting entrepreneurs all the way up. And that pipeline is what is kind of growing. And I would kind of, the huge desire for all of us is that pipeline should be even larger, because that's what keeps, as you were asking, valuations under check, etc. If the supply of good quality assets increases, because the demand for money coming in is increasing so much that what is required is to have a good supply of investments coming up. And that's really beginning to happen. You see the number of funds which are set up catering to a level that is, say, $100 million, $200 million fund, etc., is increasing at a really fast clip. You saw in the last presentation that was made as well, the fundraising momentum. So I think overall that the ecosystem is maturing and we all see reasonable deal flows.
Right, and clearly the ecosystem has matured in the way opportunities are presenting. And Shweta, I would want you to bring in here, you know, where Advent sits, you know, you do these large buyouts, and also you've been doing platform deals, you know, so there's this always dilemma that the founder has of build versus buy. And for Advent, you've been experimenting with platform deals. So if you can briefly talk about, you know, the late stage buyouts, as well as, you know, the reason why Advent chose to do platform deals.
So I mean, two parts to your question. So I'll talk about late stage buyouts, and I think that's a market that has definitely evolved meaningfully in the last 10 years, but I would say even more so in the last 5 to 7 years. And there are a few themes which have played into it, right? One big one is this whole founder succession. And you know, you see it in actually various ways. It's not only that I don't have a successor, it could be I have a successor who's not interested in doing the business. Sometimes we found sort of even the founders being quite realistic about whether my successor can genuinely take the business to the next level. And if not, am I sort of better off selling the business and moving on in life? Or there are multiple people in the family involved, so rather than result in a future conflict, separate it out and let people, you know, take the money and decide what they want to do in life. So that's been one big reason why we've seen a lot of, you know, buyouts coming up over the last 5, 7 years. Second one is, of course, you know, I wouldn't say the companies are not distressed, but the founders get distressed because of investments in other sectors, right? Real estate, power, so whether it was Crompton that came out of it, DFM, where the founder had invested behind some real estate assets and needed monetization, Eureka Forbes, where the you know, family required some capital for the immediate debt repayment requirements, right? So a lot of the buyouts came out from one, succession issues, and two, sort of distress. What we didn't see, what we thought we will see, is these large business houses divesting some of their non-core assets. So that theme is one that hasn't still played out too much in India. But I think that, I mean, you were seeing a very good evolution of the late stage buyout market from where we started at ICICI Venture, you know, 17, 18 years back and did the first buyout, right? I think there's enough to keep all of us more than busy, I would say, even though competition has been continuously increasing in the private equity market. Platform, I guess, is just another way of playing the buyout market. So I mean, whether it is the API platform we've created or packaging to some extent where we've done a lot of, buy and build as well. In many sectors, there is a very, large number of companies and a consolidation opportunity, but there's no single large asset, right? And that's where, we've picked some of those themes, like the whole API theme that we picked now almost 3 years back, where China plus one was an interesting one, overarching theme we wanted to play. Within that, we saw APIs in a very, very interesting place. And we bought the first asset, knowing that we can really build off that. And from then on, we bought 2 more assets in that platform. And as we have announced even in the public markets, eventually the idea is to merge that with a listed company that we recently bought, which is Suvain Pharma, to create, I would say, one of the largest CDMO plus API players in the country, right? And that's just because you have a very large pool of assets available, but nothing is of individual scale. So can we become the consolidators and build a scale company in the API and the CDMO space? That was the idea there, or even in the innerwear space or in the packaging space, which we used more of the build strategy.
Right, that's interesting. Ashish, Bain has been,
So we have global industry verticals, and that allows us to look at opportunities in India where we may not have invested before, but tap into our learnings at a global level to then shape an investment thesis here, right? So for us, we feel that connectivity back to the global platform is incredibly powerful. I think regionally as well, several opportunities like the data center platform that I referred to in the beginning, where you can actually do a lot if you are a regional platform with each other. And I think what we find is, again, capital will flow where, the returns can be made. But I think that benefit of having, global calibration and then regional collaboration can be quite powerful.
Right. It's very interesting that, Ashish, you pointed out that a large part of that strategy would depend on the exits. 5 years, ago, if we were having this conversation, where were the exits was the biggest question. But by now that is established. Rohan, I would want you to come in here where, KKR has had phenomenal exits in the last 4-5 years, where you've seen, large trades, be it sponsor to sponsor, be it, on the strategic side. So how has, the comfort on the exit side really helped in putting incremental capital into India?
Yeah, I think, look, the ability to get a good exit at the end of the day is, if you invest in, a good business, I think you'll always find, I think, the right avenue to exit. So I don't think you can have good exits without making good investments or backing the right businesses or doing the right things when it comes to value creation. But having said that, I think the biggest story in India over the last, I would say, 4-5 years has really been, the level of maturity and depth that capital markets in India have evolved into. I think that's, it's been a sea change. The data points I'm sure everyone here is aware of, but there have been very strong domestic market flows. Quite a few exits which we've solely exited on the Indian capital markets, and these are large quantums of capital that we've returned through tapping the capital markets in India, which frankly, 10 years ago wasn't something that we would potentially, even think of, let alone underwrite. But I think the confidence that we've now got by having some of these exits in India through the capital markets has, I think when we now look at deals or we'll underwrite new opportunities for investment, I think that definitely plays into the risk reward that we evaluate while making an investment. And I think that's a great sign for, the ecosystem in general. I think a healthy, deep capital markets and well-functioning capital markets is important for, for the whole ecosystem. And I think it augurs well that, we are on that journey, and I'm sure we're still scratching the surface. So I think that's a very positive sign and gives investors a lot of confidence.
Right. To that point, the capital markets have been, in that sense, very resilient. And Shweta, we've seen, it's been a secular trend in that sense where, the market is no more moved by a few FPI outflows. The market continues to be resilient and deep enough to absorb large trades. We've seen 2023, the highlight was the kind of block trades that happened, which offered a lot of PE investors, sponsors to really get an exit. So what is your sense, how comfort does a deep capital market give for a firm like Advent to get into those kind of trades?
So a lot of comfort, right? I mean, I have to say that I was a skeptic that if you buy, at least in control deals, right? If you have 100%, 70% of a company, how do you kind of sell that in the capital markets, right? But I think increasingly, starting with our own Crompton trade where we had control and we sold, of course it was not a 70% stake, but a large, from a value terms, a large stake, right? And in control. And diversify the shareholding. Now it seems like there are several examples of that, right? And that gives a lot of comfort because it opens up a genuine avenue of exit, whether it is control or it's a minority transaction. Earlier for minority it was easy, control not so much. So definitely it gives you comfort. I think what you have to sign up for if you have a very large stake in a company is to give it a lot of time to be able to exit your entire stake. Because you have to do it methodically, right? You have to make sure there is no disruption, you have the right board, you have the right management team, which can take the company forward. Otherwise, it will not be good for the industry as well, right? So I think that's something that you have to be mindful of and allow 3 years, 4 years to sell down your entire stake as opposed to just, rush the moment you see sort of buoyant capital market. At this point in time, obviously, I would say markets have almost gotten ahead of themselves. I think it is more positive than it needs to be, not backed entirely by fundamentals. But having said that, I think overall sentiment, of India for the rest of the globe within the country is positive. We are probably the most, geopolitically stable country in the relative context. There's still growth. There are, of course, pockets of higher and lower growth, but on balance, there's still growth. There's, I would say, a stable regulatory environment. All of that, bodes well for India, right? So that's reflecting in the capital markets, and there's a good and a bad side for private equity. Good is that, you can exit. Bad is that everything is more expensive than it, was. So that's tough, but it's, on balance, I would say it's good for good for everyone, I would say.
Yeah. Right. And I think, you touched upon a very important point of valuations. And so valuation is something that, a growth stage investor like yours is very sensitive about. The kind of money that you pay affects the kind of exit or, the IRRs you're able to make. So, and again, valuation has been a secular trend in India. It's been just going upwards. To Gopal's point where, tech investments, we've seen some bit of rationalization, but in the sectors that you play, valuations have been very, secular in that sense. It's been going up. How are you, seeing and how are you working around that?
So you asked me the toughest question that is there in the panel. But that's fine. So on valuations, India has always been expensive because we have always priced in the potential of the market. And today, even more so because of India's position in the, and to some extent, geopolitics, etc., are relevant here in the sense that suddenly there is a very clear shift that India has made towards aligning with US and other markets. Therefore, there is a certain linkages that our businesses could also kind of benefit from. So people are saying that the reason why there is a optimism around manufacturing is because people believe that now probably our businesses can align with some of these markets and there is a growth potential. A lot of that gets factored in over, you are looking at companies in a certain phase of growth where the growth potential is driven more by the management or the entrepreneur's ability to imagine what can be there. And you are trying to buy into that and develop a conviction on whether that is possible. In a certain industry, can you have a company which grows at 50% and another company growing at 10%? Absolutely yes. Do those two companies deserve different valuations? Absolutely yes. So what is your ability to make that judgment and partner in that growth will determine whether you are able to play into that particular company at that valuation. But there is reasonable kind of conviction also to believe that while there could be periods when valuations would look slightly more expensive, these all go through cycles. But in the long run for the foreseeable future, it is a multi-decadal growth opportunity that will continue to be discounted. So there is no reason to believe a complete collapse in valuation to levels which many other markets are. So the question really is that how do you factor in some amount of valuation deterioration and still make your investment case? And the growth opportunity allows you to make those cases. And then you kind of have, as some others were saying, there are different types of deals that you look into. Sometimes you're investing into ownership transition. Sometimes you're investing into platform creation. So in many essence, you're not really paying up the valuation, you are creating that value. And those are aspects that private equities will continue to evolve, and those skill sets that are required for private equities continuously evolving. You kind of see that across all funds, the ability to really take some tough decisions in terms of management changes and still steady the ship and take it forward, etc., are kind of getting demonstrated more and
Gopal, Sudhir said that, India has always had this growth premium, we command growth premium. A lot of your investments are, a lot of your pipeline is built into from companies that are previously funded by, say, a venture or an early stage investor. So is there a governance premium also that these kind of companies command, or lack of it? In today's day, we cannot ignore that fact. So how are you pricing those assets, and how are you working around that?
Well, there's certainly a pricing problem in the market. There's demand for capital, there's tremendous supply for capital, and this is a global problem. But globally, growth markets have seen a deal drought. That is a statistical fact. It's a little easier to solve for it at the upper end of the market because you can staple secondaries. And a typical investor who can do a $100 million deal can also do a $200 or $300 million deal. But at the lower end of growth, it's more difficult to source secondaries. And with secondaries, you can bring down the price of the deal without affecting, let's say, the price of the primary. Well, at some point of time, this has to give in. There's this new term, ZIRP cons, which is zero interest rate policy cons. It's been 11 years since the term unicorn was coined. We've seen a 14x growth in the number of unicorns. By some estimates, between a third to two-thirds of all unicorns are ZIRP cons. So as capital regains its character, certainly I think pricing power is coming back to investors. And I think even from the demand side, this waiting game will soon end. And you will see this deal drought giving way to more deals. Thank you.
Right. Clearly more deals and more exits. India has by now established that, the exits have been phenomenal. But, when we compare for global firms, the IRR returns, the INR returns have been phenomenal. But, the kind of currency, risk that they play into. So, Prakul, if you can talk about that, how are you hedging against the, forex risk?
We're obviously accountable for our dollar-based, in our case, Canadian dollar-based return. We don't hedge our FX risk. That's something that is done at the top of the house. So while we obviously invest in assets that have prominently INR exposure, we think of them on a USD basis, just in terms of the underlying depreciation that one can expect over time. And I think that's a pretty common principle that other funds look at as well. And similar to other funds, we also look at export-oriented businesses where the returns are not just with an INR basis, but might actually benefit from that depreciation. The jury is out there whether that perpetually depreciating trend of the INR will continue. We don't bet on that. We don't bet against.
So maybe just one last question. I'll just sum up with that. Capital has become commoditized, and at this moment, it's very important, how an investor is differentiating themselves. And Ashish, if you can talk about that, say, for a firm like Bain, how are you, because it's become a crowded market, how are you really differentiating yourself as an investor? And with that, we'll wrap up.
Okay, I feel nervous being the last word on the panel, but look, you're right. I think it is increasingly competitive out there. I suspect if you speak to any of us, eventually the way we think about it is it's three things that matter. In this sort of a market, you've got to have, you have to challenge conventional thinking, you have to have a differential point of view on an asset, how you're going to make money with it. But I think increasingly it's more important to be able to back that up with a real capability on what you can do when you own these businesses. We call it, our portfolio group or our value creation approach. We were a bunch of ex-consultants that got into investing, so I think that comes more natural to us. But I think that's really going to differentiate people, because everyone will have insights on, industry growth, pricing, etc. But your ability under your ownership to bring that to life, I feel, will be critical. I think with that comes the need for deep partnerships. Eventually, no private equity fund can do it by themselves. So the ability for you to work closely with and form aligned partnerships with founders, promoters, really capable CEOs, I feel would be the second thing that would set apart different players. And I'd say the final thing is eventually you have to build businesses that are making a positive impact in the communities and in the countries they operate in. I know ESG is a much abused term, but eventually if you build businesses with the right governance, with the right sustainable environmental impact, I think the markets will give you a premium for it. And as we think of homes for our businesses, eventually you will get rewarded for that. So again, in a nutshell, I think all of that will hopefully allow us to compete in a more competitive world.
Great. With that, we'll end the discussion. Thank you so much, guys. You've been phenomenal.
All right, thank you all for that. I request Mr. S. Srinivasan, please, of Kotak Alternate Asset Management, to come on stage and present our panelists. Please, if you could wait on stage with the certificate as a token of our appreciation. Mr. S. Srinivasan, could you please come on stage? All right. Raja Tandon to the rescue to present the certificates. Ladies and gentlemen, a round of applause for our panelists. Lots of wonderful insights and a lot of expertise that has been gleaned from this insightful panel. A round of applause, ladies and gentlemen. All right, let's get a move on, and I'm going to request Rajat to please stay on stage. Prakul Koshva, please to stay back on stage. I'm going to also invite on stage Lavanya Ashok of Trifecta and Vivek Soni of EY, along with Ajay Arora of EY, to please come right back up on stage. Do remember, just a short while ago, we had the presentation of the EY IVCA India Trend Book 2024, and now we're going to officially launch it. So please come on stage and present it. And ladies and gentlemen, do give a round of applause. This is the India Trend Book, the report that was launched by IVCA EY, Private Equity and Venture Capital Agenda. The official launch, ladies and gentlemen, a big round of applause. Thank you so much, gentlemen. For that, I request you all to take your seats. Now, next up, let's turn our attention to the generation, the next gen of disruptors and innovators. And we've all seen some very fascinating innovations in the country, haven't we? From areas like space tech to automated cars, you've got companies breaking new ground, using path-breaking technology to create a deep impact and change lives for the better. So it is critical to understand then what the evolving landscape of innovation and disruption brings. Our next panel discussion is on transforming the next generation of innovators and disruptors. Join me in welcoming on stage Madhurima Agarwal, Managing Director, Microsoft for Startups India, Mohanjeet Jolly, partner, Iron Pillar. Reema Subramaniam, co-founder and managing partner at Ankur Capital. Rajiv Kalambi, of general partner at Cactus Venture Partners, along with Vijay Raghavan Kannan, partner at Satguru Catalyzers. And this session is going to be moderated by Siddharth Modi, partner of JSA.
Good afternoon, everyone, and welcome to the venture capital panel that we have. It's wonderful to see this audience. The whole objective of what we will attempt to do in the time that has been allotted to us is, deep dwell and dive into the VC space. We will try and make this conversation as insightful as possible for all of you, whether you are an investor who is looking at some exciting opportunities and sectors to invest, if you are a founder who is looking to raise money, we will try and get some insights from our impaneled panelists. We will try our best to get their expertise. We will try and make it as interactive as possible. We are going to broadly cover some broad heads subject to the time that is permitted to us. We'll briefly speak about the next tech revolution and what are the promising sectors. We will also try and cover the government boost and whether the VC ecosystem is ready and how they're reacting to this boost from the government. We will try and speak about Built in India for the World theme, which we have been speaking about, which we are hearing about. And lastly, we will briefly speak about the founder evolution in the VC space. So let me take this opportunity to now introduce our panelist, Rajiv, who is partner at Cactus Ventures, brings a wealth of experience in industry across cutting-edge sectors like SaaS, clean tech. We have Madhurima, who is representing Microsoft's venture initiatives. We have Rema, who is from Ankur Capital, which is to just give you last few interesting investments that Ankur has made. They have done VGrow, which is digital supply for fruits. There is Nirma AI, which is for breast cancer detection. They have Off-Grid, which is a sustainable zinc-based batteries. So in the variety of the sectors, which kind of speaks on its own, how diverse they are as a fund. We have Mohan, a co-founder of Iron Pillar, a seasoned technology investor. Iron Pillar recently has invested, if I'm not wrong, in the supply chain and logistic company called Pando. Not sure if I'm getting the name right, but yeah, that's the latest investment. We have Vijay Raghavan from Satguru Catalyzers, who are focused investors on technology with focus on IP life sciences. This is the wonderful panel we have. We will try and seek their expertise on some of the broad questions that I have today for them. So let's start, gentlemen, with the next tech revolution and the promising sectors. So we have seen, if we talk about technology, we have seen AI, machine learning, which has given a lot of boost to healthcare, finance sectors, manufacturing sectors. We have seen quantum computing, which has also boosted pharma, cybersecurity. We have seen blockchain, decentralized finance, which has disrupted or has a potential to disrupt the way the financial transactions are carried out, by offering accessibility, transparency, and efficient methods of doing the transactions and asset management. So, we have seen so much happening in technology. So, keeping this context in mind, let me first come to you, Rajiv, that, you guys have recently done a fund close, so congratulations for that. So many niche themes within the technology for VC. How difficult it is for you, or what are the challenges that you have seen when you speak with your investors to raise funds, in these sectors? How do we explain it to them? Is it, and is it any different when you speak to a domestic investor versus a foreign investor? Some thoughts there.
Thank you, Siddharth. Thank you for having me on this panel. So I think the question is more focused on what we need to pitch to investors when we're looking to raise a fund. A quick introduction to what we do. At Cactus Venture Partners, we invest broadly in three categories. One sector is enterprise software, which is more of a horizontal. But there are two verticals, which is clean climate tech and health tech. We typically come into companies at a PMF stage. So PMF has to be established, and we work with the companies to sort of help them grow. So this typically happens at a Series A or slightly post-Series A stage. We invest at this stage, and then we double down in Series B. So given this background, the challenge with discussing with investors is that they will have questions for everything that you put forward to them, right? There'll be cross questions, right? Why not this? Why not that? Why this? Why that? So the challenges you will face is one, if you decide to focus on one sector or two sectors, the questions you'll be asked is, how wide is that, right? How robust has the ecosystem become for you to be able to get transactions, right? Deals. There have to be several deals for you to be, because you're not going to be able to win all those transactions, right? And then you'll also go and pick the ones that work for you, which some don't work for you. So the question is, how robust or deep or wide is the ecosystem that you're trying to target? So that is one question. Whenever you try to do something which is very sort of focused or niche or within one vertical. In addition to that, the larger question that gets asked is exits. See, the challenge with the private industry is exits. You can put in money into a company, you can help it grow, but there are lots of companies which have also grown, but getting an exit out of that is also can be a challenge. So historically, when we've seen most investors who have either invested or watching India from the sidelines, they keep evaluating exits, they keep looking at DPI. And that has been one of the challenges that we sort of encountered when we were doing our fundraising. These two things tend to be the largest obstacles when you're looking at fundraising. Now, from an international and domestic perspective, our experience has been that internationally, almost all universally, there's a consensus that India is the place to be. Having said that, people are not rushing in. They take a very measured approach. They want to understand things before they come in. It's not that, okay, because we're not investing in China any longer, we should put the money that we're generating into India. They will weigh investing in, say, for example, the US market or in Europe itself rather than rush into India. So, it's not very quick over there, right? So you've got to jump through a lot of hoops before you finally get a commitment from them. India, on the other hand, the market seems to have matured to some extent. There are several family offices which know the market very well, so that's one, obstacle that's overcome. And they are sort of venturing into venture investing in a big way. So there's a lot of potential and opportunity over there.
So thanks for that. So Vijay, let me come to you. Similar context, given that you focus on tech, which is more IP-driven life science, do you face anything in particular? And Rajiv made a very relevant point that what is important for investors as a concept, and particularly for foreign investors, is how do we make sure that we get the exit? How do we get the money out? Are they, do you see in your experience there are still some apprehension and explaining the the tech that you focus, which is IP-based life science?
Thank you, Siddharth. You know, we contextually have two funds that we manage currently in Catalyzer. One is Innovation in Food and Agriculture Fund, focused on plant genomics, plant science. The other one is Inclusive Life Sciences Fund, which is across the spectrum of human health, animal health, plant health. You know, typically it's a sector acumen-driven investment that's focus here. Of course, our first fund is among the top 5 performers of the 2019 vintage by NSE standards today. The elements are essentially investing in intellectual property. That's the obvious, innovation homegrown for the global markets with the worldwide, patent grants. And the startups, of course, or early stage companies in India have been focused on a decade or so in that. So we have about close to 4,000 odd global assets that are, IP driven, and probably the world-class assets could be about 400 to 500 in that. That's the opportunity we have in that. Now, typically 2 elements are there. One is we are looking at global markets. That's very lucrative. Indian markets is large, but affordability is the criteria there. So we would look at global registration for them, like FDA or EPA, or for that matter, EMA for that matter. And that's the ring fence, again, from competitive forces for these enterprises. So we invest in early to early growth stage kind of a situation there. When it comes to startups, we do pick assets that are, well appreciated by global investment community. And since we have the acumen, partly I attribute my gray hair to that, you need to be in the sector known as a fund with an acumen to pick the right assets in that and steer it through the markets there typically. Our investment, primarily our LPs are again international. There's very little domestic institutional investment that gets into life science sector today. Even in the Indian traditional fund of funds, it's less than 1% that's gone to life sciences fund today. It's primarily international investors. There are a lot of good appreciating private investors in India today, family funds. There's a lot of new money that's come into pharmaceutical industry exits in the last decade or so. That's certainly an element. And a lot of good family funds are now taking risk in quality assets in life sciences. So that's an opportunity that we have for us today. Typically, I would say, the big value of our death or the hiatus is when it comes to those that are large numbers but do not get their, Series B, Series C funding there. That's a big gap today that remains. Yeah.
Understood. So thanks for that. Mohan, let me come to you. Given that technology is evolving, right? Every 6 months, 1 year down the line, we see a new technology. So as a fund, when you guys identify a target with a particular technology, how do you secure that, okay, this technology is going to get upgraded a few years down the line? Meaning, I'm just probably asking a layman question to you because idea is to be as informative and beneficial to the audience here. But, how do you do the risk mitigation? How do you adapt to the evolving technology? Any thoughts in
Yeah. So first of all, I don't like being on panels that are just before either alcohol or food. So by the way, for those from outside of India, we call this breakfast. Lunch is around 5 and dinner's at midnight. So just keep that in mind. Look, 30 seconds on Iron Pillar. Iron Pillar is a venture growth fund, primarily Series B and C, that is investing across consumer and enterprise technology companies that are building from India for the world, right? So this thesis is actually woven into our logo, right? So that's how strongly we believe in the India for the world thesis. Now, to your question, it actually goes to how we at Iron Pillar work. So the way we work, even though we do Series B and C investing, we actually start engaging with companies right at the seed or Series A level, right? So the whole idea is start engaging with companies much earlier than when they need our capital. So what that does is 2 things. One, and by the way, we have a senior team for a relatively concentrated portfolio. So our entire fund will invest in 8 companies which is about as antithetical to the venture paradigm as one can imagine, right? The whole sort of power law and diversification, et cetera, et cetera. And the reason we can do that and have been very, very successful with a concentrated portfolio strategy goes to the question that was asked, which is we engage with these companies much earlier. We open a bunch of doors, right, to customers, partners, leadership. The feedback that we get from those pro bono door openings actually acts as a diligence mechanism for us. So we know, therefore, that there is indeed a product market fit, that there is indeed a land and expand, right? So that diligence works really, really well. Then, of course, the only thing that is constant in the startup world that it's not. Okay, curveballs will come, googlies will come. And so part of the analysis that we do is not just tech-centric, because tech can change, can get disrupted. OpenAI can happen, right? Which will obsolesce some and create tailwinds for others. But we're looking for those entrepreneurs who are resilient, who are gritty, who are persistent, who are self-aware, who surround themselves with people who are smarter than they themselves are, with advisors and mentors and so on and so forth. So I think that entire sort of equation is what we look at. Of course, the bare minimum is team, technology, traction, market. Those are the things that all VCs look for, but there are some of these other nuances, right, that go into the formula before we make the bet 2 years after we first engaged with them.
Makes sense. Yeah. So thanks there. We also see that there has been government has been boosting the VC ecosystem. We can see the interim budget which was presented by the finance minister. She has, I think, allocated 1 lakh crore corpus for a sunrise technology. We also see how deep tech has evolved over a period of time, leveraging extensive research and development, driving innovation across sectors, which has helped healthcare, food, energy, constituting a $300 billion market plus. So, let me come to you, Rema. How do you see this, the government boost, and you guys have also, Ankur has gone on, released a report on deep tech. So, would love to hear your thoughts as to, does it impact your investment strategies, keeping these aspects in mind?
Thanks. Yes, we did release a deep science and tech report last week, and we see this as, while we have put out a number of $300 billion market, we do see it being much larger as the time goes on over the next few decades. And why? Yes, the government support is definitely, the boost is there, but I think before that, there's a lot of other things that's happening. One is that the whole startup ecosystem, and globally as well, in the whole deep science and tech space, there's been a lot of innovations, and with the problem statements that we have across globe, we do see is the fact a lot of these science and tech innovations can solve many of these problems. And what are they? Like, if you're talking of Gen AI, you're talking of the fact that the whole gene CRISPR technologies that came in, or the fact that climate-led initiatives around synthetic biology, around new material sciences. These are all areas that have been booming that over the last few years. And in India as well, you now have a whole startup ecosystem of entrepreneurs who are looking at deep science and tech, right? So that's the starting point to say that's one reason why we are very optimistic about it. The second part of it is the fact that these startups, unlike a few decades back when a lot of industry started in India, you always remained in the lowest rung of the value addition for a very long time. But what we're now seeing is the fact a lot of our startups are moving up the value chain and not just being just the provider at the lower end of the spectrum. So it could be, for example, in space tech, we now having not just companies just build at the lower rung, but they're willing to send satellites up, to being right on this, to the fact in the semiconductor space, in the biotech space, if you're looking at how the whole synthetic biology space is doing, you have companies that are moving up the value chain. So which means that they can go global. They are not just looking at the India opportunity, but they're going to be global players as well.
Sorry to interrupt you, and also just to add, the FDA has opened up recently in the space technology, which is few days back it was out, yeah.
Right. So obviously, so the fact that we're going up the value chain opens up the large market for us, is the second thing. The third is the fact that India is a sandbox for very quick innovations to come up and to be able to pilot different things and to be able to launch things much quicker, right? The fourth is the fact that, and we can do all of that in a very, very capital efficient manner, at a fraction of a lot of that happens. And the fifth is obviously the policy boost that has come in. So that obviously is the catalyst for all of this to come in, right? So these five together is what we think India is in a very, very interesting space now to be able to launch there, is right. And we see this as a very large opportunity. We've just not even barely scratched the surface. And that's what I would urge all of, whether you're an innovator or a capital provider, to look at the fact that India is the space to look at for really cutting edge solutions for global solar problems that we're looking at.
Right. Thank you so much, Rema. Rajiv, let me ask you, you guys at Cactus have solid performance in SaaS and FinTech. So what is your take on, the fact that government is supportive, and, do you see anything in particular that you would as a fund do, given that you already specialize in some of these tech, focus? So is there anything that you have any change in your investment strategy or anything? Would love to hear your thoughts.
So so one is the digital public infrastructure that the government has set up is something that has actually disrupted industry to a large extent, right? It's democratized access. It's ensured that you embrace and involve every citizen into the activities, financial activities. And there are lots of developments that have happened on the financial side, and the government is now doing that on the health side as well, right? So the Aadhaar cards and the ADHM, etc. So where gradually what will happen is that data from hospitals and insurance companies will likely get aggregated over time, right? So companies will have to think up newer business models. So companies that were focusing on creating data lakes because they had access to information, that will no longer be a competitive advantage. So we see some changes happening. Government's involvement in this, of course, is helping industry to a large extent, but it's also in some cases also causing problems for industry. So it's a question of identifying what will work well for industry, given the changes that the government is instituting. So, and within FinTech, we typically don't prefer to do investments in the lending or the payment side of things. We look at the technology enabler side of things, because you can see even RBI now is coming down very strongly on a lot of the business models, right. In the lending side of things. So yes. We've always been slightly, we beware of that segment to some extent. Yeah.
You mentioned some interesting points. So let me touch upon the Make in India for the World theme, right? Which is, you look at ONDC initiative, which is, like you rightly said, democratizing the e-commerce platform, letting the smaller players particularly from rural areas, allowing the opportunity to participate with the larger giants and creating some sort of a level playing field. You look at India's tax success story. Now there is a UPI, Singapore has agreed for that with India's tax, that just kind of demonstrates the global success that we have had with them. A lot of tech-enabled startups are using public goods like Aadhaar, like you rightly said, for digital identification, or a UPI for digital payments, or they are looking at DigiLocker for storing documents and sharing documents, which is all creating solutions that are more, scalable, inclusive, impactful. So, Madhurima, let me come to you. What do you, how do you envisage this theme in coming years of Built in India for the world?
Thanks, Siddharth. So a quick introduction before I answer your question about Microsoft for startups. So we work with a lot of startups, upwards of 10,000 startups, and they range across early stage, so idea stage till Series C. And three things that we've seen startups really care about: building a great product, getting the right customers, and of course, raising the funds that most of the folks in this room provide for. And what we are seeing in terms of product is with all these new technologies that you alluded to, right? Gen AI is coming, and that's the latest that everybody today is talking about. We equip starters with all the infrastructure, which means they get access to all the cloud credits, Azure OpenAI credits, mentoring and stuff. And from engaging with these, close to 10,000 startups, what we are seeing is that there's a theme that's emerging: build in India and serve the globe. And it's nothing new, right? My fellow panelists talked about it, Mohan spoke about it. Earlier also we heard about how India is a deep market, it's a wide market as well. I want to share an example of, how this is panning out in terms of Make in India. One of our startups that's more in the social impact space, but nonetheless doing very groundbreaking work, that's called Karya. And they are actually going to the roots of India, engaging the women at the grassroots level to build LLMs in the vernacular languages. And the way they are doing it beautifully, right? They've partnered with Microsoft and they use all our technologies. But that's an example of how somebody is leveraging the power of India, our large population, the problems that we have, and coming up with innovative solutions. In terms of the breadth, what we are seeing is, it's not just the social impact sectors and not the LLMs, that's the only thing that's happening. But across sectors, across startups, they are all leveraging the power of these new technologies to do data, content creation. They are building chatbots which are being used by other startups to create applications on top of that. We are seeing there's a lot of work that is happening around multilingual. In India, vernacular is large, and today they are doing it for the Indian languages, but the same technology can be multiplied and done for the global languages that exist out there. So essentially, building in India, the retail access to data in India is fairly easier compared to other parts, more because of the size of the data and the variety of data. Thus, which means that if you're training your models or fine-tuning them, it kinds of gives you a good base to start with. So ultimately, these are the themes that we are seeing playing out. You talk about retail, you talk about healthcare. Fintech is one of the biggest sectors, and given that we are sitting in Mumbai, the financial capital of India, a lot of the enterprises as well in the finance space are leveraging the power of these startups today to build innovative solutions for their customers. So, long answer to your question, but we are seeing it's across the different spectrum of usage of industries and the kind of solutions that's coming out.
Right, thank you. Vijay, let me ask you this. India is now poised to be the global giant in life science, and given that your fund focuses on life science, with of course, and life science you need the IP support. So, how do you look at this, and how do you basically access the startup that align with this vision?
Sure. Siddharth, the elements that are driving startups are the speed at which they steer the inventions. We don't really do much of generative IP in India. What we really steer is the adaptive IP. Example would be, let's say, a platform like mRNA is a generative IP that's mostly in the United States. Adaptive IP is to develop a vaccine based on mRNA platform. So we are into adaptive IP. And these are product forms that really get to market in 4 to 5 year span. And they are typically in a very niche segment where the speed of getting the product to market is very, very important, with the regulatory approval that comes in there. So, and ideally a span of investment would be like 8 to 10 years to get a best of the return.
But somewhere you exit on the way as the value chain, ramps up with the regulatory approval there. So we, in our parent entity, we invested in one of the Indian vaccine company that's second largest today, and we are close to about 50x, returns in that, because it's a unique kind of a capacity to make vaccines there. We also invested in a first-time Indian biochemical molecule, which has never been there. In fact, it's now raised eyebrows in the biochemical industry that India could also come with an inventor molecule. So that's now getting regulatory approval. So I think these are ones where the Indian enterprises are steering a global standard invention to markets, duly taking them to competitive assessment in the world markets today. Yeah.
So, let me ask this, towards the concluding part of this, that what are, given that VC market is expected to reach, as per the study, $522.50 billion by 27, what is it, as some of you established VC players, and I'm sure a lot of people, young entrepreneur and founders who are about to start the business, what do you believe are the key characteristics that you guys look at in particular? I don't know, maybe Mohan, your thoughts for a promising entrepreneur.
Look, so we've come to the end of our session, but I will leave the audience with the following thought. So I've been investing in India since 2007, so 17 years. And I believe that India has gone through what I call the inspiration, aspiration, and perspiration journey. What I mean by that is, when I was here in 2007, trying to get entrepreneurs to think at a 10 million, 15 million top line was a challenge. It wasn't until the watershed moment of Flipkart, Freshworks, and more recently, the public markets came about that suddenly the light bulb went off, right? And so now, as other panelists have alluded to, the companies are no longer looking at in valuation. They're looking at $1 billion, by the way, not in valuation, in revenues. So that's the aspiration that India has. And so for the entrepreneurs in the audience, and I'm bypassing the question a little bit, but I think it's an important point that I wanted to make, for the entrepreneurs in the audience to think back to 17 years ago when your brother and sisters were starting new companies. There was a dearth of talent, dearth of capital, dearth of ideas, all of that. And now you have a plenty. So you have the best time in the world to create, juggernauts across industries. And I think India is moving from what I call the IT phase to an IP phase, which some of my panelists have also alluded to. Sorry.
Yeah,
I'm afraid we're completely out of time, and it's essential that we stick to the time limits. We've got a lot of panels and discussions lined up. Apologies for that very rude interruption. I know I'm the time Nazi. No one likes me, but then this is the job that I have to do. So thank you all so much, ladies and gentlemen. A round of applause. Siddharth, thank you so much for taking us through that discussion. And to present the certificates, I'd like to welcome on stage Sunil Goel of Your Nest, Arvind Mathur, the past president of IVCA, as well as Srinath Srinivasan of the Oman India Joint Investment Fund. Please, gentlemen, join us on stage to present our illustrious panel who spoke about transforming the next generation of innovators and disruptors, the VC perspective, with a token of appreciation. Ladies and gentlemen, a big round of applause for our panelists and illustrious and distinguished speakers. All right, a quick photo op and then we're moving on then. Thank you all for joining us today. Request you all to All right, it's time to get a move on then. And next up, we've got a keynote speaker and a keynote address that's coming up. We've got Dharma Kirti Joshi, the chief economist at CRISIL. Ladies and gentlemen, a round of applause for Mr. Joshi to talk about the India macro story. May I please request Mr. Dharma Kirti Joshi, the chief economist at CRISIL, to join us on stage. Ladies and gentlemen, a round of applause.
Good afternoon, everyone. I'm actually literally standing between you and the lunch, so I'll try to be brief. And taking cues from how the previous panel was shut, I think I'll try to stick to the time as much as I can. Well, in my career, I have seen 3 upturns in the economy. The first one was during the period leading up to the global financial crisis. India was doing extremely well, but the growth fizzled out as soon as the crisis erupted. The second phase was immediately after the global financial crisis, when the economy was again chugging along quite well, investments were happening, but that also fizzled out. So I think to cut the chase, we've been good at running sprints, but we haven't run a growth marathon till now. We are again at a phase when I think things look very promising. It's very different from the previous phases, and I think there is a lot of hope that this is the start of a marathon. So I'll build up to that story in my presentation, and let me start by giving you some of the headline messages. First message is that, well, growth is not something new to India. India already has a track record of high growth. If you take the period from 3 decades preceding the pandemic, India grew at 6.2% per annum. So that's a pretty high rate of growth. Second, I think, thing that comes out very clearly is it's been facing the challenges that come from global disruptions quite well, whether it was the Russia-Ukraine war or even the Red Sea, the tariff wars that are going on. Nothing seems to have derailed the growth story till now. Actually, growth has outperformed the expectations of government, of RBI, of analysts, everyone. So it's a good place to be in. I think in the coming fiscal, the growth may slow down a bit because the central bank has been raising rates, and the objective of raising rates is to slow down the economy and control inflation. But that's going to be a transitory, a cyclical blip in growth. After that, growth is expected to again move up, and we expect around 6.7% growth per annum till the end of this decade, which will make India one of the fastest growing economies. One difference, I mean, we've already grown at high rates, as I told you earlier. I think what is going to happen now is the magic, maintain the pace of growth. The gains are going to be much larger, I think, if you are able to do that. What is behind all this? Well, India has some domestic strengths. The balance sheet strength is one of the key ones, particularly of the corporate sector and of the financial sector. Corporate sector, the mid-sized and the large corporates, they have very low gearing right now. They have cleaned up their balance sheets, and they are in a position to re-leverage, which essentially means they can borrow more now if they want to. Second strength comes from the balance sheet of the banking sector or the financial sector. Non-performing assets are at decadal lows. I think for March 2024, the NPAs are expected to be close to 3%, which is very, very low. So I think this balance sheet strength is also something that allows you to grow at least over the medium run. And then I think finally, the policy focus of the government also adds to the strength of the economy. We have focused on creating a physical infrastructure. A lot has been talked about digital infrastructure, where we actually raced far ahead. So you're creating physical and digital infrastructure at the same time. And there's a lot of synergy that comes from doing that simultaneously, which I don't think any other country in the world saw both of them develop at the same time at such pace. I mean, so that adds to the strength. Government introduced goods and services tax. The major benefit of that has come to income taxes, surprisingly, because people are not able to cheat on taxes. So the income taxes are growing at the fastest rate right now, because once you are able to get the chain, it's difficult to, you can't cheat on your income tax, you can't be investing in mutual funds, and at the same time declaring a very low income. So I think all that is also helping. And I think these make growth a little more sustainable. So I'm going to talk a bit about this story. Now, one problem that we have right now, I think it's not everything is rosy, is food inflation. And that matters a lot for a country like India, where you have a huge population, and when people face high food inflation, then their ability for discretionary spending reduces, particularly for the lower income households. So that's one problem that the nation faces. Other than that, the other parts of inflation are very soft. This is very different from the nature of inflation that US is facing, where the core inflation is very high, which is, I think, core means you take food out, you take fuel out, what is left is core inflation. In India, core inflation, which is a headache for the central banks, generally is low. The volatile parts of the inflation are leading inflation in India, and that's something to do with climate change to some extent, something to do with what happened to rains. Last year, we were deficient in rains. We got the hottest year in 123 years, I think the hottest August, so to say, which is the time when the crops are ripening, or so to say. So I think this is one problem that we have to deal with. I think on the monetary policy, in general, central banks are at a very delicate phase. They misread inflation completely in US and in most parts, so they will be very cautious this time while cutting interest rates now. They don't want to declare any victory very early. That's not such a good news for many investing firms, because I think particularly for VC, etc., because the credit becomes expensive. And when credit becomes expensive, the funding becomes, but that's also a transitory phase. I mean, economy never moves in a straight line. It moves in cycles. And we will see interest rates also come down. For India, we expect rates to come down possibly in June this year. The reason is, as I said, it's only food, and we are expecting food inflation to slide down because the winter crops have not been too bad. I mean, so that's what the initial assessment is. Okay, and in general, I think the Indian macros are reasonably in balance. I mean, that's one of the reasons why the country is being looked at as the next growth engine. It already is a growth engine. So GDP growth at slightly slower, 6.4% in the coming fiscal year. Inflation will also edge down, as I mentioned. I think food inflation is likely to come down. Exchange rate, we've seen remarkable stability in currency, and I think that's likely to continue because you're getting a lot of flows into the debt market after inclusion of into the JP Morgan index. We are yet to be included, but pre-positioning has already started, and I think that's showing up in debt inflows. The 10-year bonds, which is the risk-free rate in the economy, is also going to come down because inflation will come down. Government is not borrowing that much. Actually, the borrowings over the last few years in nominal terms, I think they've remained constant, whereas GDP is growing. So the deficit as a percentage of GDP is coming down. And on top of that, you also have the inclusion into the bond index, which brings capital inflows, which softens yields for bonds, because the money is going to come essentially into government bonds. So let me shift gears from here. I think I'm looking at the time also, so I don't want to rush through this section, but anyway, I think I'll try to do as much justice I can. We expect 6.7% GDP growth for the next 7 years till the end of this decade. So that's point number one. Compounding benefit will play out. The size of the economy is 3.7 trillion right now. It will become 6.7 trillion if you grow at this rate for the next couple of years. per capita incomes which are at 2,600, which is the lower middle income category, you will move to the upper middle income category by the, so these are simple numerical calculations. There's no magic about it. I think countries have experienced them in the past. The point is, countries like China, etc., they've grown at 10% per annum, so they saw gains much faster than we are likely to see. But nevertheless, I think this is likely to play out. So how do economists look at long term? Three drivers of growth. One is capital, which is investments. Second is labor. And third is efficiency. So when you can produce more with the same amount of capital and same amount of labor, you become more efficient. So I'm going to argue that capital and efficiency are going to contribute more to India's growth, and labor is going to be a laggard. And I think our calculations show that 53% of the growth is going to come from capital. Efficiency will contribute about 30% to this 6.7%, and labor will be lagging behind. And very quickly, why that reduced and government started creating physical infrastructure, particularly in the transport sector. So investment as a percentage of GDP went up because government was pushing it. Now, I think government can't keep pushing investments up, we all know. They have to keep improving their balance sheet, so the deficit has to come down. Now, private sector is what people are waiting for. I think there was a mention of private sector there. We believe that private sector is ready to take the investment baton from the government, although they are very cautious. I mean, they're not going to straight jump into it. Now, there are a couple of reasons why ability is there. Willingness, well, it depends on a number of factors. Healthy balance sheets allow you to invest. I think if your balance sheet is ruined, you can't think of expanding capacity. Second is the utilization of capacity has reached, is above the decadal average, I mean, so to say. And in some sectors like steel, cement, commercial vehicles, etc., it's even above the decadal averages. Then I think like rest of the world, we are also giving incentives for domestic industrial policy, which is called the PLI scheme. I think you all must be familiar with that. That also is helping create investments in very strategic sectors where it would not otherwise come, so to say. When government creates infrastructure, steel, cement, they all do well. And steel and cement, I think they're laughing their way to the bank right now, I mean, because they're doing quite well because demand for their products is high. Finally, I think there's an opportunity which is not going to last too long to latch on to the global supply chain. Here we've seen benefit only in the electronic sector so far. The reason for why electronic sector has benefited is because it doesn't depend too much on the logistics. Roads, quality of roads, etc. don't matter because it's shipped via air cargo. When the ports, the domestic, other things come into play, you require much better, I think, competitiveness of those factors before overall manufacturing starts chugging along. So this is the least sticky part of the global supply chain. It has come good. Probably the ecosystem will also develop over time. But for that to develop, you need better logistics, better infrastructure, etc. So I think the conditions are very ripe for private investments to chug along, and if government does make it easier to do investments, see, they cut the tax rate. I don't think that has helped as far as private investments are concerned. The ease of doing business, I think, matters quite a lot. Tax stability matters quite a lot. I think we'll see some of that in the coming quarters, but conditions are definitely ripe. I think this efficiency is the major story for growth. And here, efficiency in the economy is coming from better physical infrastructure. It is coming from better digital infrastructure. I need not repeat. I think you all are familiar with the interoperable India stack, which is allowing so many innovations, etc. But what I want to point out is that when you have a better physical infrastructure and digital infrastructure, both come together to create a far more efficient economy. Just to give you two examples. One is the roads. Everybody knows we are building roads, highways. But at the same time, I think the toll bridges are also are being made electronic. 98% of tolls are electronic in India. So instead of 12 minutes wait time, it is less than a minute wait time in many of those tolls. So you're saving energy. All these things add up. And then in electricity sector, you've created smart metering, which has allowed, which is again digital, which has allowed you to save on losses. So clearly, physical and digital infrastructure are helping. And then finally, I think economic reforms, I already talked about it, goods and services tax, bankruptcy code hasn't paid off completely, but is getting streamlined, is going to improve the credit culture because you can't have phony loans, and you can't not lose your company if you don't pay back. So all that is going to improve credit culture. Now coming to labor, I think this is the last part. I think I'll take maybe a minute more. I think my time is up, I can see that. So India has 1.4 billion population, 970 million people in the working age group, which is more than the population of US, Europe, and I think you can add a few more other countries. The problem with India's labor force is that we have very skilled people, there's no doubt about it, but when you look at the entire population, the participation of labor in the work, which is called labor force participation, is very low. It's around 60% for the economy, 37% for women, about more than 75% for men. And the reason why it is low for women is, I think one is the gender gap in education. If you look at women above 45 in India, I think 60% of them did not have school education, whereas this ratio is 30% for men. Similarly, women spend a lot of time in unpaid work activity. So 6 hours, according to one survey, 6 hours of average time for women is spent on activities for which they don't get paid. So it's difficult for them to participate in the growth process in general. But for the population as a whole, education, skills, I think these are the things which will allow people to be part of the growth process. Otherwise, you'll have to keep supporting them via free food grain or free or subsidized stuff. So there is a lot of scope here, I think. So there is a lot of scope for maybe the startup or the venture capital also to how they can make this happen. I mean, this is something to think about. So let me come to challenges. Here, I think I want to point out 3 challenges which are also the opportunities. One is India is in a unique situation globally. It is trying to grow its manufacturing, it's trying to grow its infrastructure. Both of them are highly carbon intensive. At the same time, you have decarbonization targets. So how do you decarbonize when you are making your growth process more carbon intensive? So it's no other country face this challenge. So India is the only country, because others have dirtied the environment while they were growing fast. So that is a very, very unique challenge, and so this is also an opportunity how you can make this happen. I mean, so around clean tech, etc., all those things I think come into play here. Second is manufacturing environment. When East Asia, China were growing, they were growing on the strength of a very open world, which is called hyper-globalization, which essentially means that the tariffs were coming down, countries were trading more and more with each other. Now it's just the reverse. I mean, you're imposing tariffs on other countries, you're discriminating on the basis of geopolitical preferences, or discriminating on the basis of security or environmental concerns. So whatever the reason may be, the point is the environment is a little difficult for anybody to grow its manufacturing and export. So in that environment, how do you do that? And finally, I think the climate risk is real, and I think we've already seen last year what it did to food inflation. The monsoon pattern is permanently shifting. I think you're getting rains in areas where it did not rain, and you're getting less rains in areas where it used to rain. So I think all this means you need to prepare for changing climate, and you need to mitigate those risks. So anything that will allow one to mitigate the climate risk, I think is going to be the requirement of the future. So these are the things where traditional investments don't take place. So solar, whatever is the case, I mean, you may look at, it could be a crop, a new variety of crop, which is resistant to heat, which is which is resistant to less water, I mean, or scarcity of water. So I think the point here is, I think I have time for me to go. The point here is that the challenges are also the opportunity for India, because this is a very unique, I've only listed out some of them. There are many risks which are generally likely to play out. Nobody knows the specifics. The global debt is high. When will it blow? Who the hell knows? I mean, so I think there are many such cases there. The broad point is, I think India is uniquely positioned right now. The window of opportunity is next 6 to 7 years. And the chances of it achieving, I would say, I think I would say that its chances of achieving your targets is much higher than, I think, not achieving them at this juncture. With that positive note, thank you very much.
Thank you for that. Please stay on stage. Joining us right now is Siddharth Shah, Senior Partner at Khaitan & Company, to please present him with the certificate. Thank you for those valuable insights on the India macro story, opportunities and challenges. I just have a quick programming announcement. Ladies and gentlemen, request you all, if you are registered at the event, to please have your registration badge on and keep it with you at all times so that you can be permitted into the auditorium. It's time now to slip into a quick break for lunch. We will be right back here at 1:30 p.m. So please be right back in your seats. We've got some exciting sessions lined up at the IVCA Conclave 2024. Ladies and gentlemen, due to the large number of people, we have
accent, and then moved to the UK and then to Australia. In each of those markets, I've seen an explosion of private debt and private capital within the market that I'm closest to, is typically leveraged finance. Very clear and a very important option, as banks have found it more challenging to lend in a very regulated environment. In a potentially regulated environment, it can be challenging for banks to be all things and provide all capital, and that's where private debt has clearly come in and filled some very important roles. It's important for us to kind of work alongside that. I think moving across those markets, I've certainly learned a few things. I've definitely learned that not every market can be applied in the same way, and they're all different. I would do think that there are some interesting and unique aspects of the Indian market that will make it a little bit more perhaps challenging, in my opinion, for private debt to operate and get comfortable. And obviously it's a pretty complex regulatory environment here in terms of working through that. The evolving kind of corporate governance and reporting standards will also make it a little bit challenging. And alongside all that, you have a very, very competitive market from a lending perspective, given the universe of public, private sector banks, as well as a very vibrant NBFC universe. In my role in HSBC in Australia, my team, we're frequently working with our clients there alongside private debt and private capital providers to facilitate their financing needs. That happens, it's commonplace. I completely envisage the stuff we're doing there, and my ongoing role will be stuff that's commonplace here in market in just a short period of time. I look forward to talking about it on the day.
The Innova Partnerships expertise lies in the nuances involved in doing business with a single customer segment. Over the last 20 years, we have partnered with over 50 companies that in turn have done business with 55 million odd households globally. That translates to north of $40 billion worth of transactions. Now, we all know that India is uniquely positioned for a longish growth phase, and we strongly believe there has been an emergence of close to 250 million entrepreneurial households in India. These are households that have multiple streams of income and massive aspirations for their own growth. We look forward to seeing you at the IVCA Conclave, where we will be curating multiple perspectives from seasoned business leaders and practitioners about the epic opportunity, which is the economic power of industrious communities. Look forward.
Hi everyone, my name is Madhurima Agarwal and I am the Managing Director for Microsoft for Startups in India. Today, Gen AI is the topic of conversation across all boardrooms, and we are seeing a whole host of startups leveraging the power of Gen AI to create world-class offerings. This is going to impact the startup landscape in a big way, and I look forward to share my views on this at the IVCA Conclave happening on 26th and 27th of February in Mumbai. Look forward to see you there in person.
Hi everyone, this is Mohanjeet Jolly, co-founder and partner at Iron Pillar. We are delighted again to be the lead sponsor at the IVCA Conclave in Mumbai in February. I can't wait to be on a couple of really interesting panels, and one talking about how we think about investing in future disruptors and innovators, and second, a topic that's near and dear to the Iron Pillar heart. It's actually woven into our logo, investing in companies that are building from India for the world. And what does that actually take? I can't wait to share my views and those of my panelists with all of you in Mumbai next month. All the best.
Hi, I'm Padmaja Ruparel, co-founder of IN Group. We are an early stage investing platform. We are pioneers. We brought the concept of angel investing to India. We now have a platform where companies can raise from literally 50 lakh rupees to over 50 crores on a single platform. We bring in people who can mentor, we help companies actually grow, and we now have several unicorns and some ready to go IPO. The alternate investment asset class is very important if we want to breed innovation and entrepreneurship in a country. Early stage companies literally have no way where they can raise any other money but equity and high risk money. It is this money that partners with talent and helps them to create what are the next generation entrepreneurs, the best of the next innovations, and taking the whole economy forward. So AIFs is very, very important. It's a structured way of investing into startups, leveraging professionals who have been there, done this in the investing world. They not only pick out the best next of emerging sectors, high quality entrepreneurs who then execute and create scaled up companies. It is also a way of investing in well-governed entities, and we are proud to say that governance is very high on our parameters, and that makes it easier for investors to have good high returns as well as not really worry.
In the year 2023, while many developed economies faced downturn, India remained resilient despite feeling the effects of the global funding winter. The country maintained a trajectory of rapid progress. During this period, India's venture capital landscape underwent significant changes, emphasizing more on the sustainable investments. This shift created an environment conducive for businesses to stop focusing on capital accumulation and to shift the focus on prioritizing consumers and revenues. Furthermore, the PE activity in India stayed robust, witnessing a notable increase in the buyout and majority stake acquisitions. Traditional sectors such as BFSI, healthcare, energy, and consumer goods regained their pre-COVID dominance, reversing the dominance held by IT, SaaS, and consumer technology. A significant trend is the prominence of ESG, diversity, and inclusion as a breakout surpassing other sector-specific themes. Stay tuned for the latest insights as PE trends continue to unfold.
Hi, I'm Sambhav Ranka from IC Universal Legal. I'm a senior partner in the firm, and we are very excited to be a part of the IVCA Conclave 2024 as the lead sponsor. More than that, I'm excited to meet all our friends and well-wishers from the private equity and venture capital ecosystem. Year 2023 has been quite an exciting and interesting one in terms of the exits that the private equity investors and venture capital investors have been able to achieve. Not only in terms of the year 2022 and the growth, which is almost up 36% in terms of exits, the IPOs and open markets are the go-to modes which we have seen as the shining mode of exit, followed by secondary sales, strategic sales, and then the buyback in terms of the order. Year 2024 has a lot of promise and excitement for us and everybody in the ecosystem, with the geopolitical moves, with a lot of political action, including in India, likely to be there. We are expecting a lot of action in terms of how the industry will shape up. And I look forward to attending the event and meeting all our well-wishers and hearing from them as well as to how they see the fraternity shaping up. Look forward to seeing you there. Thank you.
Alternative space in India has really kind of come to an inflection point now. And I think with the number of, both in terms of size and a scale, alternatives have become as mainstream as it would be. And then I think all around the recognition in India of this becoming a strategically important industry to facilitate growth and flow of capital to the industries and the corporate India is well recognized now. It is important, I think, for the policy makers. I think we've seen a significant amount of development on that front. And I think one really needs to look at how IVCA has been playing a very crucial role in kind of helping the platform really integrate with the regulator. And I think that's something which I would say will be a very important play. And IVCA Conclave, to that extent, will be a great confluence of LPs, GPs, regulators, and policy makers coming together. So definitely it is one of the flagship events that we look forward to participating in. Thank you.
India is on its way to emerge as a $7 trillion economy by 2030, according to various estimates. This will make India the third largest economy globally. At a time when growth is hard to come by in different parts of the world, India stands out with a 6% plus real GDP growth forecast expected over the next few years. This progression to a $7 trillion economy will be powered by significant investments in its infrastructure. The $1.7 trillion infrastructure spending by the government across different schemes presents immense investment opportunities for both domestic and global investors. Indian infrastructure is at an inflection point, offering size, scale, and superior risk-adjusted returns relative to traditional investment avenues. Please join me at the IVCA Infrastructure Panel discussion, where we will share our experiences and learnings. Look forward.
OGIF or Oman India Joint Investment Fund follows a strict discipline of liquidity first strategy. 6 of our 12 investee companies are liquid. 2 more IPOs are slated to happen before March 31st, 2024, taking our liquid companies tally to 8 out of 12 companies. We have 3 more years left in the fund life. IPO markets are strong, but are very selective in pricing the issue. Good stories attract strong subscription and fair value. I look forward to sharing more with you during the upcoming IVCA Conclave. Thank you.
Hello everybody, I am Tejesh Chitlangi, Joint Managing Partner of IC Universal Legal. We are so glad to be partnering with IVCA as a lead sponsor for the upcoming and much awaited IVCA Conclave 2024. I'm excited to be speaking in the session on private credit and also be a part of the crystal gazing session on the future of financial service regulations in India. With so much to discuss from a legal, regulatory and business perspectives, I'm excited to be moderating the $100 billion private credit opportunity session and also be a part of the deliberations on the future of financial services regulations in the country and how this is shaping up. So really looking forward to meeting you all. Cheers.
Hi friends, my name is Venugopal. I'm partner with Sadhguru Catalyzers, India-focused venture fund that invests across the continuum of life sciences, agriculture, food and health. We at Sadhguru Catalyzers are very passionate about nurturing innovation that has the potential to change lives. Backed by our sponsor, a pioneering life sciences consulting in India over the last 4 decades, we take pride in ourselves being able to provide our investing companies with the strategic guidance and the much needed industry connect to catalyze success. As you all will agree, Indian economy is in a very exciting phase with rapid growth, record deal making and increasing investor confidence. The private capital has become the key driver for this economic growth. In this context, the IVCA Conclave 2024 becomes even more exciting and relevant. We are very elated to partner with IVCA in the upcoming conclave. I look forward to seeing you all in Mumbai this February and discussing the happenings in our industry. See you there.
Hello everyone, at IVCA Ventures we are managing close to 5,000 crores, which is nearly $600 million. The bulk of this capital comes from Indian institutions, Government of India and Alumni Trust, which is IITs and IIMs primarily. Our portfolio is quite diverse, spanning across 45 companies, reflecting our sector-agnostic approach. We invest across the spectrum from seed to Series B with a strong focus on Series A. What sets us apart is our robust alumni network from prestigious institutions like IITs and IIMs, through which we offer unparalleled mentorship and guidance to our portfolio companies. Our success stories like Purple, Clovia, Bluestone, Biryani by Kilo speak volumes of our ability to catalyze startup growth. We have had some significant exits and we have also some exciting IPOs in the pipeline. Personally, I'm deeply committed to fostering domestic capital within the VC ecosystem. At the IVCA Conclave, I will be delving into this topic further and eagerly anticipating sharing insights and engaging in profound discussions with fellow industry leaders. Save the date and join me as we shape the future of Indian venture capital together. See you at the conclave.
Hello everyone, I'm Vivek Soni, partner at EY and the leader of EY's private equity practice. It's my honor to welcome you all to the 13th IVCA Conclave. EY's association with the IVCA has been a long and strategic one. We have been supporting the conclave as the investment banking partner and as India's largest investment banking practice. It's a natural fit for us. We close about 40-45 deals every year. Last year, we did 22 deals which were greater than $100 million. Almost 50% of the deals that we close have something to do with the private equity venture capital ecosystem. Either we are raising money for our clients from PEVC investors, or we are helping PEVC investors as buy-side advisors. And in a lot of cases, we also work with companies which have portfolio companies of PEVC investors, helping them raise money or helping the visions to other investors. Could be strategic, could be secondary deals as well. So I say this with a lot of conviction and inside knowledge that this is a critical event for this industry, as this is one event where you get to meet not just the investors, not just the LPs, you also get to meet the regulators, the advisors, essentially everyone who's connected to the PEVC ecosystem is going to be here. The PEVC community and the sector in India is a very important one. It's almost one of the largest sources of FDI. And so it is one of the greatest pillars of the Indian economy, which is helping the country move towards Amrit Kaal. So in a way, directly or indirectly, this event becomes very important for all of us. And I would urge you all to take out time and attend this event. Thank you.
Sustainable consumption is not just a moral imperative, but also a competitive advantage in today's global market. At IVCA Capital, we believe that sustainability is a megatrend, a trend that is not just redefining our consumption patterns and driving policy changes across the world, but could also fundamentally change the way the companies operate and could potentially alter the global trade route maps. As brands revisit their business models to cater to this shift in consumption pattern and a rapidly evolving regulatory landscape, there would be tremendous opportunities in both debt and equity financing across these value chains. Our ESG First Fund provides non-dilutive capital to small and medium businesses who are operating within such supply chains, not just to adapt and survive, but to benefit and scale from this, what we believe is a multi-decadal fundamental shift. At the IVCA Conclave, I look forward to meeting like-minded investors who are as committed to investing in building a sustainable and inclusive world as.
Hi, this is Amit Agarwal, and I represent Edelweiss Alternatives, which is one of the largest asset managers in the alternatives industry in India, managing more than $6.5 billion. Of this, we have almost $4.5 billion in private credit. We are the pioneers of private credit, and we believe that this industry is touted to be almost $100 billion over the next decade. Private credit provides bespoke financing solutions to its client and helping them grow their companies. We look forward to seeing you at the IVCA Conclave, where I will be sharing my views on the private credit industry as a part of a panel discussion. Look forward to seeing you all at the IVCA Conclave.
Hi all, my name is Ashwinder Sethi. I'm a partner with Analysis Mason based in New Delhi, focus on internet verticals, doing a lot of corporate strategy and M&A work with internet-first businesses. Indian firms in tech-first verticals such as software as a service and AI are actually leveraging their cost advantage and efficient cost structure to build products not just catering to the Indian market, but also for tapping global markets. While the AI and software as a service market, not just in India, but also globally, is a little nascent, but we are expecting that as the market evolves, we would expect a 30-35% CAGR over the next 5 years. I look forward to being part of the IVCA Conclave 2024 as a knowledge sponsor, have very interesting conversations around building from India for the world. Look forward to seeing you there.
Hello everyone. The focus of Everstone Capital is on controlled buyouts and controlled investments across India, Southeast Asia, as well as cross-border investments between India and the US. We have delivered through this strategy one of the best DPIs in the industry. Our 2016 vintage fund has a DPI of 0.9 and our 2021 vintage fund has a DPI of 0.5. In total, we have delivered $1.2 billion to our investors over the last 5 years, which is twice the amount of capital invested. And if we include our co-invests, we have delivered about $2 billion of capital to our investors and co-investors. In terms of focus of our investments, the sector focus has been around technology and healthcare. These sectors allow us to have downside protection while delivering secular growth and also providing a natural hedge towards currency depreciation. That's what we'll focus on over the next few funds as well. Thank you very much.
Hello, my name is David Antalik. I'm very pleased to be joining this panel on behalf of HSBC's commercial banking business here in India, and I look forward to meeting many of the IVCA members on the day at the conclave. Now, I recently joined.
Ladies and gentlemen, we will be resuming the IVCA Conclave in the next 5 to 7 minutes, so request you to complete your meal and come right back to your seats.
चालू कर देगा वो बोल के आज शाम को देगा बल्ले की लाइन में आ जाएंगे वो नहीं पटक जाता मेरा ऑडियो पे काम करना क्या कर मेरे उधर जा जो मालूम मैं देख रहा था मैं देख रहा हूँ जरा वो नहीं होना चाहिए ना एक नंबर पोडियम वीडियो 2 नंबर वाइड है 2 नंबर का फोकस नहीं तो पूरा आउट है बोलो 2 नंबर का फोकस आउट है वापस डिस्प्ले आ गया बोलना डिस्प्ले आ रहा है
महाराज यार शांति बेसवा नहीं देता यार वहाँ पे डिस्प्ले
आ रहा है वापस कॉर्नर पे टाइमर आपने इसमें टीसी ऑन पे आवाज काम करो टीसी ऑन क्यों कर रखा ये पर निकलेगा अरे ऐसा ये टीसी ऑन करके रखो तुम्हारा बैटरी खत्म हो जाएगा उसमें हर बार टाइम चालू करके टाइम बेस छोड़ ना छोड़ दिया पासवर्ड दी ये पासवर्ड दी जाओ नीचे जाओ मेनू जाओ नीचे जाओ और अठवाडिये करे तो नहीं उधर उधर नहीं बाजू में राइट साइड डाउन करो बस आप ऊपर नहीं पहले हाँ इसको फ्री रन को रिकॉर्ड रन कर दो फ्री रन को रिकॉर्ड रन करो क्लिक करो रिकॉर्ड रन करो हाँ अभी बैक जाओ उसके ऊपर जाओ ऊपर 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 बस राइट क्लिक जाओ डिस्प्ले लास्ट करो हाँ पैनल और के ना इसको एलसीडी पैनल कर दो इंडिया में इन्वेस्ट करवानी गया यूट्यूब चैनल ये तो बंद है हाँ तो बंद किया है क्योंकि नया लिंक है वापस क्या पता स्ट्रीमिंग तो चालू ये क्यों बंद है
different playbook for investing and business building. So in the last 12 years, we've raised 4 funds. We've never raised money from India. Happy to share that that's changing this year. As we speak, we're wrapping up our first ever domestic fundraise. It's a special opportunities fund, and looking forward to participating a lot more in IVCA events and in the Indian LP ecosystem. So quick background to this particular report. So as a fund, we are a seed stage fund. So we invest anywhere from inception to Series A in our businesses. And in the last 11 years, we've refined our playbook on both investing and business building in consumer. However, we always felt the need to do a much more exhaustive study of the entire consumer ecosystem. There's a lot of coverage about tech and tech fundraisers, etc., but there wasn't enough focus and attention paid to consumer brands. So we partnered with Bain & Company back in 2022 to do an exhaustive study of all the consumer brands that were founded in India in the last 15 years. And we wanted to distill actionable insights for key players in the ecosystem, founders, investors, and strategics. So we started this back in 2022. We've published 2 papers so far. We've hosted 2 insurgent brand forums, and the response was fantastic. And I'm super excited to be sharing the findings with the IVCA community today. Let me start with the macro. I know the session before lunch was on macro, but for consumer, the most defining trend in the next 10 years is the growth of the upper middle class. Now, if you look at the chart, the upper middle class will constitute more than 50% of consumption spend by 2030. That is the defining trend for us, because the insurgent brands of today, the startups in the consumer ecosystem, start off targeting the premium segments of the society. If you look at the income breakup in 2022, it is the lower income segments that dominate the market. That is the reason why most of the scaled up brands today are brands catering to the mass segment. However, 10 years out, our view is one can build really scaled up brands targeting just the premium segment. And in our experience, we meet consumer founders day in and day out. I miss clarifying, when I'm talking about consumer brands here, I'm talking about brands that sell physical products. We're not talking about vertical marketplaces, etc. And as a fund, we made over 80 investments so far, and almost half from insurgent brands. There are 2 propositions that they offer. Either they offer a better alternative to what is available in the market, like Viba, for instance, in our portfolio. It is a sauce brand which retails preservative-free sauces and lesser fat sauces. Or we have brands that create new categories, like Sula Wines in the portfolio. It created the wine category, and it's a company and investors. So there were 4 key takeaways from studying the initial journey. I'll start off with the first. First one, the fact that brands take time to build. It's a very popular line at DSG Consumer Partners. As I said, brands aren't tech businesses and they don't blitz scale. Please look at the gray chart on the slide. On an average, it took 6 years for a consumer brand to get to 75 crores from inception. That initial phase requires that patience and calibrated approach, and it's important to build the foundations of the business in a really solid manner. And then, now I would request you to look at the chart on the right, which is the good news. Once you are past the 75 crore mark, the compounding is a lot faster. The journey from 75 crores to 200 crores typically needed another 2 to 3 years at best. So it's all about laying the foundation well, pursuing a very calibrated growth trajectory in the initial years, and then you reap the rewards as you go past that 75 crore inflection point. You know, when I compare this to the startup pitch decks that we normally receive, founders, you know, are in a rush to get to the 100 crore mark in the next 3-4 years from inception. So I would urge founders and also investors to not, you know, chase unrealistic growth, especially in the initial years. Rather focus on fundamentals and set up the business in a way where it can compound over the long term. The next thing we did was we looked at all the brands that had gone past that 75 crore mark, and then we wanted to filter the brands that are on a very good wicket in terms of growth trajectory and business fundamentals. And we again studied the patterns in the ones that have, you know, done a really good job. So there are two axes in this chart. The y-axis is the revenue growth rate, the last 3 years CAGR, and the x-axis is capital efficiency scale. So capital efficiency is a very important metric that we monitor at DSG CP. It is our stake on the return on capital employed metric that late-stage investors use. In our experience, let me define the metric first. You know, capital efficiency, we define it as revenues of a brand divided by the cumulative capital consumed by that brand till that point in time. So if you're at 100 crores revenues and you've burnt 50 crores of capital to get there, you're at a capital efficiency of 2x. In our portfolio, the good brands are at a capital efficiency of 1.5x or higher, and that is the threshold that we have taken for this exercise. So we filtered the brands based on a 30% revenue CAGR and a 1.5x capital efficiency. And we had 18 of those brands, and we looked at their journeys from inception. So 3 interesting lessons. The first one was on gross margins. The chart here normalizes the gross margins of these brands, you know, to ensure that, you know, we can derive insights out of it. And the main trend that you see here is that gross margins are flattish from year one. We've seen our brands fight the downward pressure in gross margins with competition, with the pressure to grow. The best brands have managed to hold their gross margins over time. So this chart is a great validation of the maxim that brands die with the gross margins they're born with. So it is important to pay attention to gross margins from day zero itself. The next one was on EBITDA margins. You know, as I said, if I look at the scaled up brands in our portfolio, be it Sula wines or Viva sauces, they got to profitability and scaled on the back of operating cash flows. So for us, this EBITDA margin of negative 25% is an important milestone in the journey towards profitability. So we plotted the profitability of each one of these brands from inception to current date. And when we plotted the chart, it was fantastic to see how consistent the trend was. You know, every single line there fits into the top and bottom dotted red lines. So what it essentially means is every one of those successful brands got to EBITDA minus 25% or lower losses by year 4. In fact, most of them got there by year 2 itself. And this EBITDA minus 25% threshold is a great framework to think about, you know, the growth versus profitability trade-off. You know, that's something that founders and investors grapple with. When you are in that zone, typically the unit economics has proven out, and the founder is on top of levers that will take the business to profitability. So main takeaway, drive the business to EBITDA minus 25% as soon as possible, ideally by year 2, if not by year 4. And the last takeaway from the initial journey of the brands. This is on capital efficiency. I just explain how we calculate the capital efficiency metric. We plotted the capital efficiency of every single brand from inception to current date. And what you see in the graph is, in every single year, the median value of the capital efficiency was higher than the 1.5x mark, the threshold that I just spoke about. In fact, the best brands in our portfolio do far better than 3x in capital efficiency. So this chart, again, goes to show that consumer brands do not need a lot of capital. You can drive the business to profitability, and founders can essentially take control of destiny and not depend on external capital beyond a certain stage. So I'll quickly refresh the 4 main takeaways from the initial analysis of the initial journey of these brands. The first is that brands take time to build. On an average, it takes 6 years to get to the 75 crore mark. The compounding is faster after that. The second is on gross margins. Pay attention to gross margins early. You die with the gross margins you're born with. The third is on EBITDA margins. Strive to get to the EBITDA minus 25% zone as soon as possible in your journey. The best brands got there, ideally by year 2, if not by year 4. And having a capital efficient mindset right at the beginning is a great place to be. All the successful brands had that. Now I'll quickly cover the focus of the second research work that we did earlier this year. And the focus was on consumer exits. There's a lot of coverage, talk about fundraisers and valuations, but the real proof of pudding is exits, and by that I mean cash exits for founders and investors. So this year, we looked at all the exits that had happened in consumer in the last 15 years, again to distill actionable insights for ecosystem stakeholders. And I'll jump into the main takeaways. Again, I'm just giving you a quick snippet of the work that we've done. If you're interested, we have the whole report, and we'll share that with the participants later. So the first insight was the fact that M&A exits are the most common exits in consumer. Of the 160 exits that we tracked, 85% were M&A exits. The good news is the activity is picking up. Between 2020 and 2023, we had 100 consumer exits. That's almost 2x the number of exits that happened in the 10 years before that. And the interesting thing is you have new participants as acquirers in the ecosystem. It's no longer just the large strategics. You have startups like Nykaa acquiring, and you also have buyout funds acquiring consumer brands. So it's a great sign of the ecosystem maturing, and and the possibility of exits for early stage investors and founders. The next big headline was that consumer brand exits are not unicorn outcomes. As I started off saying, consumer brands aren't tech businesses. So we had looked at the enterprise valuations of all the consumer exits that happened in the last 15 years. And 90% of the consumer exits were not unicorn outcomes. If as you can see in the graph, it has enterprise value on the y-axis and time to exit in the x-axis. Most of the exits happened in the 0 to 50 million enterprise value mark, and almost all of them happened in the under 300 million enterprise value mark. So, what this really means is founders, you're better, we live in a probabilistic world. It's better you solve for a strategic exit in the initial journey, especially till that 300 million enterprise value mark. And if, we interviewed a lot of strategics, and the main input from them was what they care about is not top line, but capabilities they are acquiring and market share, either in a particular product category, geography, or channel. So it's important to build the business in a very focused manner till you're in that 300 million mark. And as you go past that, then you can think about an IPO, focus on profitability, add new product streams, etc. The usual mistake we've seen founders do is spread themselves too thin in the early part of the journey, which could leave them in no man's land. So that is the big takeaway. These are not unicorn outcomes, and you're better off knowing where you are likely to exit, which is in the sub 300 million mark. This is my last slide. So that said, the good news is, while it's not a unicorn outcome, founders have had some amazing exits despite 5% of brands that exited had more than 60% founder stake in them. This again goes to show that brands can be built in a capital efficient manner. Just in that 200 to 300 million enterprise value we spoke about, we had founders cashing out north of $100 million. That is far higher than founders of tech unicorn companies. So, net, brands can be built in a capital efficient manner, needn't be dilutive. And as investors, one should ideally, our recommendation is to avoid over-capitalizing brands in the pursuit of unrealistic growth. We are in a market with massive tailwinds, so just building a business in a fundamentally strong manner and building a business with a view to getting it to profitability will be good for the ecosystem, and everyone can create great value in that process. So that covers my presentation. As I said, there are a lot more takeaways. Do reach out to us at DSGCP, and we also have a video walkthrough of the presentation on our website. Thank you so much for your time.
Some great insights gleaned there, talking a little bit more about how the insurgent brands have been growing, as well as how it takes time to build a brand. And I'd like to invite on stage then Cecilia of Visceral Capital to present Hariharan with a certificate to show our appreciation. Please go in the center of the stage. All right, thank you for that. Let's move right on then. And we've got a presentation lined up yet again. Aditya Muralidhar, Associate Partner at Bain & Company, is joining in and here to talk a little bit more about the valuable take on the PE VC landscape in India. Aditya, welcome.
Excuse me?
The presentation is going to come on here? Or?
Perfect. You can hear me back there? Hi, wonderful. Good afternoon, everyone. My name is Aditya Muralidhar. I'm an associate partner at Bain & Company, and I work in our financial investors practice. I'm thrilled to share with you the key insights from our upcoming private equity and venture capital reports. A sneak peek, if you may. These are our yearly publications that delve into the events in the past year in the landscape, examine the emerging trends in the field, and also offer some insights on what lies ahead in the upcoming years. So over the next 15 odd minutes, I'll start by examining the investment activity that we saw both in the private equity as well as the venture capital landscapes in India. I'll follow that up by talking about the fundraising activity and what that revealed about the investor sentiment. And finally, I'll briefly touch upon how investors approach exits and what key themes stood out over there. So in 2023, about $39 billion worth of funding were deployed in the Indian market. This was about 35% to 40% lower than what we saw in 2022. This was a reversion to the pre-COVID levels of investment and was primarily driven by a weak macroeconomic sentiment, persistently high rates, and just buyer-seller mismatches in valuation expectations. But that said, despite this compression that the ecosystem saw, India maintained its status as the second largest funding destination in Asia Pacific. Now, looking at the deal flow a little bit more closely, private equity deal flow comprised about 3/4 of the total and showed more resilience compared to venture capital investments. To put this in perspective, private equity deal flow shrank by about 20% over 22-23. But in contrast, venture capital investments saw a much sharper decline by about 60% over the same time period. I will throw a spotlight on the venture capital and growth equity investment subsequently, right after I touch upon the overall landscape key messages. So the ecosystem fundamentally was impacted by diminished deal making, and there are a couple of key factors that drove this. Firstly, the macroeconomic challenges prevented companies from demonstrating the levels of performance that investors sought. And secondly, lagging valuation corrections also meant that there was a mismatch in the valuation expectations between the buyers and sellers, which further impacted deal closures. I'll stay on the same slide and just talk a little bit about our observations from a sectoral view. Traditional sectors, so I'm referring to consumer retail, healthcare, manufacturing, showed more resilience over 22-23 compared to new age and tech-first sectors. I'll take a few examples here. Consumer retail and healthcare saw buoyant deal flow, increasing over 80% and 30% respectively. Now, in consumer retail, of course, the mega Reliance retail deal did offer some uplift to the investment activity. However, if you look at the momentum, it was underscored by a positive outlook on just consumption recovery happening, longer-term income growth, as well as just organization trends in the sector. In healthcare, investments reached a record $5.5 billion, primarily driven by provider deals. Now, before I jump into the new age sectors and the tech-first sectors, I'll hit upon the key messages on the venture capital and growth equity funding. So as I mentioned, in comparison with private equity deal flow, venture capital and growth equity investments saw greater impact and totaled about $9.5 billion in 2023. This was about a third of the levels that we saw in 2022. Deal volumes halved in venture capital and growth equity, and this was primarily driven by investors deploying capital more cautiously, more selectively. But we also saw several scale, well-funded, well-capitalized startups deferring their fundraising in a valuation challenged environment. What that drove was greater compression in later stage deals, while early stage seed deals stayed more resilient. And interestingly and importantly, in 2023, we saw the continued participation of family offices, corporate venture capitals who provided critical early stage capital in an objectively tight funding environment. Again, I'll stay on the same page as I talk about some of the sectoral trends here. Now, consumer tech, fintech, and SaaS continue to attract the majority of the VC and growth equity funding, but each of these key sectors witnessed sharp declines in funding. To take an example, consumer tech as well as software and SaaS saw 70% declines in their funding over the year, and this was driven by investors continuing to maintain strict thresholds on performance that they expected from their companies, looking for robust unit economics and paths to profitability, while on the other side, these well-capitalized scale startups deferred their fundraising, focused on managing their burn and extending their runways. However, amidst these declines across key sectors, there were green shoot sectors that displayed resilience and promise for the year ahead. I'll cover a couple of them in a bit of detail today, the first being generative AI, which is all the buzz. Generative AI investments surged 17x on a small base to amount to approximately $250 million in 2023. This was primarily directed towards generative AI apps. I'm talking about software platforms that incorporate generative AI capabilities in their core proposition and functionalities. Even looking ahead, the Indian generative AI landscape is expected to be dominated by applications, given we are seeing very convincing early signs of strong development activity. And secondly, India has a very deep talent pool that innately understands software and tech workflows, given our legacy in this domain. Now, looking at electric mobility, the second green shoot sector I wanted to highlight, the sector attracted, or the ecosystem attracted, about $600 million in funding, just a notch lower than what we saw in 2022. This decline was primarily seen in EV OEM segment, which saw headwinds due to uncertainty on the FAME subsidies outlook. But that said, the growing investor sentiment in this ecosystem was evident across the other core value chain segments. So for example, if you look at batteries or charging or auto components, there were sizable jumps in funding. Even looking beyond the core value chain at segments like EV battery recycling or EV financing, 2023 saw deals being struck. Taking a longer term outlook, it looks positive for the ecosystem as it's well poised to unlock a $100 billion revenue pool by 2030. Structural commercial tailwinds are expected to continue. For example, introduction of affordable EV options, deepening of charging infrastructure, distribution to non-metro locations, and exit prospects via strategic deals is expected to remain strong. Now, taking a step back, the VC ecosystem was buffeted by several challenges, but what we observed was stakeholders adapting to these shifts and to the apparent new normals. I'll talk through a few examples across stakeholders. So if I look at investors, there was a perceivable shift in investment paradigm to more traditional sectors, and selectively these were sectors that had the benefit of strong consumption headroom along with strong formalization trends, along with strong tech enablers. Investors also drove a step shift in governance in 2023, bolstering the governance rails across the deal life cycle. Now, if I look at regulators, regulators continue to push on digital infrastructure, both to drive product innovation as well as ease of doing business. Regulators also establish standards to drive green shoot sector growth. A good example here would be BIS approving the combined AC/DC charging connector standard for LEVs, which is expected to drive adoption in the longer term. And finally, startups visibly hunkered down on profitability, with several notable startups across sectors announcing that they turned green in 2023. But amidst this tightening of belts, we also saw continued investments in deep tech innovations such as in areas such as generative AI infrastructure, climate tech, space tech, and aerospace as well. Now, I'll shift gears to fundraising. 2023 saw robust fundraising activity both on the private equity as well as venture capital sides. I'll take them one by one. Starting with private equity, domestic GPs raised about $2.5 billion in 2023, which is broadly in line with what we saw in 2021 and 2022. And importantly, this level of fundraising is a notch above what we have seen in previous periods. Interestingly, several leading homegrown GPs announced that their next fundraise will be 30 to 50% higher than what their previous largest fundraise was, demonstrating optimism in the ecosystem. Global GPs also demonstrated very similar optimism, with several recently indicating that they're looking to increase their rate and quantum of deployment in the Indian market. Shifting to the VC growth equity side, $4 billion were raised in 2023. And if you take a longer view and not to be biased by the 2022 watershed year of $8 billion of raising, it is probably one of the highest that the ecosystem has seen. 10% of the funds raised were by domestic or India-focused GPs. A quarter of this were maiden funds, and there were several thematic funds focused on emergent themes such as sustainability and climate tech that came up in 2023. All of these are extremely strong indicators of the deepening of the ecosystem as well as the persistent optimism in the market. And finally, exits in 2023 remained buoyant, amounting to approximately $28 billion as GPs sought to return liquidity to their LPs. While the value increased by about 15%, there was a step increase in the total exit volumes, which reached about 335, which is a record high for the market, soaring 60% over the last year. Public market exits were the majority mode of exits for the investors. And even within that, it was primarily driven by the trade of listed securities as opposed to IPOs. And IPOs were a minority, quite similar to what we saw in 2022. And interestingly, the surge in exits was primarily seen in new age tech sectors such as consumer tech and SaaS. And a lot of the large exits in these domains were led by crossover funds who had previously focused their investments in these spaces. And with these sneak peeks into our upcoming report, I will conclude my presentation. The venture capital report is due to be launched mid-March and the private equity report mid-May, and both of them will contain a lot more details on the topic that I touched upon today. And I'm eager to keep the conversation going, so if you have any questions, do feel free to reach out. My name is Aditya Muralidhar. Thank you so much.
Thank you so much for that. Let's get a move on then. We've got some great panels lined up in the second half, so time to get straight to it then. Now, in alignment with India's unwavering commitment to environmental stability, the Prime Minister himself has outlined a comprehensive agenda for a greener future with a visionary 5-point agenda. This emphasized the need to achieve net zero emissions and reduce carbon intensity. Building on this dedication for these goals, we've got a panel that's going to talk about the role in accelerating transition to the sustainable and green living. Let's welcome on stage Abhishek Mittal, partner at IVCA Capital. We've also got Akhilesh Tilotia, who's the head of research and chief of staff to the CEO, National Investments and Infrastructure Fund, or NIIF. Welcome on stage Anjali Bansal, founder, Avana Climate and Sustainability Fund. We have Raj Pai, founder and managing partner at GEF Capital Partners. Sophia Nadur, who's the managing director, Rest of the World and Europe at BP Ventures. Satish Mandana, the senior managing director and chief investment officer at Eversource, who is the moderator for this discussion. The topic of discussion, ladies and gentlemen, is Decarbonizing India, accelerating the transition to sustainable consumption.
Good afternoon, everyone. And after the lunch, this is an interesting session. You had a dose of good statistics and figures to raise the excitement. And we're going to talk about something which is the biggest threat as well as the biggest opportunity for the mankind, and that's climate risk. And how do we accelerate the decarbonization is what we're going to discuss. And we have a set of panelists over here who have been doing great in relation to this particular objective through their own organizations. And by way of introduction, I'll request each of my fellow panelists to take 30 seconds to talk about giving their own introduction very briefly about the firm. And then we'll come to the actual discussion. So may I request first Akhilesh to start with.
I didn't realize this is the head start that I'm taking. Hi, good afternoon. Akhilesh Tilotia. I am head of research at National Investment and Infrastructure Fund. NIIF has a very strong green mandate, and we'll talk about many of the decarbonization strategies. Very recently, we also announced the Indo-Japan Fund, which is a green fund, but even in our master fund and fund of funds and a strategic opportunities fund, we have focused significantly on decarbonization. We work very closely on policy-related aspects too. We'll come to some of those too.
Hi, I'm Sophia from BP Ventures, Managing Director. We invest in visionary founders who are helping to accelerate the energy transition. We spend about $200 million every year, and we've been increasingly investing in India. We invested very recently in Blue Smart and Magenta, and as well we're looking to do more investments in mobility, in hydrogen, bioenergy, and anything which helps in sustainable consumption for both businesses and consumers.
Thank you.
Good afternoon. I'm Anjali Bansal. I'm with Avana Capital. We manage India's first thematically focused early stage fund investing in technologies that solve for 90% of India's emission footprint. So we are a thematically focused climate tech fund, Havana Climate and Sustainability Fund. We look at areas in energy transition, supply chain mobility, industrial decarbonization, circular economy, and of course agriculture, because you cannot think about climate in India without thinking of agriculture and water as well. We go in early, we do pre-Series A, Series A. We work very closely with our founders over their journey, helping them build the playbook, doing a lot of corporate connectivity because adoption at scale happens in industry, and linking it up with catalytic finance as well as our large research and development and policy ecosystems. So that's what we do. We follow the mitigation, adaptation, resilience, filtering framework from COP, and very inspired by Honorable Prime Minister's Panchamrit framework that he laid out at COP26.
Thanks, Anjali.
Thanks, Raj. I'm a partner with GEF Capital. So GEF is a global private equity fund investing primarily into the climate sectors. Speaking just from an India perspective, I think it's been a real privilege to be investing in climate segment in India for the last 14 to 15 years, just spanning from our first fund in 2010 to our fund 3 we just closed last August. So we have raised about $700 million of commitments purely for the Indian decarbonization play. We have invested in about 17 companies, which I'll speak to in the next round about, very interesting spanning, as Anjali said, from across the spectrum, from power generation, transportation, food and agri, and also industrials. I think that's one of the sectors I'm also very passionate about. So happy to expand on that. Thank you.
Hi everyone, this is Abhishek from IVCA Capital. We are a 20-year-old firm, basically investing in impact businesses. Predominantly known for our equity practice, but we entered private credit 2 years back with the ESG First Fund, a Luxembourg-based fund which with sustainability as its core focus area. We are about to launch our first domestic private credit fund, once again focused on sustainability.
Thanks, everyone. And my introduction is I'm Satish Mandhana. I represent Eversource Capital, which is India's biggest climate-focused fund manager. And coming to the topic of accelerating decarbonization, and each of my panelists is going to talk about one single thing which will make the big difference and what exactly is being done by their own firm in relation to accelerating decarbonization. But decarbonization will not be possible without mass participation, and which means that every corporate and every institution and every individual has to be participating into this journey. And we'll be making a small recommendations from here to all of you in relation to that. The first recommendation is that if you can persuade your own organization and organizations related with your organization to declare their net zero year. It's just a simple question, asking corporate to declare by what time they intend to be a net zero organization. This will start making them think around decarbonization, if not anything else. And with that, now I'll request, starting with Abhishek, to talk about one single thing which will make the biggest difference in this acceleration and what exactly is being done by his firm in relation to decarbonization and accelerating decarbonization.
Thanks, Satish. I was dreading it when you started with Akhilesh, right? So, for us, the theme is around sustainable consumption, but, I often say, the most sustainable way to achieve sustainable consumption is responsible production, right? So, for around consumer, if you look at 4 value chain players, right? There are brands, who are committed to produce sustainable products and services, then there are manufacturers, and then there are supply chain players who feed into this manufacture, and third, then are ecosystem enablers, right? People who are, finance providers, traceability solution providers, etc. So for us, given that we are a credit fund, right, so the big theme lies the manufacturing as well as the supply chain. An interesting statistic, right? So, for corporates, their indirect emissions vis-a-vis direct emissions are close to 11.5 times. So you really cannot clean up production if you clean up the supply chain. So for us, on performing credit side, we see a huge opportunity on supply chain financing, right? Essentially helping the...
And we are more of a growth investor, so we invest between $10 to $40 million checks. So transportation is one of the best sectors to decarbonize, e-mobility, because it gives you 2 benefits. One, of course, the lower, greener fuel, but also the tailpipe emission, which is the #1 cause of pollution, right? So we have been very active in investing in I would say all the way back in 2008, India's first EV company, Reva, to the last few deals we have done with the Hero Motors and Ratan Tata Group and all of those. So I think that's a great sector. India is looking to increase its presence in e-mobility from 3% to 30% by 2030. So you can just imagine, as an investor, that's a 10x growth opportunity. The third sector, again, with the interest of time, I'm very passionate about is the industrial sector. Satish, you mentioned about net zero. I think there's no sector that plays more meaningful contributions, a thing called the green hydrogen. I think it's still a few years away, but it's very exciting because when you look at sectors like steel and cement and refineries, which normally people don't think about these sectors when you talk about decarbonization, but these sectors will have to substitute a lot of the fossil fuel to other green sources, and green hydrogen is going to be, at least we believe in the next 5 years, is going to come mainstream. So these are some of the themes that as a firm, we are very, very bullish about and looking at it for the next 5 years. Thank you.
Thanks, Raj. And before I go to Anjali, another recommendation from our side to you. Raj talked about biofuels, which is going to be a kind of a big area commercially as well as from a sustainability perspective. And it cannot be achieved without having a practice of source segregation of the waste. A simple step of source segregation in your household can make the difference. India has done it in the city of Indore. The whole city segregates the waste into wet and dry, and we have India's biggest biogas plant consuming 500 tons of the waste every day and producing 15 tons of the biogas. So just as a matter of information and also as a matter of request that source segregation influence to the extent possible. Come to Anjali now.
I'll pick up from where Raj left off. I think all the sectors he mentioned are the ones that will drive reduction in emission. So India, of course, we have got our NDCs, 2070, net zero, and so on. I also serve, in addition to Avan, I also serve on the boards of Tata Power and Nestle. And there we see the big change Raj referred to. There are segments in the energy transition space which are well on their way. And utility scale solar, renewable, round the clock, the new bids that are going out are actually fixed dispatch RE, which means round the clock at a fixed price. So it's hybrid. It's solar, wind, renewable, and storage. Similarly, we see in the sustainable food supply chain, a lot of R&D, a lot of work on packaging. So what is missing and why? We are very excited about new technologies. So if you go back, when plastic was invented, it was actually a miracle material. It helped to extend shelf life for food. It helped to feed millions. The world was reeling under famine and poverty. So food security was a big issue. Today, we are trying desperately as a society and as markets and economies and companies to move out of plastics. What's the barrier? Not because companies don't want to or people don't want to. It's because we don't have an alternative. And that, friends, is really the biggest case for investing behind technology and innovation. Why is solar today cheaper than a new unit of thermal? And the adoption of solar has happened because it makes business sense, not because it's just good for the planet. So while, yes, good for planet, companies will adopt strategies, consumers will bring it into life, and Honorable PM launched Life last year. But really what matters is making it commercially viable and scalable. And consequently, investment in technologies, innovation, both product and process, is super important. Take the Global Biofuel Alliance, which got announced in G20. So coming out of G20, COP28, last week was Raisina, 3,000 people descended on India, talking G2G. So there is so much momentum to invest in new solutions which don't exist today. Energy transition, what is required is grid-scale storage, pumped hydro, battery-enabled, battery energy storage systems. Policy is a big enabler. EV transition is happening because policy actually enabled it with FAME 2. We are seeing, again, the trickle-down effects, if you will, of the PLI schemes in solar, in hydrogen, in biofuels, and so on. And it's all coming. So bringing together what is happening in new technologies, climate-resilient agriculture. We have a company called IVCA Foods that is growing tomatoes at 10 rupees a kilo in Kota, for example, right? That's kind of the future of food production. And this is at industrial scale. So while we think about consumption, recognizing our consumption footprint in India is very small. It's 1/40th that of developed countries. So really the way for us to get to a very vibrant and even more vibrant economy 75% of the infrastructure that is in our national infrastructure plan for 2047 when India becomes 100 is not built today. Big opportunity in built environment, right? So let's build it right, let's build it green. New investment required in technology and innovation in all of these spaces, and that's the opportunity.
Thanks, Anjali, for saying build it right and build it green. And as rightly pointed out, 75% of India is yet to be built. We have to go to 30 trillion by 2050, and much more than 75 to be built now.
And may I just add, you know, for a $3 trillion economy today, 3.4,
right,
going to 10 trillion, which will happen in the foreseeable, very near future, every sector will grow. So whenever I'm asked, you know, what sector will grow, I say every sector will grow. You just have to figure out how to grow it green and pick your winners.
Right. So coming to my friend from Shell, BP Ventures, please go ahead.
Okay, so many of you know BP or Castrol. The brands have been around in India for over 100 years. So in February 2020, BP made a declaration it would go to net zero by 2050. Now, and it's not just around BP, but also it would help the world to get to net zero. And so one of the things I did when I started coming regularly to India was to actually, many of you in the room, including IVCA, I came and sat down, we also spoke. I spoke with a lot of people on this forum and in the audience about what do you need, what is needed to help India get to net zero. How can a little corporate venture capital firm help? And we listened. And we knew one of the low-hanging fruit for the energy transition was mobility. And we invested in BlueSmart, which at the time, under the cover of COVID, when they were not earning any money because everybody was stuck at home, we invested in BlueSmart because we believe that they are one of the disruptors. And they are proven to be one of the fantastic companies helping to make ride-hailing much more clean, much more sustainable, and also a very good customer value proposition. We're doing the same thing with logistics because we believe that as India, and this topic is around sustainable consumption, as India will become the second biggest e-commerce marketplace in the world, how do you make sure that you're not stopping the growth, but you're doing it in a way that is sustainable? And so one of the second things we did in terms of low-hanging fruit is invest in a last-mile logistics platform. And that as well has helped to ensure that all of the OEMs are now putting more and more money into electric three wheels and also four wheels and trucks to be able to ensure that you've got the products available to move goods much more sustainably to where they need to go. And so that has been sort of a very early stage premise for how we're looking at the Indian market. We agree. It is going to grow, and there's nothing we can do. And actually, it's very good. Why should people in this country not live or not have the same sort of life that other people have? Well, how do you do it in a much more sustainable way? And so we are investing. We're usually the first institutional investor, but of course, we will get guidance from other folks as to how do we do this in a way that ensure that all the stars in India or the young entrepreneurs who have really, really world-class cutting-edge tech get the platform to be able to scale up. And we're doing it in hydrogen and in bioenergy. You'll see some announcements, hopefully this year. And we're also looking at other parts of the value chain around energy transition, because we think that there's no reason why that India can't grow, but grow and be an example to the world in terms of sustainable consumption.
Thanks, Sophia. And let me come to Akhilesh.
So now who had the easiest thing? Coming after 4 people, I think most of the sector can come in a wide variety of ways. Whether it is through mandates, that's something that we have seen work out in a few sectors. Whether it is through targets, and Satish, you mentioned about net zero 2070. If I can make a slightly controversial point about trying to come to a specific number for the year, I think countries like India, which are trying to figure out the pathway of bending their curve, need not overtly commit very quickly, and companies therefore also need not overtly very quickly commit, because a lot of change is yet to happen. And if we commit ourselves either to specific pathways or specific technologies, we may realize that some of these things could become large chunks of capital. So I think as we think through our policy response from the government as well as from the investing side, we should be conscious about the speed of change that is taking place. What is the sort of policies that we want from the government, whether, as I said, it's mandates, targets, viability gap funding, or any different type of market creations and regulations that you want to pull together. And there, I think there is a role that industry forums like IVCA can also help put together. Thank you.
Thanks, Akhilesh, and for bringing out the policy perspective, which is extremely important for this acceleration to take place. And obviously, we have seen the good results in e-mobility, particularly with the FAME 2 program of the Government of India, where the policy support came into the picture. And also, now there's a heavy policy push around the rooftop solar by the Prime Minister, and which will probably make the big impact going forward. So I think we had a first round where the opportunities and what one thing or what can be done to really accelerate the decarbonization. Now I'd like to ask each fellow panelist to talk about what's the one big challenge they feel will come in the way going forward, and let them have very briefly the perspective about what will be the biggest challenge they would think will be there in this whole decarbonization journey. And I'll start with Abhishek this time around.
No, thanks, Satish. So, see, just to add to one of the things that Akhilesh spoke about, right, the impact capital, right, the ability to, for sustainability-led investors to bring in capital which is catalytical, right, that's something which is, you know, for example, in our case, I spoke about a Luxembourg-based fund that actually provides first loss capital in a way, right? So we can actually bring in investors who, you know, get capital protection or essentially get first loss benefit from the investor because this capital comes from a sovereign. Now, the challenge that we see in, you know, while there is so much capital available for sustainability and for credit, but Indian regulation doesn't allow you to create first loss structures, right? So that's a challenge, right? For us to be able to, there's capital available, willing to catalyze a highly impactful move, but you know, regulatory restrictions don't allow for something like this. Second thing is, again, you know, one big challenge is the taxation, right? So, you know, the government has done bits and pieces, but for investors, there are no real tax benefits available for investing in a sustainability-led, right? So if you're a, you know, if I'm a credit provider and I am able to raise domestic capital for sustainable businesses, can I extend some sort of a tax benefits to these investors? Because the constituency...
With the rest of the others as well, we will be about a 10 trillion economy in the next, by 2030. But why is it exciting? Because that also dovetails very closely correlated with the capital market. So as a lot of the GPs here, so I've seen times where 5-6 years where there were no prospects for any mid-market companies to go IPO. That has changed dramatically, and that's changed because the domestic capital going into capital markets. So for investors, creating viable exits consistently is very important. So that's my key thing. You know, we've been very lucky. We have had 4-5 IPOs. We are looking at a couple of IPOs this year, but we need to show evidence, commercial returns to make this sector mainstream. I think that's my only key point here.
Thanks. Anjali, please.
I think we require enormous amounts of capital, and it is but a trickle right now. There's lots of conversation about 100 billion required per year, total of sort of $3+ trillion required for India to decarbonize and so on. One thing that we have to recognize, not people here in this room, but globally, is climate is a globally interconnected system, and India is integral to any global climate solution. We are the third largest emitter, the largest population, the fastest growing large economy. We have many things working for us. We have a very technology-driven population at this point, young, third largest startup ecosystem in the world, and so on. So we will come up with solutions. So the two things I want to point out here, one is cost of capital. India is, at least for many of us, we feel unjustly burdened with a very high cost of capital. At a project level, many projects are viable, whether they're utility scale or not, or smaller, particularly in the MSME segment. While at the project level, there is viability. When you add on foreign currency, hedging risk, country risk premiums, and so on, they start moving into unviable territory. So there is at the global level, whether it's MDBs, DFIs, there's structural rethinking required on cost of capital for India. That's one. which leads us into blended finance stacks. The green capital stack that we are talking about, and Akhilesh, I know I'll request you to actually comment on this because you study it so much and write about it. We need to bring in many different tiers of capital. You need that deep patient risk capital to establish playbooks for the early stage technology innovation and business models. Waste aggregation is an example. But going forward, then you need equity, you need debt, and eventually you need that full blended finance, first loss, and new products that don't exist today. So that's on the capital side. The second piece that is required is a much stronger South-South dialogue. Today, the climate discourse gets broken between mitigation and carbon, which the North focuses on, and adaptation and resilience, which is the India, as a representative of the global South, our everyday reality. So that discourse, as an industry, in whichever forums, IVCA and otherwise, lots of other forums, and I know we all talk about it a lot, but bringing adaptation into the discourse for solutioning beyond mitigation, and all the work that needs to be done around that.
Thanks, Anjali. Quickly to Sophia.
Okay, I'll just say that decarbonization is not solved by launching an app. It's really, really hard. And what I would add to whatever has been said just now is collaboration is key. And it's collaboration with unexpected bedfellows are going to help ensure that decarbonization is sustainable.
Thanks. And Abhi.
Thank you, and thank you, Anjali, for the plug on many of the articles. I will leave the audience to the articles, but I think I'll just add one point on where challenges can come, and let me keep to the policy stance. I think globally policy on green and decarbonization continue to move in step jumps. Anjali mentioned this point about mitigation being the global North issue and adaptation for the global South. Even global North continues to waver when it comes to what is the right pathway, what is the timing of the pathway, what is the quantum of the pathway, etc. This is a year of many elections, and I think by the end of this year, the global policy landscape on things like green and climate could potentially begin to alter. We are beginning to see that sort of a pushback come in countries like America already. If we end up in a situation where this goes off the agenda, this will have ripple effect all the way through into capital countries like India, which require capital from the global market. Thank you.
Thanks. So I think we had an interesting set of points of views. It's coming to an end. We'll have one question probably. But before that, I just want to point out something in relation to the sustainable consumption. I look around, every table has got lots of plastic bottles, including on the panelist side over here. But there is one bottle which is without, there's somebody with one bottle without plastics over there. And I think in a sustainability panel, it's good to see somebody being conscious around environment and bring their own water, own bottle to the conference over here. So maybe give a high hand, and maybe if you can stand up, may I request you to do that? And that's something good. Yes, great. We have a time probably for one question. Officially the time is out, but we can have 2 minutes. So can we just have some question to the panelist? Anybody wanting to have a question? I'm more than happy to close the. Okay, Clarissa, probably somebody can give her a mic.
Thank you. I'm Clarissa DeFranco. I used to be at BII, and I'm working with a company called Allied Climate Partners, who's trying to tackle exactly the problem about how do you get more capital into investing into the climate space with fund managers, and the importance of blended finance structures. Given that many of you have raised the issue of the lack of regulation that allows foreign investors to participate in that in an Indian context, what do you think can be done, and who should institutions like mine be looking to engage with to be able to shift that discussion to a more fruitful one to enable that to get unlocked?
So who would like to answer that? Maybe Akhilesh yourself first, and then if somebody wants to supplement.
No, I think Abhishek made this specific point about a specific regulatory dispensation that we currently have, which has its own history as to why we do not have differentiated capital rights for investors. I think it is a time for us to think about how this can be crafted in a manner that the regulator is comfortable with the sort of capital coming in and it not being in a sense, the regulatory dispensation is not misused for some of the things that the regulator is concerned about. So I think it's a sit-down conversation that we need to have the regulator on this specific topic.
Yeah, so I think add to what he said, the forums like IVCA, FICCI and CII, which represents the industry bodies as well as the practitioners in this country, have to have an interface with the government in the context of a larger objective and have to find ways and means to ensure that the provisions which needs to be relaxed are not getting misused going forward, and technology can help in making that happen. So hopefully it should happen, and we have seen lots of policy changes positively in the country with the efforts being made, and the dialogue needs to start on that front now. Thank you. Thank you everyone for being listener, being present. Thank you, bye.
Thank you all for that. Clearly aiming to contribute and capitalize to India's journey towards a more environmentally conscious and resilient future. And I promise you I had my own water bottle. I left it in the car. That's the only reason that these are here. But I would like to invite on stage Luisa Munareto, who is the founder Tech IA Impact Invest, to please come on stage and present our panelists with a certificate for their valuable contribution. Ladies and gentlemen, put your hands together for our panelists this evening. Thank you all for that. A quick photo op, and then request you all to take your seats. All right, let's keep it going then. And next up, we want to put the spotlight on India's economic growth. As we're on track to become a $10 trillion economy in the coming years and secure the third largest slot globally, India's resilience amid the fragmented and polarized world has been noteworthy. Be it our economic reforms or even the digital competitiveness or India's ability to attract foreign direct investments. And we want to delve deeper into this topic. We've got now, ladies and gentlemen, a fireside chat. 20 Saal Baad, a story of resilient India. So join me in welcoming on stage Viren Raskina, who is the former Indian hockey team captain and managing director, as well as a CEO of Olympic Gold Quest. We've also got Srishash Devadri, who's a parachuter, Anish Patnaik, Chief of Partnerships Officer and founding team member, and Mas, who will be moderating this discussion. Thank you all for being here. Over to you.
Hello. Hey, thanks. Hi, everybody. So I figured through the course of the day, we've been talking so much about capital and money and allocation and funds. So we thought we'll do something a little different, try and talk to you about a resilient India, a story of the entrepreneurial household. We're NMAS. NMAS is a company that was founded by the Elevar Partnership that is focused on accelerating the journey for the entrepreneurial household. I'll leave the rest for you to read online. We won't go into a spiel about what we do, who we are. You're all educated enough, so I'm not going to do what every other fund has been doing here all morning. With me is Viren. Hi, Viren.
Hi, Anish. Good afternoon, everyone.
So Viren is the former hockey team captain. He's an Arjuna awardee. He's played over 180 matches. Very interestingly, Viren watched his hero, Dhanraj Pillai, when he was 13 in a charity game of some sort. And 5 years later, Viren was playing in the same squad under Dhanraj. And with us is also Shri Harsha. And Shri Harsha is an inspiration, an MBA with a successful career with multiple banks. Shri Harsha met with an accident in 2013 that left him a quadriplegic with limited feeling in all his limbs. But ever the fighter, Shri Harsha decided to get back into sports. He won his World Cup gold in Paris in 2022 amongst a bunch of other medals. And he's the first Indian to secure his quota for the 2024 Paris Paralympics.
Hi. Hi. Hello.
So we are hoping that this panel inspires you a little bit, challenges the standard notions and assumptions that people make about small town India. And Viren, let me start with you. What do you see as trends in this space about athletes emerging from big cities versus smaller cities, smaller towns?
Yeah, thanks, Anish. It's great to be here. I've been involved in sport very closely over the last 25 years, and honestly, in sport, actually, there's a big dichotomy in India, because if you look at my organization, OGQ, Olympic Gold Quest, it's a not-for-profit foundation started by two of India's sports legends, Geet Sethi and Prakash Padukone, with a very sharp mission to help Indian athletes win Olympic and Paralympic medals. We look after the best of the best young athletes in the country in Olympic and Paralympic sport. Very proud to say that in the last 3 Olympics, India has won a total of 15 Olympic medals, and the training of 9 of those 15 Olympic medal winners was looked after by OGQ. You're allowed to clap also, huh? I know it's lunch and you'll have multiple panel sessions, but if you'll clap, we'll maybe keep the talk shorter. We currently look after the training of almost 400 of the best Olympic and Paralympic athletes. Many of these are young junior athletes in the age group of 11 to 19 years old. Out of all the 400 athletes we support, not a single one trains in Mumbai. 95% of the athletes come actually from small towns and villages. So the dichotomy is where the structure and the process and the money is in sport. The hunger and the talent and the fire and the desire is not there. And where actually the hunger and fire and desire and the talent is not there, the structure and the process and the funding is not there. And what organizations like OGQ have to do is ensure that we marry that together and we actually go out and find the best young talent and ensure they get the right support, the right funding at the right time. Just as an example of, and also how much inspiration a hero and role model can do. Just a quick show of hands. Who has heard of Mirabai Chanu, the weightlifter who won the Olympic silver medal? Okay, so excellent. Great to see that so many hands know about a sport like weightlifting. Mirabai Chanu was a weightlifter. She is a 49 kg weightlifter. So she's only 4 feet 11 inches tall. She hailed from a background so poor from a village far away from Imphal that growing up she used to lift firewood to earn a living. Tough girl coming from the mountains, she became a weightlifter. Her journey at the Olympics began with failure because at the Rio 2016 Olympics, Mirabai Chanu did not make a single successful lift. In her weight category, women's 49 kgs, you have to lift about 115 kilos in clean and jerk to challenge for an Olympic medal.
2.5 times.
That bar is so heavy, I'm 80 plus kilos, I cannot lift that bar 2 centimeters off the floor. Because if I go to lift it, we'll get a back injury for the rest of our lives. You know, that's what they say, don't try this at home. That is one of the things that we should not try at home. In 2016, OGQ made the decision after the Rio failure to support Mirabai Chanu. And I remember I had, in December 2016, I had made the journey to Patiala, which was Mira's training base, to try and find out what went wrong at Rio. We had dinner with Mira and her coach. That dinner meeting turned into a 4-hour meeting. And Mirabai Chanu was sobbing on the table for 2 hours as she was telling us the story of what happened. She said that the mental pressure on her at Rio was so intense that when she went up on stage, she mentally totally blanked out and she forgot the process. And weightlifting is a process. If you forget that process, you will not lift crazy amounts of weights. From that, we realized that Mira is very talented, her coach is very talented, but the ecosystem around her was lacking. We ensured she had a very good psychologist to ensure she overcome the fear of failure that kept plaguing her.
So putting the infrastructure where she needed
We ensured she had a nutritionist because we had to keep her weight and yet have the explosive strength to lift 115 kilos. A physiotherapist because I'm a hockey player, we look after
single bedroom house and all that. So just in 3 years, I felt the time I'm putting here, the effort I'm putting here, and the reward I am getting is much more than what I could have got in the city. So I moved
that's pretty
back.
awesome. For you, Viren, in the last few years, in the last 15 years, you've been playing for a while, you've been with OGQ for a while. What is the change in infrastructure that you're seeing in smaller India versus the big cities?
I think huge. I retired from playing hockey way back in 2007. When I retired, there were 30 AstroTurf hockey pitches in the country.
30?
30. Today, there are over 300 AstroTurf grounds in India. I checked with a few of my friends actually this morning. In Odisha, there are 36 AstroTurf grounds. In Sundargarh district itself, there are 17 blocks. Each block has an AstroTurf ground. In Punjab, there are over 30 AstroTurf grounds. In MP today, there are over 30 AstroTurf grounds. In Haryana, there were over 25 AstroTurf grounds. When we started supporting Saina and Sindhu in 2009, Sindhu was only 13 years old that time. There were 30 badminton courts in Hyderabad, similar number in Bangalore. Today, anecdotal evidence says that the impact of a hero and role model like Saina and Sindhu and how much infrastructure.
Also because there is demand for that infrastructure.
Absolute demand. If you look at the in Odisha, the Naveen Patnaik government is doing an amazing job in development of sport across the country. The bureaucrats are absolutely brilliant. The people who are the director of sports, secretary sports in the ministry, etc. In Bangalore, you see the number of job opportunities, actually the number of former players who are now turned coaches. Every court is full from 6 in the morning till 10 at night. So I think the infrastructure is creating a lot of job opportunities across the board as well. And I want to narrate the story of a boxer named Lovelina Borgohain. In 2012, when the legendary Mary Kom won a boxing bronze medal at the London Olympics, Mary is such a hero and role model. There was a 13-year-old girl watching in a small village in Golaghat district of Assam. That 13-year-old girl was Lovelina Borgohain, and she told me that she watched it on the village TV because they didn't have TV in her village in every household. And she dreamt of becoming a boxer. We started supporting her when she was 17 years old. Lovelina Borgohain went on to win 2 World Championship medals and then an Olympic bronze medal herself at the Tokyo Olympics in 2021. On the day Lovelina Borgohain won the Olympic bronze medal, the local government, only then they created a Pakka road that went to her village. Until that time, there was not even a Pakka road that goes to a village. So I hope that it doesn't take athletes winning Olympic medals to actually
get roads and
create. So there's so much more still to do.
To Shriharsha, I just want to ask one question. In the time that you've spent in Hubli, and it's almost now 20 years, what is the change in infrastructure that you have seen personally and medically?
Yeah, I met with a spinal cord injury accident which ended up in 2013, February. From that time, if I can see that right now, the physiotherapy, the treatment which a spinal cord injury patient should receive has improved, but not at that pace which is expected as compared to a metro place. We were guided to go to a metro place like Mumbai or Chennai or Delhi, but we could not because of the financial issues, or we could not dare enough to go. But now the doctors are traveling to Hubli now and then, every fortnight or every weekends, because we have an airport there. Then the patients or the treatment is much better. But it should, I feel, should still speed up more.
There is more demand and there is more.
There is more demand. Most of them, I ended up as a sportsman because my parents aspired a sportsman in me. They saw a sportsman in me. So after my fall, I lost my salary. My wife left her job to take care of me. But my parents said, okay, we know how a sportsman you were in your past. And we definitely know now also you will put in your time perfectly into what you are doing and make it positive. We know who you are. And they bought a rifle for me for the first time, which costed 1,90,000. My mother herself, without any financial assistance. They are both retired. That is how I started improving, but that's my story. But many of the other people who have met with accidents, with spinal cord injury, right now I see them, they are meager working as a clerks. They are meagerly working as some small shopkeeper, somewhere sitting in, he can't move around much and he can't do more. So they say you are lucky to go for Paralympics, play at a national level, international level. We are not so lucky as you. I don't know.
But there is the aspiration to do more. Everybody wants to do more.
Yes. It should not be by a success story by luck. It has to be a success story by putting in a support system. It should not be by luck anymore, is what I feel.
Viren, I'm mindful of the red in front of us. Do you want to leave us with a passing thought, after which I'll go to Sriharsha?
I fulfilled many of my dreams. I played for India, captained the Indian hockey team, played at the Olympics. But my one dream to win an Olympic medal myself, that remained unfulfilled. In the Tokyo Olympics, I think the most inspirational moment was about a team that did not win a medal. That was the Indian women's hockey team. They came fourth. They just missed out on the Olympic medal. 10 of those players come from small villages in Haryana. They tell me that growing up, they were not allowed to have a mobile phone. They were not allowed to wear jeans. They are not allowed to marry someone of their choice. And in the quarterfinals of the Tokyo Olympics, when they beat Australia, world #1, unbeaten in the Olympics, and I saw them celebrating, I just thought to myself, how much of a hope and dream that gives young girls and maybe young boys all across the country. Because I think sport has that power to give a hope and dream to kids, and that the power of that hope is, it's hard to measure that. And that is the most important for the millions of young kids in villages and small towns across the country.
And Sriharsha, any last passing thought?
Yeah. The thing is, sports is always welcoming. The right dedication is always put in, the hard work is put in by many of the athletes, as Viren said, from the tier 2 cities like Hubli, Dharwad, or upcountry, Karnataka, as I have seen. But the thing is, they don't have the proper, the support structure, what I call is as a qualified coach, updated qualified coach, not a qualified coach who was a coach past some decades back, We wanted an updated, technically knowledgeable coach, the physiotherapists, the sports nutritionists, the sports psychologists, and the upgraded equipments. Because what happens is, I see the equally injured athletes coming to be sportsmen like me after a spinal cord injury, but in the initial first 2-3 years, I don't say they waste their time, but what happens is the time gets wasted just in trying to search who is there to coach me. From where should I get the proper energy, the knowledge, and the coach, the technically, who can coach me. That is where the initial struggle, the energy gets lost. That is where the inspiration, self-motivation becomes down. That is when the parents say, it's enough, come back to work, earn something for the home. And sports is not going to earn you any money. So that is where, in these areas, where the energy and the potential is so high, that the hard work is very intense and very pure. If I have to say, it's very, hunger is so high, that if you put in the right,
the right
system, the right support system, or the right information stream at least, information.
No, I think goes back to what Viren you said.
There is a lot of growth which is
goes back to Viren, what Viren said. I think where there is hunger, there isn't enough capital, and where there is the capital, there isn't enough hunger maybe. I think we'll just leave you with that. Thank you.
I just want to acknowledge Shobha, who's Sri Harsha's wife. Shobha looks after Sri Harsha 24/7, has sacrificed so much. So thank you, Shobha, as well. Thank you.
Gosh,
Thank you.
Sorry, go ahead.
I just want to say thank you.
Okay. So inspiring. Thank you so very much, gentlemen, for being with us today. I would like to take a moment to allow you all to please stay on stage. We have Mr. Raman, the chairman of SIDBI, to please come on stage and present you all with a token of our appreciation and a certificate. Ladies and gentlemen, I think they deserve a big, big round of applause. So please put your hands together. Thank you so very much for those very inspiring stories and really lessons on the value of sport. All right, let's move right on then. We've got a panel discussion that's going to throw light on the 200 million plus entrepreneurial households, the epic growth opportunity. Before I proceed to call on board all of our panelists, we have a video that we would just like to play for you.
India's story is undeniable, but at its heart, hundreds of millions of entrepreneurial households and the industrious communities they form stand as the silent sentinels of growth. From bustling markets to rugged countryside, these entrepreneurial households and their communities embody resilience and vibrancy, crafting multiple streams of income to meet their aspirations. Each household a hub of economic activity, and together with their communities, managing complex networks of transactions to turn these aspirations into tangible growth. These are not just households, they're entrepreneurial powerhouses. Their hands, together with their communities, weaving the fabric of India's economic future. This is their time, and they will define the next 20 years. Breaking free from traditional metrics, we introduce core transaction value, capturing the essence of the economic life of entrepreneurial households. Core transaction value, or CTV, is a combination of all the meaningful transactions flowing into and out of the household. Inflows include multiple incomes and curated borrowings, while outflows include business spending and all the spending on high-priority goods and services such as housing, education, and health that have tangible long-term impact on the household's prosperity. Through this lens, an opportunity emerges. Transactions at trillions of dollars, a testament to the untapped potential of these industrious communities. This opportunity is epic, the economic power of industrious communities. For decades, we've spoken of customers at the bottom of the pyramid. The epic moment marks the inversion of that pyramid, thanks to infrastructure, connectivity, and inclusion, both financial and digital. Entrepreneurial households have emerged and now prosper. And serving them are hundreds of businesses that truly understand what it takes to fulfill the needs of these households and meet their aspirations. The pyramid is flipping over. This is an epic moment. Our mission is to illuminate this potential, employing cutting-edge tools to map out the economic landscapes navigated by these households and their communities, starting with India and then expanding to industrious communities globally, anywhere that entrepreneurial households share this hunger for growth and social mobility. This journey is about much more than just economics. It's about using the power of capital to think of solutions and not just products. It's about entrepreneurship building a legacy of sustained prosperity. This is a pivotal moment. Together with these industrious communities, the world of business and capital can write new chapters of business growth, economic equity, and household prosperity.
Wonderful. Clearly not just entrepreneurial households, but entrepreneurial powerhouses. Couldn't agree more. So yes, ladies and gentlemen, now it's time for our discussion. Let's welcome on stage then Sri S. Raman, who is the Chairman Managing Director, Small Industries Development Bank of India, or SIDBI. We also have Munish Sharda, Group Executive, Retail Assets and Bharat Banking at Axis Bank Limited. Utpal Isar, co-founder at Sarvagram, as well as Jyotsna Krishnan, who is the managing partner at Elevar Equity. She will be moderating this discussion. And I just want to request all of you to please take your seats. Do not leave the auditorium because we've got some very insightful panel discussions lined up. Over to you.
Thank you. Hi everyone, and this is a special panel, a much smaller panel than several others. I thought it would be good to go a little deep into this topic. I probably need more of an introduction than the rest of the panelists, but very quickly, my name is Jyotsna and I wear two hats. One of a GP, I am the managing partner of Elevar Equity, and the second hat is that of being co-founder of NMAS, which was really set up to bring out something that we're all passionate about, which is the economic power of industrious communities. I'm not going to go into these organizations more. If you like today's session, I'm sure you'll look us up for more details. The quick context is I personally picked the three people sitting on the right side of me because I know each one of them has a wealth and depth of experience when it comes to these markets. In fact, I suspect I could have had a 40-minute conversation with any one of them and it would have been full of special stories and insights. But maybe as context, personally for me, this moment of truth for me started in 1999 when I visited a family in Jhansi. And it was interesting. The woman I met in the household had many children. And she said it with a smile that she probably ended up with more children than expected because not all of them died due to infant mortality. Vaccinations had kicked in. But she was struggling to pull them all together. But she had a smile on her face. They were figuring it out. Almost 20 years later, when I visited certain belts in Madhya Pradesh, Sagar, Damoh districts, etc., I see families like that one. But now those children have grown up and each of these families have multiple sources of income. This is one generation that has made a huge shift in the way we have understood Bharat, growing up, several of us. And I just feel it's important to bring out the new version of Bharat, which is more relevant today than what we all pictured towns and villages to be 20 years ago. That story, which went from Jhansi to Damoh and Sagar, highlights three main topics, and you heard some of that in the previous session. One is the multiple sources of income, which have changed the fortunes of many of the households, which are no longer below poverty line or struggling to make ends meet, but they are fighting for growth and aspirations. Second is there's a very unmistakable quality in these households, one of an entrepreneurial spirit, which today has been talked a lot in the context of startups, but when you hear some of these families, every sports person, honestly, that we spoke about here was an entrepreneur who fought and took charge of their own destiny and did not take compromises in quality for an answer. And that third point is the hunger for growth. Even wearing the GP hat, honestly, it is phenomenal to invest in markets that are hungry for growth and are willing to double down on themselves, right? So our thesis is the next 20 years, Bharat is going to lead the way for India. And here we are to talk more about this. I don't think people need too much of an introduction, but you know Raman as Chairman and Managing Director of SIDBI. His passion for this segment is the reason we're talking to him today. Munish, who's currently leading all things Bharat Initiative for Access, will also talk a bit more about his experience. He's got a wealth of experience prior to this. And Utpal Isar actually decided to walk out of a large institution known for these markets, from ICICI to starting his own enterprise that goes even deeper, right? I suspect the proximity to customer is part of what drove that decision. But maybe I'll pass around the mic to each one of you. What I'd love for you to talk to the audience about is why you're doing what you're doing. What is it in your personal journey that brought about this conviction to double down? Probably a more personal note, and then we'll get into the market statistics a little later on. But over to you, Raman, maybe.
Thank you for having me here. And before I dive into the topic, I just wanted to sort of take a moment to applaud all of you here, because sitting at SIDBI Fund of Funds, I can only say that by committing 9,800 crores or some such number like that, all of you put together have raised an additional 56,000 crores from the market, which truly, if you ask me, is the reason why all of you are featuring in the Economic Times or Pink Papers every day. So I think it's been a tremendous achievement by all of us put together. So, you know, please do clap for yourselves. But getting back to really what I think SIDBI is trying to do is get those number of households into entrepreneurship. And honestly, when I saw your data, I could only think that you are probably doing even more than what SIDBI is doing. So, you know, it is truly amazing to read the sheer entrepreneurship, the industriousness of those households. And I can honestly tell you that I have seen it in various trips that I make, and I love to go into sort of, you know, the corners of the country. And one such, you know, very compelling story is these ladies in Ladakh, and they have come together as a community. But each one of those ladies actually looks after the Pashmina goat. And it is just the introduction of a person who came in from the plains as an NID design expert and settled in Leh and worked with these ladies. These ladies are actually taking their goats for grazing, rearing the wool, bringing it to Leh, and then doing the processing. Now, they brought to get the machinery to do the processing themselves. And they have created an absolutely incredible brand called Looms of Ladakh. And I would insist that all of you do go to their website and spend your money and buy their products. It is fantastic. But the greatest part of their story is they are doing the entire work themselves. There are about 27 women there. And today, after about, I would say, 3 years of, you know, revenue that they have generated, it is their children who are not going to the Chandigarh and the Delhi, but are remaining back there in Leh, sitting at 13,000 feet and helping their mothers do this job because there is wealth created. So it is, you know, an unmistakable, you know, aspect of human life that when wealth is created, you will have everybody going in droves and wants to be part of that wealth story. So, you know, I believe that the data that you're putting together is fantastic. And as a banker, I think my next point really would be that how do we get this information in databases, which is structured and which can then come across to all of us as bankers. Munish would obviously be, you know, sort of delighted to have information that can give us the due diligence of those people. Because most of this community is probably non-GST registered businesses. Could be some of them in GST. But when we're talking about GST, it's still easy to do an assessment of their risk. But when you're talking about the non-GST registered entities, then you're really struggling for data. So I would really look at it as, I completely agree with you, the next 20 years, in fact, the numbers that we have got is in the next 3 or 4 years, we're looking at a demand for credit from the MSME sector, which is 30 lakh crore, 30 trillion rupees. And the entire MSME borrowing on date is 25 trillion rupees. So we're actually looking at more than double of what we've got. And how does that throughput go through is really the big question that we have to ask for ourselves. But I think it is phenomenal to see this sort of line of thinking. And I think what you're really cutting through is a lot of, layers of traditional bank thinking, and you're getting down to where is the money, show me the money, and therefore there is a benefit.
Which, Munish, I think you had some thoughts. Would love to know what your moment of truth was when you decided to move into taking on a fairly massive mandate for Axis, right? So.
Yes. It's working? Yeah. So first of all, thank you for having me here. And honestly, I've not seen so much capital in one room ever. Right, so many investors here. So, and I've been with Bharat Bank for about 2.5 years now with Axis Bank. And my journey about Bharat, or my passion, or my focus on it started actually prior to I joined the Bharat banking business of Axis Bank. So this was during the COVID time, and at that point in time I was managing director of an insurance company, and I used to run a life insurance company for about 7-8 years. And this was during the COVID time, and I started, we started looking at, where is India going to go from here? And that curiosity started, pushing me in that direction, saying that is it possible to build something big in these markets on the back of the work that's happening, electrification, road network, or the digital infrastructure, etc., etc. And we thought that there could be a possibility of doing something in a digital way, because COVID actually brought a lot of this digital stuff into play. So at that point in time, I started traveling a lot into deepest parts of the country, and I went and lived in a few villages myself. There's one particular story that I want to tell you about. This was in the state of Punjab. There was a manufacturer and exporter in the state of Punjab, and in one lifetime, this guy actually used to sell kinus, those orange variants, on a roadside, thela or whatever. And today he's become one of the largest exporter of kinus from the state of Punjab, all in a span of 10 years, right? So this guy started procuring kinus, it used to sell in the local market, took some money, started investing in something, bought some land, bought some more land, and started growing more kinus, put up a factory to process kinus, then put up a factory to process kinu juice and whatever else, and all the variants, etc. And he's become one of the biggest exporters for. And that actually, brought me to a point where it said that, if somebody can get the right kind of advice and right kind of technology and right credit at the right time, there's an opportunity for millions of these households or millions of these entrepreneurs to flourish in this country. And that's when, as destiny would have it, I just was chatting with the Axis Bank, and they said, why don't you come and do this for us in this place? And ever since I've joined Bharat Banking, and Bharat Banking is our initiative to connect the dots for Bharat customer across the spectrum of banking services, across the spectrum of financial services, right from microfinance to wholesale, and large part of it is actually creating ecosystems, large ecosystem where people can come and work. And one such ecosystem is we work with this company called CSCE Governance Services Limited, which is the Common Service Centers of Government of India. So there are about 650,000 of these service centers which are located across the country. And these are individual entrepreneurs who are actually providing government services or financial services to the locals in these deep geographies. And my travel has taken me to the deepest parts of the country, and I was in, and such is the power of these entrepreneurs. I was telling the story the other day, we were in some deep part of Gujarat, and in a rural unbanked area, there's a common service center fellow who is an entrepreneur in that state, and can you imagine the business that he runs there? He actually runs a business of sending kids to foreign universities in a rural unbanked area. Okay, and I asked him, I said, how many kids do you send every year to foreign universities? He said, I send about 150 kids to foreign universities on the back of credit, and and he has tie-ups individual, one single person. And I was telling my branch manager, and he said, look at this opportunity here. I mean, this is where India is, and this is where India wants to go. And many of us have come from possibly similar middle class or lower middle class backgrounds. And and from that point, I went to a nearest branch of our bank, and it is a rural unbanked branch, and I walk into the branch, and there's a branch manager sitting and a customer sitting in front of him, negotiating, guess what product? Education loan for his kids, right? So, so this is where India is changing, on the back of technology, on the back of credit that's available, the models that are being built, etc. The ecosystem approach of corporates, or several such initiatives that are going. I think it's a large, massive opportunity for a country to capitalize on and lead to that sustainable growth that India much needs, and India much deserves too. So that's Bharat Banking, where we are trying to relentlessly work towards, using data, using technology, participating in ecosystem, etc., to bring credit and financial services to the doorstep of a customer in deep markets. And I think we are well placed to do it. Yeah.
And Munish, how much capital is behind Bharat Banking from Axis?
Well, we're a listed entity, so I can't give you specifics, but a large amount of, so we have big investments in the area. So we have about half of our branches are in Bharat Banking area. Roughly about 30,000-40,000 FT full-time resources are devoted to building this. We are about 15-17% of the bank, and we think that there's an opportunity to create a bank, as big a size as the main bank in the next 5 to 10 years time, only in Bharat. So
Yep, that speaks a lot.
That's the opportunity.
Got it. Great. And so now the entrepreneur himself. So you quit a large balance sheet and went entrepreneurial. What was your moment of truth?
Oh well, you guys talk like the epic opportunity has just been discovered. Okay, it was always there. Okay, you were not there. We were not there. From the formal sector, so to say. Over the last 20 years that I've been working in rural India, we've seen lots of transformation, but whatever we are doing today, in some part or the other, in some form or the other, existed earlier as well. We had lots of bank branches, we had lots of informal lending, etc. going on there. Infrastructure was a challenge. You would get out of an airport in a state capital and the infrastructure would end, right about 2-5 kilometers out of the airport. Now it is much easier, right till the village doorstep, maybe except a few villages that the previous panel member spoke about. It's becoming much easier in terms of physical infrastructure. And of course, given the digital public infrastructure that is now available, it's much more easier for people like us to be able to give access. However, our thought process was very simply, going through these 20 years, that the big challenge that we see here is verticalization of offerings. So you say that, credit is one offering, risk mitigation is another offering, so on and so forth. But ultimately, if you look at these households, for example, one of my former bosses used to quote this example very well, is that, in a village, for example, or even here, somebody falls from a tree, a kid, and to take that kid to the doctor, the household will typically borrow. So you are replacing a health insurance with actually a credit product in that sense. So at a household level, it does not really matter too much. And therefore, we saw a humongous amount of change coming in. We focus on rural India and only on rural India, into these households, the middle class emerging very well there, differentiated from the below poverty line segment. Again, a very large segment, but the challenge with the middle class that we saw was that they got painted with the same colors as the low income segment. And therefore, the solutions that were coming out, the offerings that were coming out were less than ideal for this. And therefore, we thought it's best to move out and start a solution for the middle class aspiring households.
Your wish of the large balance sheets to your right?
Say again?
Your ask of the large balance sheets to your right?
Well, you'll get me into a fight, but...
I thought that was the idea, no?
No, but see, there are different capabilities that exist across, right? Whether it is the capability of policy making, the capability of institution building, the capability of giving access to capital, and the ability to absorb risk. That is on the right-hand side of me. What is here is the ability to do the last mile, to be able to sit with these households, interact with them, and really understand their requirements, their abilities, and really be able to design an offering for them. And of course, with the help of policy, with the help of institutions and capital and risk abilities, then be able to marry them together.
Excellent. Now, all of these anecdotes that you all heard are no surprise to us. We end up spending a lot of time traveling across smaller towns and districts, and we've heard tons of these stories. But I also realized that the stories themselves sometimes feel surreal, and not everyone feels it adds up to something large. So that's the reason why we worked. I mean, we had commissioned Praxis to come out with a report that feels a lot more tangible in terms of this opportunity. So for those of you who haven't looked at it yet, I would encourage you to look it up. We are talking about dollars odd of core transaction value, which the best way I can talk about that is it's a number that is not less than that number that probably exists on the ground. We decided to go to the most conservative end of the estimates as we looked at things. But I think it's a fascinating market, and it's definitely business ready. And I think the best way to probably understand how business ready this market is to get all of your senses on what is it that you think was surprising during COVID, which people would have normally said, you know, the segment is probably far too vulnerable, not ready for business, etc. Maybe some instances of where COVID surprised you, and maybe we can start with you, Utpal. I know you went through a soul-searching experience when COVID hit. You'd barely gotten off the ground, right? So.
Yeah, so the biggest part of a surprise, which was not actually a surprise for us, but when we put out these numbers month on month, it became a surprise for the rest of the industry actually, was the resilience of our households. And you spoke about multiple sources of income. The multiplicity of incomes, not all of which get impacted at the same time by the same event, is something that we saw firsthand during COVID. The other big surprise, actually the surprise for us, was the positive role that media played during the entire pandemic, which was that earlier, if there was a moratorium or any sort of a loan waiver, you know, it used to get painted across as everybody's loan was waived. But here, there was very careful communication to everybody saying that the loan is not waived off, it is a moratorium, so on and so forth. Our surprise was when we started communicating with the households one-on-one, saying that, look, you have a moratorium, you can choose to take a moratorium of 6 months. However, what you do not pay now will get added, so on and so forth. Just to give you our data, and this is only us, 10%, 0% of our households took a moratorium for 6 months. 10% took for 5 months. And only 30% took a moratorium for 1 or more months between that. And that was the big surprise. And why this? Because we were able to really communicate to the households, saying that, sir, and data as they spoke about, saying that we know that your shop might be impacted, but you have milk income. And milk income, you know, is regular. It comes to you every 10 days, so on and so forth. So our biggest thing coming out of COVID was the resilience of these households. Their ability to see a large, you know, black swan kind of an event, come across on the other side of it, and then be able to continue the journey there onwards.
Great.
Yeah, so for me, there are 3-4 dimensions apart from the resilience which Utpal just mentioned. I think when we were going through that period, the first thing that we saw was that this entire penetration of digital and adoption of digital went altogether to another level in the country. I mean, it just forced people to possibly use those tools because it was not possible to go out, do physical transactions, etc. And I think that was a habit-changing, exercise that happened at that point in time. But that's one, and that's proved very beneficial for the nation at large. And the second thing is that what I'm saying. I was in last week. I was in a deep market in Jorhat. Jorhat is somewhere in Assam, and I was meeting a couple of entrepreneurs. And I was surprised to see that the number of people and these large businesses, I mean turnover of let's say 10-20 crore rupees, 30 crore rupees, and they were small businesses during COVID time. They become a bit more possibly professional, digital, etc. But what was surprising was the willingness of a number of young generation people to go back and help their families, build these businesses, etc. is something that has changed. I mean, I'm seeing it increasingly. A number of kiddos who are going back and actually helping their parents, saying, okay, there's money to be made in this market, or there's something more we can do. And I was in About a month and a half back, I was with a customer in Latur. Latur is 5 hours away from the nearest airport. And guess what? I met a businessman there who is actually running a business with turnover of $1 billion, right? And they are building a full ecosystem around it. And you can't imagine that you're seeing people like that. And what's happening in these markets is, you look at the number of other opportunities that come up, with all of this stuff, because economic activity is happening. And that is amazing, because number of private banking customers that customer was telling me we could build in Latur is not funny, right? So, and I am telling a private banking guys, why don't you open a private bank here in the district of Latur? So that is two. The third thing which has changed, I think, a lot more data has somehow been available, and the lot of stuff that the government has done, and I think that's another habit-changing exercise, is that instead of putting the weight on the burden on the balance sheet, running these, which SIDBI has done very successfully, running these guarantee schemes has actually enabled credit flow during COVID time into these markets very, very well. And that's another habit-forming exercise, because on the back of guarantees, etc., there's a bit more resilience, a bit more boldness that comes through, because you go out, you go and lend, and and the models have proved successful, and as a result of which you've been able to, credit flow to these markets have actually also improved quite a bit. And fourth is the entire enabling infrastructure around this thing, both private sector and the public sector infrastructure. There are many things that I can talk about, which the government is doing or which private sector is doing today, which actually have come out as we have exited the COVID period, which is giving a lot of depth to our activities, in terms of data, or the data that you can get for customers, the work that places like RBI Innovation Hub is doing, the work that we are doing as a bank, work that many financial institutions are doing, SIDBI is doing, Utpal is doing in these markets. It's actually leading to a formation of hundreds and thousands of those small ecosystems which are self-contained or self-sustainable in nature, which is actually leading to the larger narrative of growth being fueled in these markets. And all of this happened beyond COVID, because honestly before COVID it was going on some track, and after COVID suddenly the entire thing. And I think when we were going through that period, there were a number of these articles or whatever you get on WhatsApp saying an earth-shaking event has to happen in the life of a nation for it to start changing its orbit, and that's what's happened to us possibly, and that's what we are seeing and benefiting out of. Yeah.
Raman, maybe if you can also add, I know that women have emerged as phenomenal participants from an economic standpoint. Throw in some statistics. I'm not a big fan personally of the women's labor participation, etc., being low, because what we see on the ground is very different.
So some statistics on how COVID sort of played itself out. So under the 100% sovereign guarantee that was provided during COVID, called ECLGS, 3.64 lakh crores were the loans covered under ECLGS. We received claims, or let me say we received NPA markings to the extent of 17,000 crores. So that's just 5% of the total loans given out in a stressed period. I thought that was remarkably low. And out of that 17,000 crores, which is marked as NPA, we've actually received claims of around 6,000 crores. So, what is happening at the banks, I can't entirely figure out, but maybe they're collecting, maybe they're taking their time. Now, our lending to the MFIs have shown that, the 90 DPD was well over 8% and 11% for some of the MFIs. It's all sort of come down to less than 4%. So, the resilience of this sector is remarkable. And I think, everyone here has spoken about it. It's obviously the credit demand has picked up. Now, the MFI sector is something that SIDBI sort of worked with very closely and sort of incubated a few of them in the past. But what is it that's happening today? And today we are really looking at so many more NBFCs coming in. So let me just give you a sense of the NBFC market where we have given, loans or, for refinance or on lending to about 65 small NBFCs where AUMs are less than 200 crores. Now, obviously, they're dotted across the country's landscape and they're all giving loans. Now, this credit demand is, I would say, roughly, for an NBFC, let's say, it's 24% interest or something like that. Now, as a, sort of challenge to these businesses, so, your epic households, my big question is, all business continue to grow if they're going to get loans at 24%? So I'm just putting that on the table. It's not that, as a country, we need to figure it out. So there are obviously several sources of loans. There is SHG loans, but that's much smaller. There's MFI, JLG. There is a host of persons who are now getting individual loans. And one of the experiments we ran, it started in COVID and then faltered and then we've picked it up again. We've given about 2 lakh loans of about 1 lakh loan size each. So, the average ticket size is 1 lakh. We've given about 2 lakh such loans. It's obviously with partners on the ground, so there's some feet on the street. Either it's a BC or an MFI. 75% of these are women borrowers. So, I can only sense that from the JLG stroke SHG, there is a gradual movement away from group loans and into individual loans.
And
now,
that's where
I'm
women
sure
also
all of
kick
them
in.
are, part of your count of, whatever, 25 crore or 250 million that you're talking about. So, this is really where the credit uptake is massive. Let me just come very quickly to the point that Munish said. Our credit guarantee scheme, which goes under CGT MSC. Now, that is the largest micro and small loan guarantee scheme. You have a guarantee of 75% of the loan, and up to 10 lakh rupee loans, the guarantee goes up to 80 and even 85% for those which are less than 5 lakh. So, it's a graded system. We have done more than 100,000 crores of loans in this current financial year.
It is massive.
So
Yes.
it is huge. I mean, we did 57,000 crores last year. Before that, it was all sort of 30,000 and 25,000. So I can only speak from these numbers that the market is just, sort of huge. It's
I guess
exponential.
the one thing that is often, I think it needs more than a pure digital lens to the market. That's very important. And all of you here represent like hundreds of millions of touch points on the ground, which completes the picture. And that's an important point to focus on. I know I'm conscious of time. I'm going to very quickly go around, maybe, Raman, one point on where SIDBI is poised from a futuristic standpoint. How would you look to capture the next 20-year opportunity? What would be the big focus there? And then I'll...
Yeah, I think from our standpoint, it is certainly, direct lending, but our catalytic role will really come about if we were to do something similar to what we did with the MFIs. And this time, I think our focus is really on green finance. So between an electric vehicle to a solar rooftop, whether it's on a business or a residence, where you have these companies called ESCOs, energy saving companies, or RESCOs, rooftop energy saving companies. There are a host of them in India. They are happy to put up the plant on a residence and give a lease rent to the residents. So, there is a burgeoning amount of work that's happening in the green space. Interest rates need to come down a bit. But again, I'll say that if 25 crore households can each get an EV, I think we'd have done a phenomenal job. And for that, we need probably another 100 NBFCs to come into fold.
I mean, and there's no green transition happening without including these households, right? So,
Absolutely.
And we need distribution into them. Munish, from your standpoint, what's your outlook?
See, we are Axis Bank, we are a full-blown, full services bank. And when we say Bharat Banking, sometimes one construes it as saying, only agriculture or microfinance, etc. But it's not that. We count on doing pretty much everything that a bank can do for its customers in these markets, right? So for us, Bharat Banking is a big initiative. We think that the demand, the consumption story, etc., is going to play out fully in the next few years. I personally think that if India is continue to grow at 13% nominally, we will create an India which has gotten created in 75 years in the next 7 years again. So one full India is going to get created in the next 7 years, and possibilities are for everybody to see. And we think we could play a bigger role in helping India achieve its potential in these markets. And for us, as an outcome, we see ourselves, fully and deeply in there from a full purpose or all service bank in these markets.
Thanks. Before, I'm going to let you have the last word, Utpal, since you're the youngest organization out here. But we as investors are supposed to be ahead of the curve in spotting future trends. And I think I'll let Utpal talk a bit about the concept of core transaction value and how you see that, because you've gone through the report and you had some reactions. But I think this is a good wake-up call for all of us to say there is a massive trend that is not to be missed. In fact, it's probably going to fast-track everything that's happening over the next 20 years, right? But over to you on your sense of the transactional activity maybe you see on the ground, which is your opportunity.
I think you guys severely underball that number, by a factor of easily 4, 5, 6. I don't know how much actually. And if you want to really test this hypothesis or test this statement, just take any market. We've all seen lots of markets. Don't look at, your shopping malls only, but let's take any dense market that you know. Small town, don't take metros, take small town. Walk that market, just do a transact in that market. 10 feet wide shops, right? So in a kilometer, you have about 300 of those shops across. You go 1 square kilometer, you would have more than 1,000 shops. Any estimate that you want to make, take 100 footfall, 2,000 rupees, 1,000 rupees average purchase, etc., and just do the maths yourself and convert it into billions of dollars quickly. Otherwise, your calculators will run out of space actually on that. And that is really what we see as the opportunity of emerging India, be it urban, semi-urban, rural, metro. It doesn't really matter. It cuts across. And what we've now seen over the last 10, 15 years is more and more movement from below poverty line into this aspiring middle class of households. Here, as well as in the villages in rural Assam that we spoke about earlier. It is this opportunity that keeps us awake, and we are going to be spending the next 5, 10, 15 years, whatever, God gives us, in being able to prove a model that is seen by everybody else, because as Mr. Raman rightly said, we don't need 100, we need thousands, maybe tens of thousands of organizations to really be able to do justice to such CTV. We just hope to be one of them on the leading the curve from there.
What Utpal did not mention is he did the CTV math on a 1 kilometer radius dense old market and arrived at a north of $11 trillion number if you take about 5,000 such square kilometers in India, which is an easy one. Yeah. So I conclude by saying our report is probably off by margins.
Yeah, I mean, see, just the larger towns would have 10, 12 of those markets. What you call as tier 3 or 4 towns would have 2 or 3 of such markets. And rest of the, census towns, which are about 4,000 of them, would have at least one such market, right?
But just think of the fact that you could, just sitting here, add many zeros to our GDP. Because a lot of that is just not in the formal system.
True. Anyway, thank you so much. Thanks a lot, and this was wonderful. There's so much more depth to all of this than we are just scratching the surface even in this conversation. Thank you so much.
Absolutely, but the resilience of households is an epic growth opportunity indeed. Jyotsna, thank you very much for that. I'd like to invite on stage Jayanta Basu, Chairman, CX Partners, please, to felicitate our participants for this panel discussion. A round of applause, ladies and gentlemen. Thank you to all of our very esteemed panelists for taking part in that discussion. Very energizing, very thought-provoking, to say the least. All right, let's get a move on now and deep dive into nation building. Ladies and gentlemen, it's time for our next panel discussion. For this, please join me in welcoming on stage Karthik Reddy, the chairperson at IVCA and co-founder managing partner, as we all know, at Bloom Ventures. There's Madhur Singhal, managing partner and CEO at Praxis Global Alliance. And moderating today's discussion is Nisha Podar, editor and anchor at CNBC TV 18. They'll be taking the center stage and discussing the nation building report. This is titled Swarnim Bharat Ke Or. And ladies and gentlemen, this is a pivotal collaboration between IVCA and Praxis. I request you all to please take your seats, and those who have to join us on stage, do so. And I'm going to hand it over to Nisha to take that over, talking a little bit more about the role of private equity and venture capital in the empowerment journey towards a brighter future.
Hello everybody, good afternoon. Karthik, Madhur, thank you so much for joining. And thanks to all the audience. Private capital is a very important component for nation building. It is a lifeline of businesses. It gives the fuel that the businesses need to grow and survive. So we're going to talk about how private capital has really helped in nation building and what more needs to be done. So Karthik, first talking about how long have we come in this particular journey? At this point, a lot of investors are very keen on India opportunity, and you know, nation building as a whole is really taking shape with the banks as well as private capital all put together. In your view, how far have we reached, and how long a way is it that we have to go for optimum utilization of this particular benefit?
No, I think so. Two analogies. One closer to where the US and China were in their formal economies, about $3 trillion in '88 and I think late 90s, early 2000s. And if you see the compounding that took place after that, it happened very rapidly in the next decade. Yes. So the ability to grow 3x once you hit certain thresholds, I think, becomes far more compelling. And with us, it's not on the back of simply relying on physical infrastructure, which was the growth engine for 20, 30 years from 1990 to say 2015. Yes. But it's on digital infrastructure, which all kicked in simultaneously around 2016. So it's also the other analogous thing for this would be if you follow cricket, usually what you score in the first 2/3 of the innings, yes, you should be almost able to score in the last third. So if we did all of what we did in the last 20, 25 years, the next 10 years should be explosive in terms of delivering at least the same output.
So we are in the slog hours.
No, yeah, we're in that phase where I think all the groundwork has been established. The foundations are very strong. Yes. So the acceleration should pick up from here for the next decade or so.
Right, so all said there. But what do you have to say about the opportunity that India presents? All the private equity that I've been speaking to, their global leaders are making a visit to India. Their deployment towards India has substantially increased. Even infrastructure, real estate, which was not attracting as much capital earlier, is now seeing a lot of investor interest. What is the opportunity that you see?
Yeah, so I think even in the Bharat Nirman report that is about to come out, if you look at the data last 5 years, overall private capital, I'm not just talking private equity or venture capital, but overall private debt, structured credit, infrastructure financing, etc. All of that together has brought in $210 billion of capital in the country. And that $210 billion has roughly supported around $1 trillion of GDP increment. Now, if we are, depending on the exchange rates you take, but you know, anywhere around $3.5 trillion of nominal GDP, if we have to get to $5 trillion from here, right? Our estimates are that you would need at least $600 billion of private capital to come into the country. Now, let me explain that very quickly. It's interesting what Karthik said about the growth applies conversely about capital, because to drive the 1/3 of the growth, that means the capital that came in the first 2/3 needs to come and more, right? So 3x of the capital that has come in the last 5 years needs to actually come in the next 5 years, because the internal capital accrual or cash accruals of the companies, ECBs, IPO markets, whatever other sources of capital are, they cannot support the amount of capital formation that the country needs if we want to get to the $5 trillion of economy. And that's where I think the gap is filled by the private capital.
Yes. So that gap is getting filled. And Karthik, domestic pools of capital, a lot of thrust has been given by the government on capital formation of our own as well. Where does it stand and what more needs to be done?
So I think some of it is trapped in risk aversion, some of it is trapped in regulation. Yes. The way insurance money works is, it has old IRDA chains which don't allow it to invest other than their very specialized units which only focus on Indian investing. Yes. So no dollar from what they invest into from a fund can leave the shores of the country. So that said, I think they've been huge providers of capital to secondary markets. So the faster we get our capital, our companies to the secondary markets, more there'll be participation. Yes. So one way to think about it is how can we accelerate paths to IPO earlier and earlier and get more participation. This is one big pool, insurance itself. So broadly, venture, private equity, real estate, all of these asset classes, credit, depend on long-term pools of capital. Yes. We have long-term pools, but they're not been unshackled for taking this kind of risk. Yes. So if you go to provident funds, pension funds, if you go to PFRDA, all of these folks, a small sliver of their capital, which the government has permitted now, up to 5% to come into these asset classes, has actually not started flowing in because, and we've actually, Mr. Raman just left the room, I think, we've actually requested the government, please trust Mr. Raman's organization to actually manage this capital.
Yes.
Right? So if you have a fund of funds management problem and a talent problem, which is a problem, yes. We don't have that culture in India like most of our guests earlier this morning, who overseas, this is a 30, 40-year-old specialized field. In India, that's not necessarily true. So where do you start? And so we're stuck on that loop where we meet all of these stakeholders every other year. Invest India and DPIIT all arrange and facilitate roundtables. I've actually gone and met people one-on-one, and they don't know where to start, right? And by the time it trickles down from participating, or we said if it's private equity, give it to NIIF, right? Yes. So give it to folks who are specialized and who will then be held accountable for that capital. Yes. If you're worried about young managers like us, let it come through systematic channels. Yes. Yes. But it's been a starting cold, what's called a cold start problem.
I would say, Karthik, we've come a long way because you mentioned NIIF, you mentioned SIDBI, Fund of Funds. All these are the making of last few years.
Yeah.
So we have come a long way, but
NIIF,
much more needs to be
NIIF
done.
is all of 6 years old. The Fund of Funds is government enabled is all of 7, 8 years old. Yes. 10,000 crores, SRI fund, 5,000 crores came post-pandemic. Yes. But you add all of this up, it's still 15, 20,000 crores. And to the point Madhur raised, that's $3 billion. Right. So when you put it in perspective of 500, 600 that's required, actually I would give more credit to the HNIs and family offices of this country who have put in more money than all this put together. Yes. So what they have provided so far is the stimulant for getting the leverage that you can. Yes. So they're taking a young manager or an Indian house and saying, ye lo aap humse 10 rupees lijiye aur 90 bahar se lijiye. So we have a little bit of a stimulant to go out there and say we've gotten some love and support from our anchor government institutional bodies. Yes. Now can we go raise 80, 90 bucks from others? Yes. And some of that is coming from private India and some is coming from overseas. Yes. But still, even in a fund like ours, as we've grown, more dollars have come because we've taken planes and headed overseas. Yes. Not because we can fill that demand for our own needs inside of the country.
Yes. So a lot more needs to be done, but in the last decade or so, a lot has been done. And IVCA has also lobbied a lot with the government for many steps. Madhu, you have any views on this part? And also, in nation building, how has the capital really taken up, really participated in job creation in particular, because that, I think, is going to be one of the biggest agenda for the government for elections and even post-elections.
So I'll steer clear of the political aspects of this, but I think where you started from, what Karthik was talking about also, see, the domestic pools of capital are now starting to trust this asset class, right? Last year, and we just published an India Investments Pulse, we do it every year. Last year has been a momentous year for exits, $29 billion of exit, and this is just exits that are not exiting through project finance closures, and so this is actual sort of exits to a third party or a secondary sale. Now, why am I talking about this? The lot of the private equity that goes in, right, or private equity, private capital, private debt, all of that put together, every dollar of private capital that goes in a business creates 5.7 times the revenue, right? 5.7x the revenue. So $1 million going into a company creates $5.7 million of revenue. Yes. It creates 1.2 to 1.3 billion dollars of taxes, right? $1 million is 1.2x. So that's straight away sort of adding to the revenue kitty of the government. It adds every $1 million of private capital. We've done this analysis for all investments in the last 10 years, and we looked at the published businesses, and we parsed out how much job creation happened. Every $1 million of private capital has created 47 new jobs, yes. Right? Every $1 million. And so I think creating capital or putting money into capital formation in the country will automatically lead to other types of capital formation. Talent formation is also capital formation of a different kind, yes. Right? And so all of that, the intent of this Bharat Nirman report was actually to quantify and document the impact. And it's not just social impact. It's actually a more wide-ranging economic, social, innovation, reputational. We talk about other things, but it's a very wide-ranging impact.
Many takeaways, but
just want to add to that on 2 counts. This is why our pet peeve as the industry, that if you don't want to change capital gains on all private assets, the fact that that kind of capital is being routed predominantly through formal vehicles like AIF, how can we not be given the same treatment that you're giving to a public asset which otherwise is simply trading hands without any of that impact? So you have $1 million come in from party A to party B. Party B is, party A has made some capital gains, and that you're giving more benefit to that transactional value than all the value creation, nation building that this $1 million is doing, which is, I feel it's almost tragically shameful that you're not actually encouraging this en masse, right? So this has been one of our pet peeves, that you have not equalized, private and public taxes on what is actually fundamental value creation from the ground up. On jobs, on taxes itself, ironically. If you look at early stage venture capital, 80% of the capital we put in comes back as income and salaries to somebody or the other. And the finale part of this is actually what Madhur, I don't know, Madhur, if your report has captured the second order effects. A lot of the businesses, if you heard the last panel, they didn't touch upon how technology changes those marketplaces. But once technology enables those marketplaces, income generation and the speed and velocity frictions that those otherwise unorganized marketplaces are benefiting from have far, far more reaching impact than everything we're discussing on this panel. Which means, like, if somebody, what are the benefits of UPI to that, nth customer provided by a venture-backed startup? Right. What are the benefits of getting identity proof digitized rather than that person running with a physical copy of his, for the nth proof that he has to submit? Right. So all this for you and me might not be, you can use an office boy or a driver. For them, it's their own personal time. So the amount of productivity, value that it creates for people not in the formal job economy is manifold actually. And we are not able to capture the depth of that. Like that's cab drivers to riders to farmers. Farmers don't even get categorized from a job perspective. But how dramatically this has shifted, their income generation capacity is not in this report, right? So that is not being understood, I feel, deeply enough by the government. The reason we collaborated on this report as an industry body is shift the conversation away from just the dollars. It's not about the dollars. It's about what the dollars does in a market like India. The second, third order impact is massive.
So Madhur made a point on even the exit options. There was a long time of lull, Karthik, where the new age companies, investors and that were not given proper exits. Now, of course, the IPO market opened, the avenues opened. So for overall investor community, do you think our returns and exit parameters and options have also improved? Because that really creates the fundamental infrastructure which is required for investors to come in the first place.
So very different question, but I think it's improved in terms of both perception and preparedness dramatically in the last 3-4 years, right?
Yep.
There was this fear on 2 counts that the regulator will block everything that's not profit making. If you look at the law of the regulator, it says you have to be profitable for 3 years.
Yes.
So people said, how can we list most of the new age companies which have not yet turned profitable? What they underestimated is the sophistication of the public market investor in this country, right? I think both the sophistication and the wisdom of the public market investor, with all due humility, is probably 10x of ours, right? So they know how to judge stuff. And most buyers of these assets are also driven by public market.
Yes.
They will not come and pay a 20x multiple when they're trading after 50 years of effort at 10x multiple. So fundamentally, I don't think we have scaled exit outcomes other than those determined by public markets and public comps. The universe of companies that needed to go and demonstrate that took much longer than one imagined.
Right.
So same thing, it's a little like that T20 analogy or 50 over match analogy. Now the floodgates have opened, right? So now it's not like overnight I can hit a button, file the equivalent of an S1 in India, 30 days go public.
Right.
SEBI will still sit on the DRHP for as long as they want.
Right.
But the point is, you are now able to show 20, 30, 40 different types of companies, which wasn't possible 5 years ago.
Yes.
And the minute one of them goes, establishes, runs through the rigor of equity analysts in the public markets, 10 other companies which are smaller than that can look up to this big brother, big sister, and say basically, now we have a comparable. We know how to get valued in the market, and it opens up the floodgates.
Right.
So I've always maintained, my pet subject is we have to have a NASDAQ equivalent by 2030.
Right.
And we have to have 30 awesome stocks on it.
Right.
Otherwise, we have not arrived, actually.
All
At least for venture, I can speak. PE, I think, has been thriving. Actually, in the last few years, they've shown boatloads more liquidity because they don't necessarily overpay and buy for innovation and go crazy and this FOMO. These are all venture elements, right?
Yes.
They're not taking new technology risk. They're taking old business model risk which can be made more efficient. So typically, if you ask a good PE guy, he'll say, I'll never lose principal and I will always buy at a multiple that I can exit at a higher multiple. So it's the other way around, right? So they've done well, actually, and that's why there is so much money coming in. You saw the morning panel.
Yes.
Some of these guys are all oversubscribed in this last 2 years. Compared
That's
to
right.
China PE, we are looking very good.
All right. So very good points here. But global ambitions, global, reputation, putting India on the global map, that's also one of the aspirational things which the capital has provided the entrepreneurs the leg for doing. So how do you see that? And of course, still we create our own NASDAQ. At least at the moment, Indian companies going global. Of course, one big listing is going to happen from one of the old economy, companies from India. But the new age is not too far.
No, so absolutely. And I think what Karthik ended with, I think last year, 2023 calendar, was actually the first year when we have, if you include private credit, we've actually surpassed China alternate investments, right? We're not talking Cat 3 AIF equivalents, but we actually surpassed. We're now the second largest private investment country. And there is data documented on that for the last 10, 15 years. Now, the point that you made about global, Karthik spoke about the kind of risk that venture takes. Actually private equity, I personally do a lot of work with private equity. There is, while the cash flows are there and the business models are there, but a lot of money is going from private equity or private credit into global expansion, right? Globalization of Indian companies opening up new markets. Some businesses like pharma and IT are fundamentally exports oriented, but even manufacturing, right? And the amount of money we are seeing flowing into, ODM, into manufacturing, into new age spaces, which might be venture to some extent or early stage growth in other ways. Investment into drones, investment into agri-innovation, which is not necessarily venture innovation. investments into financing, which is a lot, which is going into sunrise sectors. Right? So I think private equity and venture capital in some ways share that load. And I think the amount of global cognition it is creating for Indian businesses, and the fact that Indian businesses over the last 5 years have become a lot more confident, a lot more, fearless, and a lot more demanding in terms of what they can do with that capital, I think is a phenomenal rub-off that all of us present in this room will see over the next 5 to 7 years.
All right, my final question on this. Karthik, while investors are also opportunistic investors, they have to look at their returns. But while we talk about nation building through private capital, it has to be very patient and also fairly allocated in the areas where we want to see impact. So social impact, empowering the categories and sectors where we as a nation need to grow, and channeling the investments over there. How do you see this capital allocation?
No, I think the two things that are happening there. One, the government itself recognizes that all of these are not, sort of equally attractive from a capitalistic only perspective. Yes. So one is the same way they provided a stimulant to, domestic venture capital 10 years ago. Yeah. I think there is an attempt afoot to actually try and propagate that for very specific India-centric social sectors. Yeah. So I wouldn't be surprised if they announce 1,000 crores or 2,000 crores towards, manufacturing in India, or electric vehicles in India, or agri in India. Yes. Things that can actually accelerate everything we've been talking about for the last 20 minutes, right? So that how does innovation not stick to the 100 million people who are already well-to-do in this country, but how does it percolate down to 500 million and then 1 billion people? So you will start seeing, I think, in climate, for example. Yes. So that's one. Second, I think, unbeknownst to most people, the generalist early stage fund is almost gone, actually. Yeah. So if you see any new franchise that's formed after 2016, 2 out of 3, if not 2 out of 3, 1 out of 2 funds are super specialized. They only focus on sectors that they actually have a deep expertise into. And about half of those are very naturally inclined to sort of social/innovation, right, economies. Yes. So someone like a Sunil sitting there in the front row will do only deep tech in this country. Now that could be anything from, medical devices to EV to something else, to life sciences, which are all super impactful, whether that's for an Indian customer or a global customer. Whereas someone else might do only agri, which only serves the Indian customer, and usually will not be touched en masse by, some of the bigger funds. Yes. For us, it'll be 10% of our exposure. For them, it is 60, 70% of the exposure. Yes. So it's a natural order of things. As you heard from some impact funds in the morning, this is built into everybody's market models. Yes. You can't force this down. So if you deliver outcomes at 15%, if not 25% compounded, there's more than social impact money than you can ever absorb. But it comes back to showing the moolah back. Right. If you've not generated 15% and given it back, then they'll say, this is not charity, right? I need to see outcomes. So I think we're all on the verge of it. I think next 5 years are super exciting.
I think 5 to 10 years, the growth potential looks very, very promising. But I would say that investors are getting very, very specialized in what they bring to the table, not just money, but a lot of times alliance and expertise and support for the entrepreneurs. And our entrepreneurs are also getting that support for their R&D and innovation to thrive and get that capital. So I think this combination is a very fitting combination at this point, and a lot to be exploited from this and benefited for this for nation building. Thank you so much, Karthik and Madhur. It was an interesting discussion, and thanks so much to all the audience as well. Thanks.
Engaging to say the least, talking about how we are seeing India surpassing China.
You have a shortfall of interest, whether you have a default or shortfall on repayment of loan. There could be early interest receipt, there could be early principal repayment, there could be a rollover at the end of the tenure where there could be some restructuring of the loan, and so on and so forth. It just keeps on going. Globally also we see that administrating a loan portfolio is very difficult, because in today's world as well, your agent notices in many cases are still in paper format. So when you deal with those kind of intricacies and challenges, obviously there are learnings. Learning is to make it very easy is that if you overcome all those challenges that I just mentioned, then you will sail through. However, it is not easy, right? Because all that you need is a very good technology platform. Without technology platform, it is very difficult to administer a loan or manage the investor level reporting or accounting of that. B, you need a good mechanism to collect the supports and the documents from your underlying. Now, the example that I gave was of direct lending where you could have subscribed to a bank would have given it to, say, the underlying could be a consumer finance or a housing loan. This I'm talking about the global fund as we frequently see. The level of discipline required at each borrower level, because your bad debt provisioning will start seeing how to measurement of that bad debts depending on the level of compliance at the borrower level is a task by itself, right? So you really need a good mechanism whereby you collect the documents and supporting for the loan, which with the help of which you'll be able to administer. And I think lastly, I would say it is better to engage a third party rather than putting your own resources doing the administration of loan or accounting or investor level reporting. The reason I say this is because, as I mentioned, you really need to focus on your flexibility or the structuring of the deal with your investor as well as the investing company. And if you focus on to the known core areas, it is quite likely, we've seen global funds, it is quite likely that, one can miss the bus. So those are the learnings, I think, for what we see, working on a global fund.
Thank you so much, Atul. So I will move to the next round of queries I have for my panelists. I am cognizant of the time. We have 18-19 minutes left, so I'll get some quick answers for each one of you. So my question to you is, Rahul, you guys have been, at Trifecta, you have been the pioneers of venture debt in India. On the venture debt side, you raised multiple funds back to back, and primarily your capital has been from the Indian domestic institutions, family offices, HNIs. That way, so what's the secret recipe here? Like, if you don't mind sharing it with others, we can get some cues.
It's a very thick skin. No, I would say that like any other business, one needs to be in the right place at the right time. And I think back in 2015, I think we were in the right place at the right time. I think there was a rising tide of interest in the venture asset class. But I think Indian institutions and families had three concerns. One, I don't think they liked the binary risk of early stage venture. Two, I think they didn't like the fact that the duration of a lot of equity strategies was 10 years. And three, there was always this concern around exit risk. Will I get money back? So I think when we went to them to talk about venture debt as an asset class, we made it a point to address those specific issues of risk profile, duration, and exit. And I think that made the conversation a lot easier because I think they wanted to allocate capital. It's just they needed the right product. So I think some of this comes from, I think, figuring out, what do they want to invest into versus what are we selling? And of course, I think on the demand side, the early stage venture funds had done a great job for 10 years in creating a foundation of borrowers that could absorb credit because the risk profile had changed. So I think Fund 1 was largely on the promise of this is a new asset class. I think Fund 2 was a few years later, we had something to show. And so there was a little bit more track record. And then Fund 3, I guess, just built on Fund 2, and we had some DPI. I think we heard earlier today, DPI is what people care about. I think the good news with, say, even performing credit or venture debt is we generate income every quarter. We distribute that to our investors. So there's real evidence of returns. And so it makes the conversation a lot easier when you go back and say, can you please put in some more capital? So I guess there's no secret sauce other than just, staying disciplined and keeping at it.
Great, thank you so much, Rahul. My next question is for you, Amit. You wear various hats at Edelweiss, right? You are into the performing credit space, real estate, or pure lendings. So what are the finer nuances and differentiators between each of these strategies, if you can throw some more light on these?
So I think, again, for all the strategies, I think the secret sauce you were asking for was actually track record, track record, track record. I don't think there's anything else actually that defines any alternate asset manager. I think the private credit spectrum is a fairly spectrum which is wide. So you have funds raising capital from promising a 13% odd returns to all the way up to high teen returns on the private credit side. So, and I think we as Edelweiss Alternatives manage $4.5 billion across the entire credit spectrum. I think it's very important to understand, so investing is quite well understood. In fact, most of the reporting that I see is on investing, and most of the excitement is about investing, that this is where Edelweiss invested, this is where Baring invested, this is where IIFL invested. I think it's also important to understand what is the domestic LP looking to give you money for, because this is a capital which is unlike the previous avatars where it was drawable back at any given point of time, let's say in a mutual fund structure or in a bank structure where they are giving deposits which can be drawn. These are 4 to 5 year locked in capitals. These are capitals which they can't really ask you back. So I think the market as it deepens, and that is where I think the more the number of competition coming in, I think it is actually better for the industry because you are deepening the market. Like for example, a very recent regulatory change of dematting all the AIF units. I think that is a very, very progressive thing because now people can look at it in their demat accounts, these demats, there can be trading. Like we have seen secondary transaction in AIF units. We have sold over $200 million of secondary AIF units over the past couple of years. That is an example of deepening of markets. You are seeing non-convertible debentures being traded between funds. We sold down something to the market, and so the market is beginning to deepen. So I think the LPs will start becoming more cognizant that they have liquidity from outside the market apart from only contributing into the fund. So that is going to lead to a lot of development of the market. On the investing side, I think there are only 3 things which the investee entity is looking from us, or a corporate who actually borrows at non-bank rate or bank plus rates. I think he's looking for 3 things. A, his growth is faster, and I think as an Indian economy, the growth is faster, and sometimes the debt capital from the banking system is not able to basically move at the same speed as which the entrepreneur wants to move. The second is flexible solutions. So he's not looking for inflexible approaches because business is cyclical. When you're talking of 5-year, 7-year horizon funds, you should be able to meet the cyclicality and also offer him flexible solutions around coupon or structuring around equity or variable return. And the third thing is more of a partnership approach that he is looking for. I think what we have realized that it is very impossible, I would say, or very hardly possible for us to make returns unless our clients actually ending up in a healthy position and making actually good returns out of our investment, because debt capital is supposed to enhance equity returns at some form. So I think if all of those 3 objectives are met, there is enough and more amount of capital that we can deploy across a core strategy, performing strategy, special situation strategy.
Thank you so much, Amit. My next question is for you, Kaushal and Akash. How you're looking at the mid-market space as an opportunity, because globally, if you see, the highest amount of private credit is attracted by the mid-market opportunity, right? And how do you see it from a performing credit perspective, because you two champion in that, right? We can start with you, Kaushal, first.
Sure. So I think let me start by saying that, kind of highlighted that mid-market space, to my mind, is the most interesting space in the private credit, market right now. Multiple reasons. Let me start by just saying I think perhaps the most compelling risk-adjusted return strategy, which we are seeing currently. We of course as an institution have been focused on this area for more than 10 years, more than a decade now, and we have done deep work here. We have done extensive data analytics. What we have realized, and it's a very interesting point, is while the mid-market businesses by size are smaller, And to that extent, they have more limited access to the public market in terms of capital. But if you look at the mid-market businesses, and especially the top quartile businesses, which by itself would be, I think, would be more than 1,000 corporates. If you compare them to the larger counterparts, they would compare quite favorably in context of any of the matrices you can talk about, the profitability ratios, you can talk about the return on capital, it could be the leverage, it could be interest coverage. They compare pretty favorably with the larger corporates, which means that when we are able to generate a delta IRR or return on the investments which we make on the mid-market space, that comes from a very compelling kind of thesis in terms of the risk-return strategy. I think also, just to kind of highlight the fact that, while mid-market is a very interesting space, one very important aspect of doing this business is that it takes a lot of, patience. It takes some bit of effort and long time period for you to build the right sourcing channels, to understand the risk aspects. I think David was talking about, one needs to be very cognizant about how you structure the transactions, also the, how you think about post-deal monitoring. So there are a number of intricacies of, doing this business, which comes, with time. And to that extent, people who have kind of spent time doing this over the last decade or so, are pretty well positioned to kind of take the benefit of this space. Just in terms of, I think the opportunity going forward, the opportunity seems to be just growing. Over the last few years, if you look at it, the mid-market business has been more oriented. Some of the sectors, maybe, services or, infra-linked sectors or renewables. But what we have seen over the last few quarters in particular is that the manufacturing space has come up pretty well. And to my mind, over the next 2 to 3 years, the manufacturing demand itself in terms of capital would provide a significant impetus in terms of, how the mid-market, business grows going forward.
Yeah, just to sort of add on, I'll just add a sort of a couple of points to what Kaushal said. I mean, we think of credit as two pillars within performing credit. One is where you're looking at the larger, more structured transactions where you're solving for a specific solution or a flexible capital ask. But the mid-market space for us is equally compelling. And we've looked at it from 3 points of view, right? So 120,000 companies between $50 million and $500 million of revenue where operating leverage is below 3 turns, right? That itself shows that, and this used to be 4 turns maybe pre-COVID, right? So we're seeing a fairly healthy set of balance sheets, diligenceable data, fairly well-run businesses who have long track record, who are now coming to the credit spectrum where access to capital is a constraint, right? So you're solving for a pretty basic need of growth capital, but you can structure fairly effectively and you can really get returns which are easily available because you're solving for an access to capital challenge. The other sort of piece of data is that if you keep out services industries or sort of asset-light industries, like Kaushal said, there's a wide variety of industry diversification available, and you're not specifically doing thematic investments, if you will, and you can really build a portfolio fairly sensibly around the whole mid-market space. And I think all facets of credit protection are available, right? So business assets, cash flows, promoter assets, promoter recourse. You can really build a very sensible credit package without being sort of diverted away from classical old school lending principles. And I think these 3 facets along with the returns make it a very compelling piece, at least for us. And I think investors like that, right? They like to see new businesses, they like to see growth capital trades, and they like to see well-structured transactions within the risk reward that one can really build effectively. So because of these 3 or 4 points, I think the opportunity is compelling, it's large, and within that space, supply of capital continues to be limited.
Thank you so much, Kaushal and Akash. So my next quick question is for you, David and Atul. What are you seeing that how the foreign funds are looking at India? I had asked that question, but what can India do better to increase that foreign inflow of capital in India in the private credit space? What can the regime here do differently to attract more global capital? I may start with you, David, first, and Atul, if you can quickly chip in.
Okay.
I won't get too preachy. I'll try and make some points though. There is no syndicated large entry point to get familiar with Indian credit transactions. There just isn't. That exists in other markets. It's very simple for someone to come into a market and see, the rigor, the patient approach, basically everything you'd want to see in order to get comfortable with the debt investment. It's hard to see that. So it's very difficult to attract international capital unless it's patient, unless it's been told the story, and ultimately it's, frankly, going to be done by someone on the ground typically. So I would say take a very patient approach to attracting the international capital, and make sure, the most important thing is you sell the story. I mean, it's obvious, as I said earlier, the general trends, but private credit in the country is still relatively new. It's building the track record, selling that on, and saying all the things that people expect from private capital, the sensible way it can be deployed, but ultimately a way that is flexible, exactly what it should do, and selling that story to a bunch of investors that think it's that way, but isn't necessarily sure because they just can't see it.
I think I will have a different perspective here. We do a lot of due diligence on behalf of our client with their prospective investors who are looking to make an investment into the fund. So, if I have to summarize the sort of inquiry that comes from them, they're all related to governance, transparency, independentness, controls and checks, not just for the fund, but for the fund administrator who could be doing they're providing the fund admin services to them. The kind of flexible arrangement or the bespoke arrangement that we've all been talking about also leads to questions regarding whether how much is the independent valuation as a fund admin will do, whether there is a proper onboarding process for the investors, AML, KYC, as well as for the vendor, whether did you have any regulatory, adverse remark, whether the auditors had an adverse remark for, for the fund as well as for us, whether, are you complying with the timeliness, whether, you have a technology deployed to take care of the transparency or the bespoke reporting that they need. It goes to an extent where one of a very large institutional offshore LP had also inquired that do you have a mechanism whereby you can convert the paper document into a digital document and therefore then let us know about, give us a lot of reporting at a granular level. So there are variety of kind of questions that come along with it. And, but I mean, if I have to again summarize, it's all about transparency, an ability to read data, an ability to use technology and governance. I think those are the questions I would summarize.
Great, thank you so much, David and Atul. My last question is to you, Monu, and see, there is a saying, and I'm coming to exits, I'm talking about exits. There's always a saying that nobody will give you a sweeter story or a better story than somebody who is trying to borrow money from you, right? And there's also a notion which will say that give me a loan and leave me alone, right? So that brings me to the final question on exit. How you are seeing the exits shaping up right now, how you are trying to prevent defaults, and if there are any lessons learned which will be useful for the industry. So, like, quick take on this.
So the exits in private credit are a little different from private equity. It's big brother. So what happens, unlike private equity where there is a one-shot exit most of the time, in private credit we see multiple recurring cash flow based repayments, and so that kind of in some way lends some kind of visibility to your exit strategy, though I must say it does not make it any easier. So when we look at exits in private credit, it has to be it's very intense. It has to be a holistic approach, right from client selection to structuring, monitoring. This post-investment monitoring is a very, very important part of this. So in the industry, private credit has existed in some form and manner for the past few years, mostly large structured deals, which were buyouts, leverage deals, or distressed, participated by large funds, domestic and foreign. But in the current avatar, which is the performing credit and these mid-market type of companies, my belief is that the track record is still building. But from whatever track record we have on exits, it's very promising. In the last year or two, two key trends I would say is that one, many funds have exited their investments, credit investments, ahead of maturities. And that reflects good selection. It reflects healthy liquidity with the in the corporate balance sheets. And the second is that there is a healthy mix of takeout. So it's either through regular cash flows as per the plan, or through refinancing, or even equity takeouts. So that's the first part. We as Avishkar, you know, we are very, we again have tightened, or we have very deep processes for managing the entire loan journey. So we're very selective with our origination, and that is coupled with structuring. We do, and like a lot of credit funds, we do a combination of collateralizations, which is promoter guarantees, business assets, cash flow tightening, etc. We are very cognizant of the priority of cash flows, because when things go south, it's your priority that matters. So the other thing we do is that we focus on our portfolio concentrations. We are a sector agnostic fund, thematic, but not sectoral definitions. So we have sectoral caps, and that kind of helps us manage the industry risk. And my key messages or learnings from the you know, credit industry so far is one, credit is a cyclical business, and we all must be cognizant of that. We are sitting in a buoyant market, and that sometimes make you believe that it will stay like this forever, and that's not the case. So however healthy the corporate balance sheets look right now, one cannot take the eye away from the downside risks and have to mitigate that properly. I think the other key message I want to leave is that do not get swayed by the pressure of investments. Be patient and get the right deal. The worst thing that can happen is if the fund managers or the investment teams start lowering their credit standards in the pressure of liquidity sitting in the funds to make quick disbursements and move on to raise the next fund. So yeah, and of course there's no substitute to detailed due diligence. We all believe in that. You have to go through external, internal validations and tight post-investment monitoring.
No, thank you so much. The last part, as a lawyer, I loved the most, right? You need to do a detailed due diligence so you know to whom to go. And so thank you so much. It brings me to the end of this panel. I have taken liberty from Rajat. He has allowed me a couple of minutes, so I would like to do a quick rapid fire. I'm saying quick rapid fire, actually that way, and maybe expect a word or two from each one of you, and I can start with Amit, and maybe we can, with Akash, and we can go so on and so forth. So my question to each one of you is that, which is one book or a web series or a movie? I call it as a KMP session, not a key management personal thing, what you know, it's more like a know my panelist, right? So the first question is, what is a book, web series, movie which defines the Indian funds industry actually, or private credit industry the best, which you can share with the audience?
I think that's a tough one for not a voracious reader like me, but one book at least, which is completely nothing to do with the credit industry, but which I think is a matter of thing for the private credit industry, I think will be Atomic Habits. I think we all need to have that atomic habit, the need which she said not to do investment for the pressure of it. I think the industry has to have that habit, and all of us as investment professionals need to build that very strong sense of habit of what we are investing in, be core to our thesis. But I don't know if there's any book I can define for the private credit industry or alternate industry in the night, but genuinely, that's what I would say.
Quick ones actually from each one of you.
Book that I think should define us is Same as Ever. It's a fantastic book, but what I'd like one of us to be is the web series Billions. I don't know who can be Bobby Axelrod here, but some of us can try and be him at least, but to have some fun.
For me, Lost in Translation.
The movie, The Big Short, is one of my favorites. It shows how you can miss.
I'd say maybe one essential reading is a book called Principles, which I think as managers who are building hopefully long-term franchises, we need guidance, and hopefully we can pick up that from books like that.
I think I'm missing the name of the book, unfortunately, but it's a book about Bayesian approach to doing business in a way you do incremental improvements into your business, and that's what I think the industry has been doing over the last few years. Just forgetting the name of the book, though.
I think it's a web series called Dumb Money. It's a Netflix series, and it talks about how you get the money. So not particularly for private credit, but generally about investing and how it can go wrong or correct.
Last 1 minute, starting with you, Amit, again, sorry to put you on the spot. One thing, or what you would have been if not the fund manager, right? What you would have been, could have been, should have been, or what you will be, right? If not the fund manager. Quick one take for us.
I'm a chartered accountant, so maybe an accountant, I guess.
I teach kids sports. I had this question in an internal session 2 weeks ago, and I honestly said unemployed. Because I'm truly doing what I enjoy doing, and I wouldn't really want to do anything else, so I'll go with unemployed. How about that?
So I've been a corporate banker for 25 years before this and jumped into impact investing last year. As of now, I can't see myself doing anything else but this.
Yeah, hopefully, if one has a life after this, which seems like it's going to be pretty tough, but I'd love to be an architect. So.
Philosopher, maybe?
I think I would retire and enjoy my life.
Good one. Thank you so much to each one of you, and that brings to the end of my session. Thank you so much to each one of you for wonderful insights, and thanks to IVCA. It was glad to have all of you here. Yeah, thank you so much.
All right, India is emerging as the next big destination for private credit. Thank you all so much for being with us. I request you all to stay on stage. We have Mr. Rajan Anandan, Managing Director, and Peak 15 and Surge joining in on stage. We'll be presenting you all with a certificate on behalf of IVCA. Rajan, please do the honors. All right, not just insights, valuable as they were, but also some book recommendations, web series, lots to take away from that very insightful panel. Moving right on then, we want to shed light on the expanding role of private credit in India's financial landscape, paving the way for new growth opportunities across various sectors. So we have our next fireside chat, and ladies and gentlemen, get seated. You do not want to miss this one. Join me in welcoming on stage two very distinguished speakers. We have with us Mr. Deepak Dara, Senior Managing Director, and along with him, Rajan Anandan, who is the Managing Director, Peak 15 and Surge. Please, could we have you both gentlemen on stage?
Okay, can you guys hear us in the back? All right, Deepak, we're getting into private credit. That is just about the biggest panel I have seen outside of a government event in India. So, and I think Rajat gave them extra time. By the way, private credit leaders, next year we expect you guys to be the sponsors. See those names? The lead sponsors, that needs to be all of you, because clearly business is going very well. And by the way, they took away 5 minutes from us. Did you notice? Not only are they running 20 minutes late, they took away 5 minutes. So we have a grand total of 14 minutes and 13 seconds. All right. So let me introduce Deepak. Deepak is a senior managing director and India head for OTPP. How many of you know who OTPP? How many of you know? Okay, right, about a third of the room. So we're going to have you introduce. He leads all of OTPP's investing and portfolio management in India. And prior to his joined OTPP in 2020, and prior to that was at BCG. I was at a rival consulting firm before you were born, Deepak, so, but I won't hold that against you. Was at BCG where he led a lot of the private equity work for a very long period of time. So, Deepak, it's great to have you. So what we're going to do is, since we have now 13 minutes and 32 seconds, we're going to actually do a few things. I'm going to have Deepak talk a little bit about OTPP. What do you guys do? How can everybody in this room benefit from you? I think they're all trying to raise money from you. I don't know if they're doing private credit or not. And then we're going to get into 2 short questions. That's all we're going to do.
Look, let me start off by letting you guys know that we are an LP in the traditional sense, but we are actually a very large GP, right? So if you take $250 billion that we have, of which 80% is managed in-house, and only 20% goes to managers, right?
But 20% of 250 billion is 50
It's still a large number.
50 billion. How many of you are raising capital? Anybody raising capital? Only Karthik. Nobody else is raising capital. Oh, raise your hand. 50 billion is a lot of money, Deepak. 50 billion. Okay, keep going.
Look, if you're in India right now, you're trying to raise capital, it's not such a hard place to be, right? Compared
It's easy
to
for you to say, no?
That's also true. So look, we manage money for 330,000 teachers of Ontario. Try to give them retirement security. The reason we have gone more and more into private assets is because, you know, aging population, the ratio of teachers, blah, blah, all of that stuff drives to the fact that we have to do better on our investment returns. India is one of the 6 markets in which we have our office. So it's clearly a very important market. It's one of the 9 strategic countries as we define it. So we want to do more and more in India over a period of time. We opened our office in 2022. We are invested across infrastructure, private equity, credit, late stage growth, as well as public equities. So across the board, we have our direct teams through which we are trying to do more and more directs. We also have our partners across each of these asset classes with which we are working, so that gives a lift to our private teams.
Awesome. All right, cool. So what we're going to do is, really only focus on 2 things. Deepak is going to talk about what he's excited about in India. Clearly, we can't talk about private credit. We just had 40 minutes of that. So outside of private credit, what are you excited about? And then I'm going to talk a little bit about what are we excited about at Peak 15. And then we're going to talk about what worries us, right? And that's all we're going to do. So Deepak, start with what excites you guys.
Look, lots of exciting stuff, right? So when we started investing in China, there were only specific asset classes we went after. India, given all the things that folks have talked about, demography, digital revolution, so on and so forth, as well as rule of law, we are here investors in everything. Infrastructure, which is an asset class where we primarily just buy and hold for 20 to 30 years. We are doing that in India.
By the way, when you buy a road for 20 to 30 years, like how much returns do you make?
So that's typically we are underwriting at 13%, 12 to 13%, which
30%
is
or
1.3, yes.
Okay. Karthik, you were going to write like a new files, man. The roads file. Anyways, keep going.
This is INR denominated, so obviously, 3%
Okay, good, in rupees.
Yeah. So it's probably 10% US dollar, which is probably better than any of the other markets that we are seeing, right? So in infrastructure, roads and renewables are the 2 areas that we are excited about. The markets are deep, investors have made money, and your counterparty, at least in the road side, is the union government, right? On the renewable side, given just the excitement across the board, like I think we have also started to take development risk. On the private equity side, it's the themes of financial inclusion, right? IT services, which is the true export of India, pharma, which is another exporting market for India, as well as on the healthcare services side. So we own Sahyadri 100%. We continue to look at these themes. The other new theme that we are getting excited about in private equity is related to advanced manufacturing industrials. We'll watch that theme over a period of time and continue to look at that. We'll get into what worries us soon. And then the third thing is related to late stage growth. So we launched our strategy, we did our first late stage growth deal called Express Bs.
Express Bs,
yes.
Okay, we'll talk about that.
And we are excited about B2B We are excited about fintech. We are excited
B2B
about
e-commerce?
B2B e-commerce, yes.
Wow, there's like no margins in that. Like,
so
no, but like what kind of B2B e-commerce are you
so-
excited about? You know, like last time I checked, I mean, you know, really,
Yeah.
like what kind
So
of
look,
B2B?
ExpressB is, right? ExpressB is a
Okay, logistics,
derivative
logistics.
play to e-commerce. So if you think e-commerce is something that would continue to expand, then you want to go after logistics, right? Which would expand over a period of time. The other way to play this would be through logistic parks. So there are multiple ways to play this, right? You don't have to actually pick up a name. You can do derivative play to many of these things. And finally, it's the broader.
Is there like a minimum gross margin that you look for in a B2B like company?
In this specific case, right? So in the margins.
Logistics is like 20+%,
Yeah,
right? Like, so that's decent. But would you invest like in a B2B company that has, I don't know, high single digits gross margins?
No, it's very hard.
Okay, there you go. So most startups, I don't think there's, fortunately there are no startups here, mostly fund managers.
Yeah.
Okay, got it. Keep going.
So that's it. I mean, those are the themes that we are looking at in the short order. And then the ability to actually play in multiple asset classes allows us to dial up or dial down over a period of time on where we want to do investments versus not.
So what, I mean, you pretty much described the entire Indian economy.
Yeah.
I'm just trying to think whether you actually excluded anything. What do you guys not like? I mean, like, are there sectors that you are like, from a direct investing standpoint, we're like, for now,
Yeah,
because, you know, like, oh, you did not mention Web3 and crypto. That's good.
So look, broader India consumption story, the only pieces that we like is high margin businesses, right? Just beauty is one example, which is a higher margin business. Businesses where you don't have positive unit economics, we're not going to go after, right? So that's one piece for us to look at. Within each of these areas, there are subsectors that we like, right? I'm not going to go after the entire financial services economy.
So within financial services, what do you not like?
What we like, I'll give you what we like, because not
Okay.
like would be, right? So what we like is housing finance, MSME lending, as well as auto finance. Those are the three themes that we like. Everything else is excluded so far. This is also driven by where our teams have actually done the deep dive and where we think we have the right to win.
Got it. Okay, cool. I'll ask one last question, and then maybe I'll talk a little bit about what we're excited about. You know, there are a lot of, you know, you're doing a lot of direct investments. That's what I think most of your team does. But if you were to invest in local Indian fund managers, Deepak, what would you look for?
Look, we are already investors into many of the managers on the private equity side, right? So
On the private equity side,
yes.
okay.
So as well as we are investors in.
Yeah, I know.
50.
Thank you for that.
But look, at the end of the day, I think we're not going to do any more new private equity fund managers, right? Because we're investors in Kedara, we're investors in Chris, we are investors in some of the Pan-Asian funds as well as global funds. And we are already coming across many of these folks looking at the same set of opportunities that we look at, right? Private equity, we look for opportunities 150 million plus in terms of co-control, and control transaction 300 million plus. There are probably 14 such transactions that happens in all of India. So
14 per year?
14, yes.
Okay.
In all of India. It doesn't make sense for us to get into to drive, you know, opportunity for us for our direct team. On the late stage growth side, because we are later stage, we like investing into earlier stage funds. So I think SaaS would be one of the areas in which we would like to have a manager, so that if they are going Series A, Series B plus, we can go at a later stage.
All right, good. There you go. SaaS, you all. But we are excited about everything that is tech and tech-enabled. You know, if we look at our investments last year, we were quite active, especially in the early stage business. About a third of our investments are consumer broad. So that's sort of about a third. About 25 to 30% software now is really developer tools, right? So that's about 25, 28%. Last year was the first year where deep tech became quite meaningful for us. We made our first 2 semiconductor investments. We have a green hydrogen electrolyzer company, advanced manufacturing with IP. That becomes very, very interesting, and a bunch of companies like that. And then early stage, we've always been very active with fintech. Probably have 25 fintech unicorns as a franchise in India. So I think those are the things that we are quite excited about. I think the new thing for us, Deepak, at least last year, was deep tech. What we are seeing is the emergence of IP-based companies, right, that are founded by, actually, you know, I co-lead a seed business at the firm, and we run a program called Surge. And in this current cohort, we have 13 companies. 8 of them are founders with PhDs.
Wow.
So it's kind of like crazy, you know, like, in fact, 7 of them are, both co-founders are PhDs. So that's sort of a very big change in our ecosystem where we are seeing these serious IP-based companies that are starting up now. It'll take a long time before they get to your stage, right, where you guys would directly invest. Okay, so that's sort of what we're excited about, for what it's helpful. Let's now go to what are you worried about?
A lot, actually.
Okay, good. Well, we only have 7 minutes, so
yeah, so
you know.
a lot, right? Across the board, this is probably a more complicated investing environment than it has ever been, right? So we lived in a benign geopolitical environment. It's getting worse. We lived in an era of hyper-globalization. There's deglobalization that is starting to happen now. Inflation was also very benign, is starting to go up. Across the board, you're seeing a lot of challenges. If you come to India, the private equity ecosystem, right? So we spent a lot of time, right? And you were joking that we look at everything under the sun. We did no investment, no new investment in private equity last year.
Do any investments last year?
In private equity.
Zero?
Zero.
Oh, wow.
And we looked at, not for the lack of trying, we looked at 6 or 7 opportunities. What's happening is a lot of capital is moving into India and a lot of managers, right? We are in performance business. We are not AUM gathering business. So if you are such and you can...
By the way, nobody ever says they're in the AUM gathering business.
But we don't even raise capital, right? So it's...
Okay. I know, that's what I mean. You can say that, but like I just wanted to set the record clear for the Indian industry, you know, at large.
So it's in the performance business, right? So if there is no reason for us to get excited about a specific sector, and every time we had a valuation in mind for investment, there were investors who were willing to pay 2 to 3 times higher than that. And I think you would continue to see across the board the bid-ask spread to be there. And that does put pressure on closed-end funds, which have a fund life, and it requires them to sometimes deploy capital at a higher rate. We personally, across the 3 areas and the subsectors we like, we didn't find any opportunity that we could get excited about, given the valuation.
So too much capital chasing too few companies in private equity, leading to very high prices. So do you think that, you know, we've had this, in fact, the previous panel, or maybe it was the panel before that, there was a discussion that private equities had a terrific run in India over the possibly last, I don't know, 7, 8, 10 years. You think that's changing now, Deepak, or?
I think, look, you have to go into the pockets, right? So when I say private equity, for us, it's like really large EV companies, right? 300 million plus. Like, I think in the smaller scale and lower middle market to mid-market, you have more opportunity. We don't play into that sector. So you'll see pockets of where things would go. And when I say like we are long-term investor, we think about decades, right? So we just have to get excited about one thing in a year or 2 things in a year and do a large position and move on, right? So and that's where we are going after and doing things. I think it's going to be increasingly hard, especially at a larger EV.
So why don't you invest smaller amounts?
It doesn't make sense,
I guess
right?
you have 50 billion of, right, that's the
250
problem.
billion fund, right? Doesn't make sense. Late stage growth, we are excited about. There we write $80 million checks. There.
So what's the late stage growth check size?
So it's 80 million. So call it 50 to 150, we can be flexible. And there we have been excited because we provide an angle, a capital solution which is not available otherwise, which is like you come in 1 step before the IPO happens, you consolidate the cap table for the founder as well as early stage investors, and you take away the pressure from that stock right at the IPO. That specific solution is where our capital is differentiated. So we are finding opportunity. I mean, a lot of crossover capital is gone, and there has been some exit of capital in late stage growth, and that we are finding quite attractive. Again, as I said, each of these markets are cyclical, right? Private credit we used to like a lot. We never created our own private credit program because right now the yields in US are really high. But once the yields start compressing, then India starts to become more attractive. So that way we can actually play across different things. But I think, generally speaking, lots of capital is about to come to India, given all the talks that are happening, and that will continue to put pressure, right? This is one, India has never had dearth. I mean, there are some moments in which we have had dearth of capital. India, the problem is the supply of scaled assets. I think that would continue to be the problem. I don't think capital chasing deals is going to be a problem for a long period of time, at least from our perspective.
So that's anything else that kind of worries you about, just other than the fact that you can't find a company to invest 150 million? By the way, we have lots of them, Deepak. You know, just saying, you know, I mean, like, other than that, anything else that worries you? Are you excited about the macro, the long-term trends, all the consumption patterns?
I mean, look, we have dependency on climate, right? Extreme heat creates issues. especially for India, especially given our dependency from an agricultural standpoint, as well as employment from an agricultural standpoint. The second piece is related to just inflation and what happens with broader inflation. All the macro things that apply to the broader geography also apply to us, as well as commodities. Our exposure to commodities is really, really high. If something were to go wrong in one of the regions, that starts to create issues, right? And if you think about our geopolitical positioning and the neighbors that we have, that also is not, we don't have friendly neighbors, right? So there are a lot of things which can create issues from a macro standpoint, but generally speaking, there's a lot of things to be positive about as well.
All right, good, good. A lot to be excited about. I think from a, from a venture standpoint, if you ask me, like, close our eyes and, wish for something, so my partners tell me that's not a good strategy in the venture capital business, but anyways. It used to be, by the way, exits, but I think now the IPO markets have gotten to a point where actually it's very exciting, right? I think we'd be quite shocked at how many of our collective sort of portfolio companies are going to not just get profitable, but very profitable. If you ask me what's the one thing that I would love to see more of, it's not something I worry about, but something is more technical founders, deeply technical founders, right? Across spaces, I mean, as I said, right, like 8 of our 13 companies have PhDs, but the reality is we don't have enough deeply technical founders starting up, right? That's why, for instance, if you look at AI at the foundation model level, the Bay Area is way ahead, right? I mean, China is sort of number 2. We could argue that, UK with Oxford Cambridge ecosystem is further ahead. So whether it's AI, whether it's quantum, whether it's semiconductors, whether it's, energy transition, I think having more deeply technical founders starting up, and by the way, this is not a problem we can solve as a nation over 5 or 10 years. It's a 20-year game. We got to double down and triple down on our universities, have many more PhDs, have many more research centers established and so on and so forth. But I'd say that's probably the thing that, because, as we, India today is, we are world class in many areas, right? Fintech, transactional commerce businesses. I think we are probably a few years away from being even in software, developer tools, things like that. But the next big frontier for us is these sort of what I call IP-based industries, where we have to really become quite relevant. All right, with that, let's end with, we have just under a minute left. What's the one big priority? I mean, we're 2 months into 2024. If you were to say OTPP India, one big, huge focus that you have, what is it for you guys?
Look, it's franchise building, right? Going deeper into each of our asset classes across the sectors that we go after. I mean, that's one big priority for us in this stage. Just our right to win, increasing our right to win. It's extremely competitive, but there are opportunities out there, as you were saying, for us to get deeper and creating a right to win. Having an angle in every situation that we go after would be extremely important. That is one big priority for us. How about yourself?
Yeah, I think for us, we just want to find the Google. It is that company. It is that company. By the way, we do have a whole bunch of mini Googles. We just want them to become Google faster. All right, with that, we're going to wrap up. Thank you very much, Deepak. Let's give Deepak a big round of applause.
And Rajan, a big round of applause from someone who interviews you to see you doing the quizzing. That was absolutely wonderful. So many takeaways. And please, can we have on stage Ashley Menezes, who is the Vice Chairman IVCA, as well as the partner and CEO at CRISCAP, to present you both with a token of our appreciation. So many key takeaways from that discussion. Roads and renewables looks promising. Late stage growth is where there is a lot of exciting opportunities. Too much capital chasing too few companies. And then, of course, that the IPO markets are looking exciting. And let's hope that your endeavor to find the next big Google, Rajan, happens sooner rather than later. All right, let's move right on then and focus on the next discussion of the day. A new digital ecosystem that includes close to 1 billion people is being created at a scale that is unprecedented anywhere else in the world. And to prepare for this next decade, the India Stack, a new generation of public and private digital infrastructure in the form of last-mile internet connectivity, has emerged. Enormous opportunities exist not only in the digital but in the product ecosystem. And as India is accelerating this backbone digitally, Our next panel is going to discuss perspectives on how India can lead the next wave of product and service offerings. So let's welcome on stage and put your hands together for Anuradha Ramachandran, Managing Partner at TVS Capital Funds, Jenny Lee, Managing Partner, GGV Capital Asia. We also have Mohanjeet Jolly, Partner Iron Pillar, Manish Khetrapal joining in, co-founder and partner at Waterbridge Ventures, Sagar Agarwal, co-founder and partner at Beams FinTech Fund. Is there anyone in the room? Please join us on stage. We also have Srinidhi Kalvupuddi, who is the business leader, Amazon Global Selling. And this session is going to be moderated by Ashwinder Sethi, partner, Analysis Mason. Please, can we have you all on stage for our next panel discussion? Okay, just waiting by for our panelists who seem to have disappeared into thin air or perhaps are in the next room. We'll be getting them on board and they'll be talking about a little bit more about how India has really led the wave of products and services, offerings, and they'll be talking about unleashing the potential, building from India for the world. So that's going to be interesting to get in perspective from them, given the fact that as we prepare for the next decade, the India stack, we have seen a lot of public as well as private digital infrastructure, last mile internet connectivity. So if we have our panelists, please join us on stage. Anuradha Ramachandran, Managing Partner TVS, Jenny Lee of GGV Capital, Mohanjeet Jolly of Iron Pillar, Manish Khetrapal of Waterbridge Ventures, Sagar Agarwal, Beams FinTech Fund, Srinidhi Kalvupuddi, who is joining in from Amazon Global Selling. And as I said, the session is going to be moderated by Ashwinder Sethi, partner at Analysis Mason. Over to you, and ladies and gentlemen, a big round of applause.
There definitely is an opportunity for some of the fintech evolutions that happened here or to get replicated. The second part of it is also that even in India, as digital transactions rose, the back-end digital infrastructure also started increasing substantially. So you required management infrastructure, which is purely tech platforms. They have nothing to do with regulations, right? It's a tech journey within a bank or within an NBFC or within a fintech. A lender. So those are actually like non-regulated entities. They are tech platforms which are built for scale. And that's basically also something which is actually getting exported across these kind of markets. That's something that we have seen as a trend across the different kind of players that we've been looking at in the tech infrastructure space.
Manish, and sorry, Sagar, I know you have some different views on the topic, but yeah, we'll be...
Yeah, no, I think, thank you IVCA for having me over. I think it's a pleasure to share the stage with some of the most esteemed panelists, so thank you everyone. I think just from our perspective, right, fintech is slightly different as a sector compared to other enterprise SaaS or enterprise tech, right, so slightly more complicated. I think I'll divide this into three parts. One is the capability, second is the opportunity, and third are the challenges, right? From a capability perspective, if you look at India, we've been the outsourcing capital of the world for nearly 3 decades now. Almost $150, $160 billion of revenues comes in India from the outsourcing businesses. IT, IDC services companies are contributing that today to the global markets. 55% of that primarily coming from BFSI market, right? So that's a large contribution by the IT companies towards the BFSI segment. Yes, it's largely been export of services, not products. We have a cost arbitrage, we have a labor arbitrage in the country, which allows you to generate dollar revenues and probably INR costs, right? So is there capability? Yes, we have 1.5 million engineers coming every year. 70% of those engineers are coming in the computer science, right? So there's a huge developer community which is coming out in India. But does that capability result into a large opportunity? Today, yes, there is an opportunity. $500 billion worth of products is being consumed by banks and financial institutions globally. And this is not contributed only by the traditional guys like Infosys or Fiserv of the world. It's also being contributed by new age players like Lentra, M2P for that matter, or Solaris Bank, right, in the US. So a couple of new players are also contributing. But this is not just about building point solution. It's about building full stack solutions. Today, we are on cloud infrastructure. We are able to build a microservices infrastructure. So you can transport the stack from India to overseas. Can you do it sustainably is the question that we're asking. I think through absolute innovation, it is possible. However, it's not so easy given the capability and opportunity. There are challenges, and which is why we're not seeing large outcomes from India to overseas yet in the fintech space. We've seen an enterprise SaaS. I think fintech is still evolving. The first thing we've seen is, as I shared, right, global players are building full stack solutions. Indians are still building point solutions. So if you don't move from point solutions to full stack solutions, it'll be difficult to crack larger corporations outside India. You can be a service provider, but for a product, you require a lot of time, a lot of commitment. I think Anuradha touched upon regulations. When you are talking about regulations, you need to follow local regulations. And localization of data. These are two challenges that we are seeing. When I say data regulations, you cannot be present in a US or a European market without following the licenses and processing system, especially when you're catering to a bank or a financial institution, right? Similarly, I think data localization will take center stage over the next decade. And when you are dealing with people's money or processing systems in local countries, you need to have teams on the ground who are capturing data locally. Otherwise, it will be difficult for you to do business. It will be difficult for you to create outcomes. I think two more things that we are seeing. One is the opportunity from acquisition perspective. Can you still cross the hurdle and acquire companies and build large outcomes? Yes. But are there enough players to acquire? In developing markets, we are not seeing enough acquisition opportunity. In developed markets, there are, but then it comes at a cost. You have to incur a lot of cost. You have to incur a lot of money, which Indian VCs and PEs are still not able to deploy, right? And I think it's an evolution of the market. US is a 50-year-old, 70-year-old market from a VCP standpoint. We will get there, where we'll provide 10-year capital, 15-year capital to companies to be able to build this outcome, right? And second, I think entering or creating brand name. Again, very challenging in developed markets. You need logos, and logos attract logos, right? And you can't get logos so easily unless you put a whole team on the ground. And in developing markets, getting logos is easy, but the governments are not ready, the digital infrastructure is not ready over there in local markets to build businesses. You can enter. Some of our companies have entered US, some of our companies have entered Southeast Asia market, but there needs to be enough and more public infrastructure to build on top of that. So from an opportunity perspective, yes, capability, yes, but there are challenges to build on top of that. If you're able to come through the challenges, you can build a large outcome in the fintech and financial services space as well.
Sure. Thanks, Sagar. Now just moving on from UPI, now India has also produced the ONDC stack, right, which is helping transactions cross-border as well, right? And Manish, you were invested in a couple of businesses like Business and Magic Pin, and Jenny, you were invested in as GGB in Udaan, right? So it'll be great to understand what opportunities lie within this framework that will help Indian businesses to address global markets, right? Jenny, if we start with you.
Yeah, thank you IVCA for inviting me. I have to say that this is my first trip to the event, and my purpose here was really to ask the question, why India? So as a GGV Capital, we've made investments in some of the largest market, US, China, for the last 23 years. And so there's quite a bit of pattern recognition across the board. Since this is the last session, I thought we'll make it a bit fun. Obviously, our panelists are selling India very hard. We have capital, we have dry powder, we are here to make investments. So I have both a GP and an LP hat. And I would like to challenge the group here who has, deep investing strength. So when we think about the, building in India for the rest of the world, I've been plagued by, I buy into this, right? Because if you look at the fundamentals of India, our STEM talent, our ability, just the whole coding capability over the years, I think 30+% of our GDP basically is in services. That's a clear-cut advantage. But I also want to ask this question: what happens when AI disrupt the original strength that cost arbitrage has given India over the last many years, when we said you could outsource to India and they could develop all these products for you for the overseas market, right? US market, for example. Now today, with the right type of AI tools, you actually don't need 3,000 engineers. Maybe you need 30 engineers and a good NVIDIA chip doing training. Right? So that my question then would be that for the Indian entrepreneurs in the audience and for our startup and our investors, what then do we look for when we said we still want to leverage India, building in India for the international market? Do we now need to build more data centers, training capabilities, AI engineers here within India for us to be able to support that next leap to continue to build for the world? So that's how I would be thinking is what's the next 10 years, the next 20 years, if we want to continue to have a strength there? What does it mean to then bring along or understand the India policy and support locally for infra build for us to continue to be a great supporter or source of products for the Western world? So that's really one question. Love to hear the audience as well. And then I think when you talk about ONDC or UPI, the first time many years back in my other LP head, I heard about the digital public goods in India. Some of you may or may not know, so we were part of, GGV was part of the journey in China over the last 20 years where we saw huge companies, payment companies like Alibaba, Tencent really built their payment infrastructure. And the reason why in that market the payment infrastructure was able to be formed was because the private sector was willing to invest, was able to be creative, and was able to roll out the right set of products in conjunction, like in the case of Alibaba for commerce, in the case of Tencent, right? Obviously they bought huge into the Didi of the world to then get payment off. So when I first heard about the digital public goods in India, my first reaction was, oh, that means we're not going to get the 1000x return in India. Because all the great unicorns or decadon or whatever you call it is going to belong to the government. And I hope I'm not offending anyone, right? But as an investor, when I put on the hat and I said, then what does it mean? So the platform companies are gone. What can the application companies do? And is there, now obviously there's huge benefit to connectivity, right? Because you open up access to all the payment, in terms of payment, ONDC for digital commerce. So then where's the value? If the value is not going to be accrued by the largest player and you are going to have a whole bunch of players, how big is this outcome? Is this $1 billion outcome? Can we get $10 billion outcome? Can we get $100 billion outcome? So I think while I see that it's amazing to have infrastructure connect, right, India with the rest of the world, and I think this is the fastest way to get connected to the rest of the world, maybe within the next 3 to 5 years, then the next question is what's going to go on top of the infrastructure that's allowing all our investors here to be able to generate the right returns to continue to fund the innovation for the next 10 to 20 years. I think I don't have a long-term question here, but what I've been thinking about is that when we put it in the context of UPI, it becomes maybe every company is now an embedded fintech company, right? So if you have customers, if you have traffic, whether it's to B or to C, that may be your way to monetize. And on the ONDC, perhaps every company that has some level of customers can now start to think about commerce. And that commerce could be in the form of providing to the sellers, huge outcome. I love to hear the audience, the panelists as well.
Manish, if you want to go in.
And that's to Manish.
Jenny has raised existential questions here, so I'm under the spotlight. Mohanjit, I think you'll step in and help me out on this one. So what I'll say is super quickly, maybe I don't want to miss the point. On one hand, there are companies like you named Business, and I think Udan was mentioned somewhere, and of course, some of them have gone through their ups and downs, but reality is China +1 and the geopolitical situation is helping. So that's, to me, a more obvious opportunity where you just plug the global demand once you've figured out a way to organize supply. So companies like Business basically are factory operating systems. Could be an Agra belt building something from leather. It could be some other part of India building something else in cotton. So that's a more obvious one. But on ONDC and UPI, I actually could not agree more with Jenny's assessment and the question she's raised, that it's while it really opens up and democratizes the opportunity within India, is that really a global opportunity for Indian startups? I don't think so. And I don't even see a path to that. And just to use a very quick example, since you mentioned Magic Pain, of course, companies like them are able to plug, like they're basically making an Ola or a Google Pay also compete with Zomato or Swiggy, right? By enabling all the pieces of ONDC's infrastructure by becoming a technology service provider actually to the payments company and to the logistics company and so on. And all they're doing is they're bringing supply in an organized way. But how do you, while Indonesia has the same fragmented retail market structure, consumer need, online to offline, unless you have an ONDC framework and a UPI framework, there's no economic model there. So some things more obvious, others may, like I said, democratize and create more opportunity within India, but not always. I mean, it's good to talk about. I love the memes, and I also forwarded when the French president is drinking chai and he's paying by UPI, but how do we really have Indian companies monetize? It's a tough one. And on AI, it's a very interesting question. I have some comments, but I don't want to hog the stage. Jenny's question, I don't know if you want us to try and answer that. Of course, we got to also impress our LPs here. Maybe we should do actually a hand raise. How many LPs in the audience? If you don't mind raising your hand. Okay, few. And how many GPs, fund managers? Man, who are the rest of the people? Okay, fair. Okay, we have some idea of the audience. Okay, I'm going to be more honest. There are very few LPs here. But do you want to go first?
So I'm not going to comment on the UPI and ONDC side necessarily. I think we've got experts here. I will make a couple of hopefully explosive or controversial statements. So the OpenAI crew in Silicon Valley has a bet going on right now, okay, started by Altman, that when will a single individual billion-dollar company be created, thanks to AI? So think about that. You have a company of one, and the bet is it's going to happen in the, I think Altman is saying in the next 2 to 3 years, others are saying sort of 4 to 5 years. But that's the power that we're dealing with at this point. So I'm going to weave in a couple. Billion in value. Billion in value, okay? Now, two other things. One on the IT services side. So obviously that's been the growth engine for India for some years, hundreds of billions of dollars of market cap. Now, if I were in their shoes, right, I will be embracing AI, okay? Because like it or not, that is going to be the fuel for your future. So if you read today's Economic Times or one of the newspapers, Accenture, for example, is saying they've invested over $1 billion in training their global staff on AI. That's the kind of embrace that I think the Wipro, Infi, TCS, HCL, et cetera, need to take, get ahead of it, because they have an advantage. The advantage is that they are the trusted concierge for Fortune 500 and Global 1000, Global 2000 companies. Right? They have those multinationals in their fold, and it's up to them to continue to be that trusted concierge. They cannot do it by throwing bodies at it. They have to do it by leveraging AI, because those same customers are still questioning. They're saying, oh my gosh, the board is telling us you got to do something, you got to do something. We actually have no idea how to do it. So the first call should be to that trusted concierge, and that's the opportunity, I think, of a lifetime. I'll just give one plug to a portfolio company. We have a company called Unifor, and I think this is also where the Indian companies can shine. Sarvam and Krutrim are trying to do some of this, but Unifor is a conversational AI company. Spent 7 to 8 years out of IIT Madras training the beast around automating conversations, right? They needed data, they needed conversations. They fed the beast, they leveraged it to create, we think, and we're biased, one of the best sort of conversational AI platforms in the world, right? And then they flipped to a US Inc. and went to Palo Alto. Then they brought in senior researchers from Uber, Google, Microsoft, et cetera. Now, think about this. The seminal paper that was written that got the transformer architecture, which is the underlying architecture for AI, was written in 2017. And do you know that the lead author was a gentleman named Ashwin Vaswani? He was a Google researcher. So we have the Indian DNA that was the catalyst for getting this entire movement going. I think it behooves Indian entrepreneurs who want to leverage AI, whether it's at the data layer, whether it's the application layer, or it's at the DevOps or tools layer, right? Selling shovels to miners, to start partnering with research scientists and that level of credibility. I think if you combine all of that, the engineering talent, the data lakes, the vernacular data that's being collected, I think you've got a powerhouse in the making, or many powerhouses in the making, but that mindset and that sort of collaboration has to take place.
Sorry, just to add, Jenny, to your point on the platform in India, right? I think you're right, the platforms are built, right, by government or NPCI, right, for that matter. But platforms only work when you build on something on top of that, right? You have to connect the platforms. You need to build the pick and shovels business. You need to build apps on top of that. And I believe that there's an opportunity to create large platforms on top of existing platforms, right? These are basic layer infrastructure. UPI would only work if there was Google Pay, Phone Pay, Amazon Pay, Paytm, all of these guys in the market. And they have been able to create large outcomes. Obviously, there's a little bit of free market economy conversation, which we can have separately. But I'm saying there's a large opportunity. Even in fintech, it's financial services first and tech second. If you're building deep financial services business, a $50 billion outcome is possible. Market is deep enough, right? It's not just the platform where you will create outcomes. Can you export these platforms to overseas? Of course, yes, right? That is what new age founders are doing, the pioneer founders are doing. But I still feel that if you look internally, the opportunity is to build large outcomes on the existing platforms for the next decade or so in India.
Thanks, Sagar. I think when we talk about building from India for the world, the next logical question becomes which geographies are best suited for Indian products and services, right? Srinidhi, if you want to share your views in terms of on the product side, what do you believe are the markets best suited for Indian businesses? And Anuradha, if you can talk about from a tech first business perspective, yeah.
So from a product / D2C point of view, it's quite clear, right? I mean, you just look at markets from a GDP, descending order of GDP / per capita consumption, right? And so North America, particularly US, which also happens to be one of the Amazon marketplace, right? That's where we started. It continues to be our biggest marketplace, right? So that's one market I don't think that anybody can afford not to look at if you're a D2C brand trying to build for the world from India. So, that's one very big market. Followed by Europe, of course, in terms of size of GDP, etc. But then, in terms of openness to trade, regulations and so on and so forth, that are perhaps, it's slightly more stringent in the European Union as opposed to the US. US is, far more, free trade, for that matter. Another very interesting geography, of course, I think, and I'm sure a lot of the panelists will also talk about that, is MENA, right? I mean, UAE, of course, given the diaspora, given the consumption capability and stuff like that. And a very recently emerging market is Saudi Arabia, right? Saudi Arabia is another very, very interesting market. Of course, not as open to trade as maybe UAE is, right? But, they're getting there, and, again, the consumption potential there is sort of huge. Right, so this is all of it is on the western side, to India. But talking about the East, Japan comes to mind. Japan is another market that a lot of Indian D2C brands have been able to do well on. But again, Japan also runs into the problem of perhaps not being again very import friendly, right? So if I were to stack rank, I would say US, followed by maybe the UAE, Saudi Arabia, Europe, and Japan, and that's sort of my stack rank.
Makes sense.
Like we were talking about tech-first businesses going to the world, and I think, like many of them have already talked about some of the pure tech SaaS kind of businesses going to the more developed countries like US, Europe, etc. I have a slightly different point of view when it comes to what do we aspire to build next, and that was perhaps also a kind of a response to what Jenny was raising as a point, right? We're looking at product companies, and product companies which can sell in large markets like US, which are structurally very different, right? So the minute you take a product company to the US, you have to have deep pockets in terms of actually acquisition targets, which I think also you mentioned, or you need to have the sustaining power to stay there for a few years and then start building out. if you look at an Indian market and capital which is available freely, there actually like capital is equally distributed between infrastructure, which is rapidly growing. And infrastructure, I also include physical infrastructure. And it is to other kinds of, like products and services which are there in India. So therefore we are naturally a capital-starved country. In a capital-starved country, when you want to create value in businesses, you actually like go to markets where there is a deeper consumption story and there is a capability of yourself to build out the next Amazon, next Infi, whichever kind of company that you're thinking. And those markets happen to be markets which are actually like contiguous to the way that we are evolving, right? And Indonesia comes to mind as an example, right? Very similar in terms of like, like population, in terms of like actually the evolution of the market, and similar market structures, not the same. It'll never be the same. But at least like it is similar in terms of consumption trends, patterns, etc. Philippines is another market, right? Like when you look at Asia, there are these two large markets. Then I think MENA is another large market where you have also the diaspora who can kind of like, like help and create deep markets out there. Funnily enough, one of the like, like larger export markets that I see for some of the emerging fintech enterprises especially is Egypt. Egypt is also evolving in a manner which is very similar to India. Like an elastic run kind of a model is something that actually like, like Flourish, which was my earlier employer, we had funded out of Egypt as such. So portions of Africa which are replicating the UPI stroke, like the Indian tech business story as such. So here's an opportunity for Indian entrepreneurs to go and build for the world and build with their own brand, right? It's not actually like something where you're looking at a structural shift where you're at a disadvantage the way you are in a developed market. But to be at an advantage where you're actually like, like you dictate kind of a lot of the way that you can build out the products and services. So that's something, whereas the consumption and the need and the adoption is actually like there. India is actually in a, so, like there was also this panel of regulators called AFI, which was set up, which was financial regulators. And one of the key things that I've noticed in that is that the Indian regulators are actually much sought after. It's an alternate model which is evolving. Not that the other markets are not sought after, but like India has like established a different kind of a model and people want to learn and know. Brazil, for example, is also another sought after regulator, right? So you look at the emerging leaders and then there are people who are saying that, okay, my distance from the US is extremely high. My distance from Europe is extremely high, but my distance from Brazil or India is not that high. And maybe I use their leadership actually like to grow my markets as well. And so therefore, it comes with a different set of opportunities to grow in a different set of countries. And then you make India the global leader in that kind of a context. When we think of the globe, it's, buying power in these markets, while not as high as the US, is also significantly higher. Value is the lowest in India. Actually, like if you look at like per capita itself, Indonesia is about like twice India is. Right? So there is buying power in many of these markets, which is actually like comparable. The size and the scale of the markets are not necessarily the same as India is, but you can accommodate multiple markets within the kind of infrastructure that you create. Therefore, there is, to answer your question, the ability, I believe, to create $1 billion, hundreds of $1 billion of enterprises, and to respond to Sagar's point as well, which serve local plus contiguous markets, as we call them, right? And these will become the next, like set of leaders, and that's actually like what we are trying to back at the moment.
Thanks, Anuradha. I think we have time for one last question. Sagar and actually Manish and Jenny, this one is for you, right? And we have an opportunity to be a little controversial here. So we were discussing this just before we came here, right? And the question is that how do you see exit opportunities when you look at companies which have a good mix of revenues coming from global markets? Do you see it being any different from a traditional India-first business, especially in the context of what has been happening more recently in terms of reverse flipping, right? Has been a phenomena that has happened in the last couple of years, right? So Jenny, if you want to go in first, and Manish, you after that.
Yeah, sure. So I think exit is a pertinent question, right? Today, everybody is talking about how to build in India for the US market, because naturally, a lot of the business model that's been developed has comparable listed in the US market, the US market from an exchange perspective, the depth of the exchange perspective has the largest liquidity, largest market cap, and therefore in the good old days, you are getting great valuation, right? In the good old days, SaaS is hot. The SaaS companies are priced on 50, 100x PS. But I have to caveat. I think that there aren't a lot of LPs in the room. A lot of times, GPs, you got to tell your story, but not to LPs. At the end of the day, the ultimate number that will show up is your DPI, it's your returns. And so I would actually say that the exit market, as we have observed, is actually slowly changing. And why do I say this? On a geopolitical level, every region is fighting for their own exchange. To have a strong, solid, deep liquidity exchange means that you can allow the entrepreneurship, the private sector who is supporting a lot of the economic growth from an employment and value creation perspective to secure a more stable currency. If you have a company, say for example in MENA, right, listed on the Saudi exchange, or listed in India exchange, or listed in the China exchange, or Hong Kong exchange for that matter. Singapore is trying very hard, though they are way behind everybody else. So I think that in the more bipolar or bifurcated, I want to say bipolar, polar world, there is also a local, regional intent by the government to support their own entrepreneurship, which means that, and we are starting to see India as well, that companies that would probably trade at 10 times PE today on the US exchange may be trading at 50, 60 times PE in India. And so I think as investors, then we have to always put on that hat. Where is the best exchange for value maximization? And so I would say that, depending obviously on the business model and where the comms are going to be, that I would be very supportive of saying, I've brought companies over the last 20 years probably on 6 different exchanges globally. You'd be like, where's the 6, right? They are there. and so really understanding where the best exits would be great. And I think India right now is probably one of the few markets that's still trading at premium valuation. And so to the extent we can bring some of the companies back here to have local leaders, I would say that. I'm a proponent for India. If you build India right with India entrepreneurs and private enterprise, you will be able to build for the world. Manish?
We're over time. You want me to add quick 30-second? I think several hundred millions of dollars capillaries of the world will list here because you'll get the best multiple. 2 billion to 5 billion, don't know. It's an unknown because India may not be ready. NASDAQ, too small. If you're over a 5 billion vision company, you could be in the US. The good thing is LPs, investors, everybody in the cap table is not pushing you anymore to be in the US or be in India. That's why you're seeing the reverse flipping, because you see capital availability from seed to IPO in both the markets, but I think size does matter here. So to me, 2 to 5 billion is still an unknown territory. I'm hoping India will develop. IPO markets here will develop enough, and M&A lot needs to happen to also create space for $2 to $5 billion companies listed or being sold in India.
All right, and on that optimistic note, we'll wind it down. Ladies and gentlemen, a round of applause. Rama Subramaniam of Anchor Capital, please join us on stage to present our panelists with a certificate. Just going to request you to be here with us. But yes, indeed, lots of key, valuable insights that we have gleaned. Sorry.
Okay, while that is going on, I want to leave you all with this one data point. India is going to have a population of roughly 1.8 billion, somewhere between 1.7 billion and 1.8 billion by 2050, at a higher GDP per capita than it is today. So think about, to Jenny's point, the opportunity in India. By the way, we love to procreate. That's the other thing I'm taking away from that. So 1.7, 1.8 billion people, young population still, which is going to present an opportunity, again, of a generation or maybe multiple generations.
Building from India for the world. Thank you all so very much for providing us with those valuable insights. I'm going to request Padmaja, please, to join us on stage to hand out the certificates to our esteemed guests and distinguished panelists today. All right, ladies and gentlemen, a round of applause and for our panelists and for their valuable insights. All right, it's time to get a move on then, and we want to discuss innovation and cross-border investments. The attractive market opportunities, the favorable regulatory reforms, and even the increased avenues for investments have led to a spike in deal activity and foreign investments in the country. In fact, we've seen some fascinating innovation from areas like space tech to automated cars. To discuss this more, innovation and cross-border investments, ladies and gentlemen, let's welcome on stage Dr. Nandini Tandon, co-founder at Indus Setu Global, Padmaja Ruparal, co-founder, Indian Angel Network. Padmaja, please stay on with us. Luisa Monaretto, who is the founder, Tech IA Impact Invest. Visalakshi Chandramouli, Managing Partner at Tata Capital Healthcare Fund, and moderating the session is Kartikeya Prakash, Partner at Khaitan & Co. Request you all to please take the stage for your session. If we could have our next panelists, please join us on stage, ladies and gentlemen. Who is on stage so we can kick start? Dr. Nandini Tandon, Padmaja Ruparal, Luisa Monaretto, as well as Visalakshi Chandramouli and Kartikeya Prakash, who will be moderating this session. Innovation and cross-border investments.
Thank you. Thank you everyone for joining us. I welcome you to a very bespoke session on innovation and cross-border. I have a very distinguished and diverse set of thought leaders here. So as we all know, and some of the points which have been touched upon in the earlier session, today's ever-evolving tech journey, innovation has no border. And when it comes to the cross-border opportunities, from a simple collaborative research to a partnership, the potential is limitless. We would of course touch upon certain sectors which have an edge when it comes to the cross-border opportunities when compared to others. And hence with that thought, without much ado, I'll commence the session pointing towards Visa with some pointed thoughts on the healthcare sector. Visa, you have seen the Indian healthcare journey for really long and you have observed it very keenly and closely. In your thought, what do you see? I mean, what are the offshore opportunities for this sector? Is there any challenges which you have faced? Anything, any insight on that point will be really helpful for us.
Thanks, Kartikeya. So for us at Tata Capital Healthcare Fund, we have now been investing for over a decade or so across 2 fund vintages. And we have a specialized healthcare and life sciences private equity fund, largely doing growth capital investments. So this is one sector where we've seen, I think, tremendous inflows in terms of foreign capital. So if you look at the overall sector itself, right, the last 2 years, healthcare and life sciences has attracted nearly $6 billion of private capital investments. And especially last year, more than 80% of that has actually been foreign investors. So clearly and this trend is here to stay. We estimate that for the next decade or so, there'll be at least about, another $25–30 billion of healthcare private capital that will hit India. And I won't be surprised if a majority of that comes from foreign investors. For us as healthcare and life sciences private equity, I would say our, impact from an offshore point of view, I would say rests across all the 3 pillars. So, one is in terms of our investor base. nearly about 45% of our investor base itself are offshore investors. And this could be a mix of global conglomerates, medical conglomerates. It could be, dedicated global healthcare investing houses, or even family offices for that matter, who are very deeply engaged in the sector. So, so clearly there is, on the investor side, we are also seeing impact-focused healthcare investors. The second, I would say from an investing standpoint, in terms of our current portfolio companies, we have, on a very selective basis, taken the first steps towards offshore investment. 1 out of our 7 investments currently is an overseas, is an offshore company. It's a company in radiology imaging. It's an AI-based radiology imaging, and the name of the company is Deep Tech. So what they do for a living is actually build algorithms and the software platform. They're currently ranked among the top few globally. They scan about 100,000 scans a month or so. And more importantly, they have, as an investor base, before we came in as the largest financial investor, they have investors from Japan, from US, etc. They do work across multiple geographies, although they have a big customer base in India. They also do work in Singapore, in US, Europe, Japan, etc. So that's from an investing standpoint. And finally, maybe let me take an example about some of the exits that we have done from our past fund and vintage. We've had an opportunity to do cross-border exit. We had invested in a chain of dialysis, kidney care clinics, which we exited to one of the large conglomerates in this space. So I would say across the entire life cycle of, say, from an fundraise, investments, exits, we've seen, I would say, a splurge of cross-border interactions, not at a very deep level, but obviously this is a starting point. So we're definitely bound to see that. So it's not something that we can stay away with.
Thank you. And if I may do a quick follow-up on that. You are a AIF based in India, and there is a limitation around offshore opportunities for AIFs to capitalize because of the SEBI thresholds they have. How do you perceive that when it comes to exploring offshore opportunities for Indian AIFs? Does it create some sort of a deal roadblock? Does it impact the deal shaping for you? Any thoughts around those will also be helpful.
Very relevant point, especially in today's context. I think, one good thing is that since 2022, I think SEBI has relaxed norms for AIFs to invest outside the country. But that was a $1.5 billion quota, right? And that has expired now for more than 6 months. So if we have to do follow-on investments, etc., so that's a little tricky how we go about, etc. So it's really challenging. Really hoping that SEBI can look into this matter and we can see this window opening up and expand and also enhance the limit. So clearly this is this is definitely, I would say, a roadblock which we need to cross.
Thank you. No, very, very well said. I think there's tremendous opportunity at all level of financial sponsor journey, and everybody is exploring this opportunity, and perhaps if the thresholds are higher or we have more headroom, there will be much better play to see it. On this thought, Padmaja, I'll direct the question to you. I mean, in your experience, in your recent interactions, which are the sectors you have seen which are gaining more traction from a cross-border opportunity perspective? Of course, some of the names which comes to our mind is deep tech, space tech, and so. But what's your take has been? And then perhaps a second question I would also like you to touch upon. I'm taking a note from what Visa said. Any regulatory gating items one should keep at? You have seen several of those early stage tech and emerging businesses which have either gone offshore or they have undertaken flip, externalization, and several other restructure. What's your take has been on those?
Thank you. Before I start, I just want to first actually congratulate IVCA, Rajat, and the team. I think the event we are seeing today, every year it seems to be growing and growing. So while it does reflect how the industry is going, I think it also says that you have had a huge hand in growing the industry. So congratulations for one more successful event. So, and thank you for having me here. I think what I would say is, we are early stage investors. We invest literally from 50 lakhs to 50 crores. Entrepreneurs can raise, so we are coming in very, very early. And purely from that perspective, we are usually continuously investing in best of the next. We keep having to look for emerging sectors every so often. So I think innovation almost is a DNA for us as we invest. And that is where we've also had a lot of success over the last 18 years that we've invested. Now, what we are seeing in the innovation space is a couple of things have changed, but more importantly, there's a lot of deep tech that has started to emerge. And what I mean by deep tech are a couple of things. These are propositions which have a lot of science and technology. They are building IP. And I think there is a huge focus now that entrepreneurs are focusing more on the product side. That piece is good. And I think Rajan mentioned it in his session that he's starting to see a lot of PhDs start to build businesses, which just tells you that the science and tech part is deepening in the country. While that is good, I think one of the issues that we are seeing in the deep tech, and if you look at these companies, there are about 4,000 or 5,000 companies now, somewhere there that we are seeing. They've raised about $500 million domestic money, another 30–40% FDI that's come in. So this space is growing, even if you look at just last year's numbers. There are a couple of things that are very interesting that's happening. These founders, you didn't see earlier the science and tech guys, PhD guys, actually starting up in the very first place. That started to happen. But the next piece which is missing currently is that the business side, the commercialization side is very weak. And a lot of the early stage investors like us have to do a lot of heavy lifting on that side. So if you want to take innovation cross-border, just a tech product or just a formula or a molecule is not going to go cross-border, right? So I think that's the big piece, that if we are investing in these companies, one has to be prepared to actually help the companies almost on a weekly basis, right? You're always on the phone. They're always asking for advice. They're always asking for connects for talent. They don't even sometimes understand the fundamentals of running a company, right? P&L. They sort of confuse between CapEx and OpEx. It's as fundamental as that. So that, I think, is a huge thing. The second piece, which we've been sort of discussing with BIRAC, where a lot of the biotech companies are emerging, that here, this early stage money has started to open up, right? Investors like us, family offices, angels, they've started to open up. But these companies will die if the next round funding doesn't happen. So a lot of the deep tech companies, there's no next round funding in the country. So it is almost mandatory that they start preparing for the global market, be it the US, be it Europe. So the foundations of these companies have to be global from day one. The way their outlook, the way they set up their processes, their understanding of GAAP of the US, understanding Indian accounting, how they interact with talent, all of that sort of needs to get nurtured almost immediately, because the markets don't exist here, the customers don't exist here, very few do, I would say. And funding surely later rounds is very difficult. So I think that is the second big challenge to go cross-border, but it's mandatory to do that in some ways. The third piece that we are seeing is India's regulatory approval process. If you look at biotech, if you look at health tech, that is very, very, very nascent, right? There is nothing here. There's no equivalent of FDA here. So that is another challenge where companies are almost forced to go global. And that cross-border becomes, therefore, another piece that is very critical. Now, the interesting piece that I find which is happening is earlier, about 4 or 5 years ago, We, for instance, had a company which was based in India, which was being built for the US market, right? And per force, that company had to flip to the US, okay, to attract funding from there. So once they flipped, they got American money, they got European money, they've started building that market. I think today, when I look at some of our deep tech companies, they are still based in India and they are being able to access American markets, the US market, you know, especially space tech, for example. And they are being also able to attract FDI. It did take a lot of heavy lifting. We had to work with Department of Space, we had to work with RBI, we had to work with whoever. But the good part is that after all those months of working, there was success at the end of the tunnel. So I think that's the big change that we are seeing, that how is it now compared to 4 or 5 years ago. And finally, I think the biggest challenge when you're investing is how are you going to exit? How's the liquidity going to come? And that piece is very, very tenuous right now, you know, because you're getting global money or companies are going global. How do Indian investors exit? You know, there are all these issues of restructuring. I think some of the things we've been talking about is, can Indian exchanges allow listing of IP-based companies, for example? Because if you start having liquidity options, then I think Indian money, domestic money will start increasing in these sectors. But, you know, one may think it's all negative. No, I think I'm very positive. This will keep increasing. I think Indian talent will go deeper on the science and tech side. We'll see much more, how should I say, innovative companies, deeper talent. And the good thing is our LPs, our investors are very gung-ho. So, you know, in our I was just thinking, just sort of recapping, and about 70% of our companies do have family money, family office money, or HNI money, who have sort of co-invested. So I think that wallet is opening up, but it's the later rounds that I think needs to be sort of encouraged.
Thank you, Padmaja. In fact, I want to hold your thought on that one. I just want to pick Luzia. You have seen, so the same narrative what Padmaja just explained, from an offshore perspective, from an international perspective. How do you see that in the context of Indian Inc.?
Yes, first of all, thank you very much to IVCA for organizing this session and having me as speaker and sharing the insights with the panelists. Yeah, deep tech, as explained, has the same issue everywhere. It's not just a problem here, it's an issue in different countries. So how to support scale? These businesses start from a technical aspect, a scientific aspect. It is important to find a scalability. Now, one of the answers that has been found is corporate funds or corporate venture funds that have a very strong scientific background, and so they can help scalability. Yeah, it's a cross-border business since the beginning, but I think that for what is the experience, I was investor in deep tech space long time ago. What make it successful is really to have a corporate since day one. A corporate fund, which in combination with the fund is really able to support the technical standard and also to help the scalability. This is one aspect. Back to the cross-border aspect, I think that in deep tech there are sectors and verticals which are more scalable internationally than others. There are some segments which are specific to the countries of origin, and there are others like space tech, edu tech, health tech, which can be transversal. I make you an example that we have in Europe, that you have here in India. We have an health tech in Europe named Doctolib, which is quite known. It started as a deep tech, and is a platform dedicated to appointments and to teleconsulting. In India, there is another company named Nirok Street, which is doing the same thing in Ayurveda. So it's the same technology, but in a different market. So these spaces of this deep tech are internationally scalable, while there are others in which they are too specific to the reality. So this is one aspect of cross-border. Then there is another aspect of cross-border, which is concern more the investors, the LP, the GPs, which is another chapter.
And Lucia, if I need to just conclude the thought on that point, if one is looking to scale up offshore, build a brand, expand the way Padmaja mentioned, perhaps your customer base is there, perhaps your deep tech is more suited to the ancillary tech which is available in that jurisdiction, how to go about it strategically?
So you mean how a deep tech can go out of its market and scale? As you know, the point is to find the right corporate, or sometimes what works and what worked in the past as to have a fund which is backing this deep tech, but this deep tech is making acquisitions in other markets. So they create a sort of build-up in the same technology, and so in that case you became local in day one. So it's not just an internal development, it's really a buy and build.
Okay, understood. Padmaja, I'll just conclude the thought on the regulatory piece. The way Visa indicated that for an Indian AIF, there are of course challenges when it comes to offshore investment under the SEBI regime. Similarly, for the early stage companies which are either earlier compelled to flip offshore, or even when they are sourcing FDI directly into India, that's the trend which you have noticed now. Any other thought from a FDI or a overseas direct investment perspective which becomes ever talked item in your portfolios or your founders when you are interacting? Anything where perhaps from the ease of governance perspective, the government and the regulators can help and do something which can ease up situations?
So I think if I approach it slightly differently, if I may, is to say that when you're investing overseas, it's very clear from the SEBI regulations. And when you're investing in India, of course, it's also very clear. I think the challenge happens that you've invested in an Indian jurisdiction company, and if the company is raising next round or for some other reasons it moves overseas, how do Indian AIF investors, and I would actually expand it, it's not only Indian AIF investors, but also individuals or corporates investing from here, they have a challenge. Now, that's the piece which is a really, which is flipping in some ways, right? And flipping, I think we all know, especially people in this room, what are the challenges. So what we've tried to do in some cases is actually restructure, right? And we are now talking to companies when we invest to say that, you will need to be open about restructuring. So especially if we're investing, let's say in a biotech, or we are investing in a multi-product company, we are saying we'll restructure to create a subsidiary, and the subsidiary can then be bought out by overseas investors. So we've had to be innovative as well to go cross-border in some ways. But I think there is a need, and I haven't really thought it through to be very honest, but there is really a need if we want to breed deep tech companies, we want to create, we want to have companies built in India for the globe, we will need to have a structure, right, which will enable this FDI coming in or markets being accessed overseas. Because earlier it was a little easier in some ways. When we had angels just investing, it was much easier, but now even the angels are coming through a SEBI regulated fund. VC, of course, is coming. So I think, and then there is the added piece on RBI, etc. So I think there is clearly a need for a discussion if we want to take deep tech and build it out in this country. How are we going to do next rounds and exits? Because if that avenue is not open, there's going to be restricted investment. So FDI is one, but if there's a word called FDO, then there's...
If I can add one point on this, when you promote a deep tech, you support a deep tech, the name and the brand of the fund, of the promoter, makes a difference as well. So, you know, why a lot of brands and the PE are so successful is also because their own brand is known outside their own geography. So what I'm very often discuss with offshore funds is that the success of your portfolio is also based outside your geography, is based on the reputation and image that you built outside your geography. So this is require energy, time, and resources to build a brand. A brand is always a brand, could be financial, luxury, but the logic is the same. So brand building for sponsor, for PE, for VC is becoming key, so invest in that sense. This is why we see all these international brands that are successful everywhere.
Good point. Thank you. Thank you for concluding on the regulatory piece. That's a burning talk of the point for every startup, every tech company which is ever thinking of going out and exploring an investment there. Dr. Tandon, thank you. I have a question for you. How do you see the journey of the medtech and the sentiment in the Silicon Valley vis-a-vis India thing? I mean, considering your extensive experience on the medtech, I would like to hear how do you perceive that? What's the sentiment? How the trends have shifted towards India and its favor? If you can throw some light on that. Thank you.
Thank you, Karthik. I too, like Padmja, would like to start off by thanking Rajat and Akriti and the rest of the IVCA team for inviting me and including me, and also my dear friend Visa for connecting me with the folks that I already know. So it's a pleasure being here. In the context of cross-border, Karthik also being included, as you know, that the critical and emerging technologies was initially launched with a deeper focus on it between US and India in 2020. And at that time, the focus was more in space, cybersecurity, semiconductor, AI, so on and so forth. And the more recent development is that we also have biotechnology and the general area. So the deep tech is expanding, and the medtech specifically, the way we are looking at it, is going to benefit a lot from multiple forces that are at play. So first of all, in medtech, as you know, early intervention plays a very critical role in ensuring that we save lives of the patients, and we also save the whole economic issue. Oftentimes, when you don't have early detection, then you have the lack of the economic equity becomes even more dire. So medtech is going to play a very important role, and the imaging aspect with the help of AI will play a pivotal role in making exponential leap out here. And the cross-border element is going to be important because India, of course, has a scale of 1.4 billion. And as we all know, that medtech is getting to be more and more engineering coming into medtech. And maybe 10 years ago, we would not have looked at India the way we look at India today. But after the Chandrayaan and after the COVID and the success that India has had during the whole COVID debacle that we had worldwide and India's pivotal role, India is no more seen as a recipient, but is seen, and also not just as the ones who are filling the bottles and selling it out, right? It is now seen as a co-creator in complex areas of science. And India also lends itself very powerfully to strong critical mass of engineers. And whether it is cybersecurity, which also enters the realm of medtech and biotech because we have health cybersecurity. And we know that many times that has come into play, that whole issue, and it's going to become even more important going forward. So that is going to be an important piece. And from the perspective of Silicon Valley looking at India, many of the Western medtech companies do not have a business model that allows them to enter tier 2, 3, 4 cities in India. That business model is not sustainable there. And if we have Indian entrepreneurs working in those areas, and given the price point that they work with, which made Chandrayaan or a Mars visit possible for India the way they did it, then what they will do is they will create an ecosystem which is going to mature, and then the Western companies, American Medtronics and the others being some of them, can then acquire those Indian entrepreneurial ventures. And so it's going to be a win-win from both sides, and it's going to be a very powerful ecosystem that's going to emerge. So we are very excited. And then there's yet another force which is at play in this, and that is the whole force of Quad. The US, India, Australia, Japan, and all these 4 countries are very powerful from a tech perspective, and they're looking to partner together, not only in just in the areas of geopolitical strategy, but part of that geopolitical strategy is going to be deep tech. And so from all of those perspectives, I think this is an exceptionally powerful time for the cross-border. And I compliment Rajat and his team for making this gathering even more global than it was in the last years.
Thank you. No, this is very encouraging, and my takeaway is simple, that Silicon Valley is bullish on India's story. Just one, perhaps a cautionary statement to our mind or a founder's mind. Is there any other jurisdiction globally which you perceive is as compelling and competing with India when it comes to the investment opportunities or expansion opportunities? So in other words, if a Silicon Valley investor is exploring opportunities in India, I mean, whether there is a competing jurisdiction which is also at the same time propelling their growth story, and India Inc. has to think about it.
No, I think that's a very good question. And I think more and more we are seeing worldwide that countries are trying to become more savvy in ensuring that they have an ecosystem that is being developed that allows investments to come in and their backyards to be utilized better because of the shifting supply chain. So I think we all know the Vietnam story, and there are several other countries like that that are taking advantage of it. But not to deflect the answer from your question, I was in vibrant Gujarat, and I was giving a talk in deep tech, and I was on a panel, and we were talking about semiconductor, and the big announcement was made that Gujarat is going to be the very powerful center for semiconductors in India. Now that would be a difficult story for other countries to compete with. I mean, the Vietnams of the world can compete with the fact that they can take advantage of the changing supply chain. But if India becomes very, invests a lot of time and money on semiconductor, which is such a critical aspect of where the world is going today. Every automobile industry knows that the semiconductor chips are critical to them. The medical devices, every device, chips. So the convergence of all of these forces allows India to be, in some ways, to shine in this story, and also it does help that they have 1.4 billion, a huge internal market. But yes, many countries will compete and will make India be more aware that they cannot sleep at the wheel if they want to take this opportunity, run with it. But from what seems to be happening is that India is looking to make the best of it. But to your point, there will be other players.
Thank you very much. This is very promising.
All right. Thank you so much to all of our distinguished speakers for being with us this evening and for running us through that panel, Unleashing the Potential, Building India from the World. All right, I would like to invite on stage Ramasubramaniam of Anchor Capital. Please come on stage and hand over a token of our appreciation to our panelists who have spoken to us today. Ladies and gentlemen, a quick round of applause. Ladies and gentlemen, a round of applause, and that brings us to a close of day one. But we've got a stellar lineup come tomorrow. Anant Narayan, S. Srinivasan, Ashley Menezes as well will be joining us. But before we wrap it up, I would like to bring on board and on stage Vineet Rai, founder and chairman of the Avishkar Group, to share the closing address. Thank you, ladies and gentlemen.
I think I can see very tired folks. I was given the job of keeping you away from the networking for a long time. I don't think so you want to stay long. So let's try to, well, I know that, but I don't drink, so I avoid talking about drinks from the stage. Anyway, I think just to keep this fast, quick, interesting, I thought I'll actually talk about my own journey. I started in 2001, so a very, very, very long time back. There was no AIF at that time. There was a VCF guideline, no ecosystem. And if you have to search for an entrepreneur, you really need to search for a needle in the haystack. Entrepreneurs were really difficult to find. I'll tell you my story along with the 7 choices of words, and those words pretty much will tell you how our own ecosystem has evolved over the last 20 years. My first word of choice is choice itself. I was a forester. I was living in a forest in Odisha, and I firsthand saw the aspiration of young poor who wanted to be rich. Now, I was very unsure of what rich meant, but I consistently heard from all poor people they wanted to be rich. And it took me to IIM Ahmedabad to search for the meaning of the word rich. And I discovered that you become rich if you have the right to make choices. And that's really what defined richness in general. So started with rich people, rich person can make choices, and then the corollary of this, if you can make choices, you're rich. And so with this conviction, I met one of the gentlemen called Vishnu Varshne. I don't know how many of you would have heard of him. He's considered to be India's first venture capitalist. And Vishnu Varshne introduced me to the word called venture capital. And I thought I need to actually start a fund that will unleash this latent entrepreneurial capability that will help Indian masses to make choices. The second term that I draw from my own background, which is forestry, is ecosystem. So my forestry degree did not help me to raise capital. It took me 5 years to raise my first million. And of course, it's a long and hard journey. But that $1 million did not come because I was really good. It came because there were lots of individuals who stepped forward and who allowed me to actually deliver while while they stood from the background. So people like Jayesh Parekh, Praveen Gandhi, Anant Nageshwaran, Sanjeev Sanyal and others who actually basically allowed me to shine. And I think our industry is built by this contribution of many stalwarts. Some of you saw on the stage, some of you who do not come on the stage. And some of these are the ones, the word ecosystem draws a lot from forest and nurturing. The ecosystem is our collective responsibility. Your presence here today is an important contribution to this ecosystem, so please keep doing it. I know there are not many GPs here, but whosoever is here, my third term is humility. I wanted to use this opportunity to remind all of us here that as general partners, we are not necessarily the center of the universe. We are actually the lever that entrepreneurs seek to support her quest to change the world for better. Let us be mindful that we are a catalyst to the equation and not the equation itself. Our industry must remain humble as we scale. It's very important for us as GPs to keep that in mind as we invest in entrepreneurs. My fourth term is governance, a fairly oft-abused term. I just wanted to exhort my colleagues here to introspect if we are helping young entrepreneurs in building governance guardrails to protect themselves from missteps. We must acknowledge that healthy conflict will exist between the ambition of the entrepreneurs, the interest of shareholders, and the governance of the company. While we acknowledge the importance of governance, we need to spend significantly more time in strengthening the board and allowing governance to emerge independent of our shareholders' interest. I just wanted to highlight that because a lot of time we do not understand how important it is for us to not overlay our shareholders' interest on the running of the company. And I have seen it personally from close. So just my fifth term is, the choice of my word is regulation. I think it's a very important term. But more importantly, our industry today is fueling the future of India as we invest in these entrepreneurs who try to reimagine the world. We need to be more mindful of any misstep given the importance the sector holds for India's future. It is imperative for us as an industry to acknowledge the need to self-govern as we gain prominence. IVCA is actually thinking of bringing forward a code of conduct and code of ethics, and I hope we will follow them rigorously. Please keep that in mind. My next word is sustainability. I started by saying that we should be investing to create multiple choices, but I want to remind everyone that we have to make choices that are sustainable. We cannot be party to creating a world that our future generations find unsustainable. Finally, impact. That's the last word I wanted to talk about. All invest deliver impact, but not all investing is impact investing. I did not know when I started in 2001 that we were trying to would create a new paradigm of investing called impact investing. This industry that wants to intentionally deliver impact now stands as $1 trillion in assets and growing. I think my journey of spending 4 years to raise $1 million was worth it. As I conclude, I wanted to draw your attention to Sustainable Development Goals, or SDGs. In 2015, 193 governments of the world came together to sign an agreement that imagined a world without hunger, without poverty, without inequity by 2030. This is an opportunity to rewrite human history, and each one of you has a role to play in making the world beautiful, sustainable, and worthy for your future generation. Do not miss the lifetime opportunity as you make your investment choices. Namaskar, thank you. We are going to meet tomorrow, and do come here. Unfortunately, I won't be around, but best of luck and enjoy yourself.
driving policy changes across the world, but could also fundamentally change the way the companies operate and could potentially alter the global trade route maps. As brands revisit their business models to cater to this shift in consumption pattern and a rapidly evolving regulatory landscape, there would be tremendous opportunities in both debt and equity financing across these value chains. Our ESG First Fund provides non-dilutive capital to small and medium businesses who are operating within such supply chains, not just to adapt and survive, but to benefit and scale from this, what we believe is a multi-decadal fundamental shift. At the IVCA Conclave, I look forward to meeting like-minded investors who are as committed to investing in building a sustainable and inclusive world as.
Hi, this is Amit Agarwal, and I represent Edelweiss Alternatives, which is one of the largest asset managers in the alternatives industry in India, managing more than $6.5 billion. Of this, we have almost $4.5 billion in private credit. We are the pioneers of private credit, and we believe that this industry is touted to be almost $100 billion over the next decade. Private credit provides bespoke financing solutions to its client and helping them grow their companies. We look forward to seeing you at the IVCA Conclave, where I will be sharing my views on the private credit industry as a part of a panel discussion. Look forward to seeing you all at the IVCA Conclave.
Hi all, my name is Ashwindar Sethi. I'm a partner with Analysis Mason based in New Delhi, focus on internet verticals, doing a lot of corporate strategy and M&A work with internet-first businesses. Indian firms in tech-first verticals such as software as a service and AI are actually leveraging their cost advantage and efficient cost structure to